So now let's start our discussion on the second head of income, guys. Income from house property. A small, simple, sweet little head of income. Two main conditions in this head. Condition number one, there must first of all be a house property. And condition number two, the assessee must be the owner of this house property. Only when both these conditions are fulfilled, you can even enter into this head. Okay, guys, let's talk about these one by one. Condition number one, there must be a house property. See, house property means what? There has to be a superstructure. Superstructure means there must be a building. What if there is no building? What if there is a land? If there is a land, the land has to be appurtenant to building. That is, the land has to be connected to building. So under IFHP, the subject matter is house property. That house property will either be a building or it will be a land which is appurtenant to building. That is a land which is connected to building. Okay. What if I have a vacant piece of land? What if I have given a vacant piece of land on rent for car parking, let's say? Then whatever rental income I get, will it come under IFHP head? No, guys. Understand? If it's a vacant piece of land, there is no superstructure. There is no building. It's just an independent piece of land. It is not connected to building. So vacant plot of land, vacant piece of land, that from that whatever rental income you get, that will always come under the IFOS head only. Okay, guys. So when will your IFHP head get triggered? Only there is a house property, and house property means either there must be a building or there must be a land which is connected to building. Now see, the next big question is whether this building will also include commercial properties also. See, we have the word house property. We have the word house. But don't get fooled by the word house, okay? Even though we're using the word house property, it doesn't mean we're covering only residential houses. No, we're also covering offices, storage units, factory, music hall, auditorium. We're covering them all under the IFHP head, okay? So building you have understood. But house property discussion is not complete until we understand properly land appurtenant to building. The land has to be appurtenant to building, which means the land has to be attached to the building. The land has to be connected to the building. The land is not independent of the building. Straight away come to this small diagram over here and try to understand. There's one superstructure, guys. I have a house over here. That's a superstructure. Now around the superstructure there's a garden, guys. Now is this an independent garden altogether? No, it is connected to the building. So this garden becomes land which is appurtenant to building. Similarly, now you see this road. This is called as approach road. This road cannot be used for any other purpose. It can be used only to reach this house. Even this road is a part of this entire property. So even this road, it's a piece of land only. But this piece of land is connected to the building. Even this becomes land appurtenant to building. So my first example was the garden. My second example is this approach road. Then similarly, there's also one car parking area over here. Now even this is a piece of land, guys. Piece of land on which car will be parked. Now this piece of land again is not an independent piece of land. It is connected to this building. So even this car parking becomes a land which is appurtenant to building. Understanding? So land appurtenant to building means it should be having some connection with the building. Okay, guys. So till here everybody is crystal clear. My first condition, house property, is clear. So point number one, there must be a superstructure. There must either be a building or there must be a land appurtenant to building. Point number two, that building need not necessarily be a house. It need not necessarily be a residential house. It can also be a commercial unit, not a problem. So house property, point number one, you've understood. Now comes my second condition. The assessee has to be the owner of the property. The owner generally refers to the legal owner, but we also have something called as deemed owner covered under section 227. In deemed owner, guys, we have totally 6 situations, okay? If any of these 6 situations are applicable, then deemed owner concept will come into the picture. If none of the 6 situations are applicable, then we will always pick the normal usual legal owner only. I'll help you understand what is this legal owner, what is this deemed owner. You will understand. Listen to me. In my first situation, let's say there's a person, Mr. Blue, and then let us say there is Mrs. Blue. Okay, so Blue, what Mr. Blue is doing is he is transferring his house property to his spouse, Mrs. Blue. In return, he is getting no consideration or inadequate consideration. So assessee is transferring a house to spouse for no consideration or inadequate consideration. Now tell me, guys, who becomes the legal owner of the house? Of course, the transferee, Mrs. Blue, will become the legal owner of the house, guys. But IFHP head section 27 says, in such case, I don't care about the legal owner. Instead, the transferor, assessee Mr. Blue, he will become the deemed owner. You will do full IFHP computation in Blue's hands only. Simple, guys. So if assessee is transferring house to spouse for no consideration or inadequate consideration, then you will not care about the legal owner. Instead, the transferor, assessee, will become deemed owner. Okay, guys. Now listen to me. What if Mr. Blue is not giving house to Mrs. Blue? What if Mr. Blue is giving, let's say, money to Mrs. Blue? And with that money, Mrs. Blue is buying a house. Then you cannot apply deemed owner concept. deemed owner concept you will apply only if assessee is transferring a house. Okay guys, now listen to me. What if Blue is transferring house to Mrs. Blue but under an agreement to live apart? Agreement to live apart is nothing but one fancy term for divorce, guys. So under divorce proceedings, if Blue is transferring a house to Mrs. Blue, now tell me, will you apply the deemed owner concept? No. If the transfer happens under an agreement to live apart, then the deemed owner concept will not apply. If deemed owner concept is not applicable, then whoever is the legal owner, Mrs. Blue, the transferee, the legal owner, that person itself will do IFHP computation and will pay tax. Got it, guys? This was my first situation of deemed owner. Now listen, okay, there's a potential for a silly mistake over here. So listen to me very, very carefully. I'll give you one small situation. Let's say same thing, Blue and Blue's spouse. Okay, so Blue has transferred a house property to his spouse for no consideration or for inadequate consideration. Now even though Blue's spouse happens to be the legal owner, you're ignoring the legal owner and you're assuming Blue, the transferor itself, to be the deemed owner. So in Blue's hands only you will do IFHP computation also, and Blue only will pay tax on this IFHP also. This is what we have just studied. Now there's one more concept called the clubbing concept, guys. There also you have a similar provision. In clubbing concept, we learned that if any assessee transfers any asset to spouse for no consideration or for inadequate consideration, then from this asset, whatever income the spouse earns, that income will be clubbed with the transferor assessee. Now, don't you think, guys, this is exactly what, or at least similar to this is what we're doing even in deemed owner concept. Even over here, we're ignoring the legal owner, and whatever is the income from this house property, this person, Mr. Blue, the transferor, he only is paying tax on this income. So can I say that in this deemed owner concept is also applicable, clubbing concept is also applicable? No, guys. Always remember, whenever deemed owner and clubbing both are applying, please don't apply clubbing, apply deemed owner instead. Deemed owner concept has more weightage over clubbing concept. Okay, guys? One small simple extra point for you, that in this situation deemed owner is also applicable, clubbing is also applicable. So when this overlapping situation arises, apply deemed owner and not clubbing. That is why if you see in the clubbing provisions, it is very clearly mentioned that this asset that the assessee is transferring to spouse, this asset should not be house property, because if it is house property, deemed owner concept will apply instead. Okay, guys, so this was your first situation under deemed owner. Now coming to the second situation. In the second situation, let's say there's a person, Mr. Blue, and let's say there's a person, Red. Red happens to be Blue's minor daughter. Okay, so what happened is Mr. Blue has transferred to his minor daughter a house property for no consideration or for inadequate consideration. Now again the same thing happens. Red, the transferee, becomes a legal owner, but I don't care about the legal owner. Instead, the transferor, Mr. Blue, will become the deemed owner. So the IFHP computation will be in Blue's hands only. Whatever is the income from this house property, Blue only will pay tax on the income. Okay, guys, we are applying the clubbing provisions. Now what if however this Red, what if this minor child happens to be a minor married daughter? If the minor child happens to be a minor married daughter, then the deemed owner concept will not apply. Now see, if deemed owner concept doesn't apply, clubbing provision will apply. I'll help you understand this point. Listen to me. See, there's a provision under clubbing chapter that whatever income the minor child earns, okay, if the income is not because of skill, talent, labor, if the minor child is not disabled, then whatever income the minor child has earned, this income has to be clubbed. It has to be clubbed with the income of that parent who has higher income. This is a clubbing provision. Alright, now listen, let's put this in the side. I'll give you some situations. Situation number 1. The father transferred a house property to his minor child for no consideration or inadequate consideration. From this house property, the minor child is earning IFHP. This IFHP, tell me, it becomes income of the minor child. So will you apply clubbing provisions or will you apply the deemed owner provision? This situation is getting fitted under the deemed owner second situation, guys. Assessee is transferring house to minor child for no consideration or inadequate consideration. Minor child is a legal owner. I will ignore the legal owner. Instead, the father will become the deemed owner. So here you will apply the deemed owner concept. If deemed owner concept is applicable, clubbing concept will not apply. Okay. Then comes my second situation. This time, the father transfers house property to minor married daughter. If the minor child happens to be a minor married daughter, then deemed owner concept will not apply. If deemed owner concept is not applicable, then in that case you can apply the clubbing concept. The clubbing, why clubbing concept? Because don't you think it's the same situation, guys? Minor child, the minor married daughter, is earning income income from house property. So you will club that income from house property with the parent who has higher income. Now here you have to be careful. The IFHP in this situation will be clubbed not necessarily with the father's income, not necessary. We will club it with father or mother, whoever has higher income. Okay, see, if deemed owner concept is applicable, okay, only the transferor, in our example the father only will be deemed owner. But if clubbing concept is applicable, then you will club the income with mother or father, whoever has higher income, not necessarily with the transferor's income. Okay, small point, be careful. So this was the second point. So in my deemed owner situation, my first situation, assessee is transferring a house to spouse for no consideration or inadequate consideration. Now the transferor assessee will be deemed to be the owner. But however, if the transfer is under an agreement to live apart, then we will not apply deemed owner concept. In my second situation, assessee is transferring a house to minor child other than minor married daughter. Now the transferor assessee will become the deemed owner. Okay, always remember, whenever the deemed owner and clubbing, both the provisions are applicable, give priority to deemed owner. But in case deemed owner is not applicable, then think about clubbing. Okay guys, these are the two most important situations under deemed owner. We have 4 more situations, not very important. I'll quickly give you a reminder of the remaining 4. In my third situation, holder of an impartible estate. Impartible estate is nothing but a property which cannot be partitioned. So whoever is the holder of that property, he will be deemed to be the owner of the property. Then comes my fourth situation. In my fourth situation, what happens is, let's say there's a cooperative society, okay, and I happen to be a member of this cooperative society. Now this cooperative society owns one building. In that building, there are many houses, guys. Now one of these houses, the cooperative society is allocating to me, and who am I? I'm a member of the society. Okay, now who is the owner of this property, guys? The cooperative society, they are only the legal owner of the property, but I will ignore the legal owner. Instead, the member to whom the unit is allotted, that member, me in my example, will become the deemed owner. Okay, so the member of a cooperative society or an AOP or a BOI or a company to whom a house property is allotted under a house building scheme will be deemed to be the owner. Then comes my fifth situation. Here I am talking about part performance. That is nothing but 53A of TOPA. The same point, guys, will come once again in a capital gains chapter as well. See, there are 3 simple conditions. Okay, imagine there is a seller and there is a buyer. Okay, the seller wants to sell and let's say he wants to sell a house property to the buyer. Okay, so between the seller and the buyer, we already have a written agreement for the sale. Let's say the buyer has already paid consideration also to the seller, and let's say the seller has already given the possession of the property also to the buyer. So there's a written agreement of sale between the seller and the buyer. The buyer has given consideration to the seller. The seller has given possession of the property to the buyer. Everything is over. What is pending? Only registration is still pending. So in the eyes of the law, the seller is only still the legal owner, guys, because this entire transaction registration is not done till now. So the seller is still the legal owner. But however, if all these 3 conditions are fulfilled, what are the 3 conditions? There's a written agreement between the buyer and the seller. Buyer has paid consideration. Seller has given the possession also to the buyer. If all these 3 conditions are fulfilled, even though the seller is still the legal owner, but still the buyer will be deemed to be the owner. This is called as part performance, guys. Why part performance? Why not complete performance? What is pending? Registration is pending. Because registration is pending, it is not complete performance, it is only part performance. Okay guys, this is derived from 53A of Transfer of Property Act. Alright, TOPA is nothing but Transfer of Property Act over here. Alright, so if all these conditions are fulfilled, even though the seller only is a legal owner in the eyes of law, the buyer will be deemed to be the owner. IFHP computation will be in the buyer's hands only. Okay, then comes my 6th situation, my last situation of deemed owner. This is very simple, guys. Imagine a situation where there's Mr. Blue who owns a property, and there's Mr. Green, he wants to take this property on lease. Okay, so Green becomes the lessee over here and Blue becomes a lesser of the property, guys. So Blue is giving his house property on lease to Green, and the lease period is minimum 12 years. The lease period is greater than or equal to 12 years. If these conditions are fulfilled, even though Green is only the lessee, even though real owner is Mr. Blue, the lesser, still Green, the lessee, will be deemed to be the owner. Okay guys, that's all. There are 6 situations. In all of these 6 situations, we have the concept of deemed owner. Come on, let's revise. What are these 6 situations one by one? Situation number 1, when assessee transfers a house to his spouse for no consideration or inadequate consideration, but it should not be under an agreement to live apart. Then second situation, assessee is transferring a house to his minor child, but should not be a minor married daughter. Then third situation, holder of impartible estate. Fourth situation, member of cooperative society, AOP, BOI or company to whom a unit of house was allotted under the house building building scheme. The number 5 part performance under 53A of TOPA, wherein only registration of the property is pending. There's a written agreement between the buyer and the seller. Buyer has paid consideration to the seller. Even possession of the property is given to the buyer. If all these conditions are fulfilled, only registration is pending, then the buyer will be deemed to be the owner. Then we saw the last situation wherein the lease period is minimum 12 years. If the lease period is minimum 12 years, then the lessee will be deemed to be the owner. Got it, guys? So this was your entire discussion about deemed owner. Now listen, let's move into the IFHP computation part. How exactly do you compute IFHP? You have to see whether the property is a self-occupied property or let-out property. Accordingly, your computation will change, guys. So if the property happens to be a self-occupied property, you will always start with net annual value. Net annual value will always be 0 for self-occupied property. Then from that you will subtract deductions under section 24. Generally, you have two deductions, standard deduction and interest on borrowed capital. Standard deduction is 30% of NAV. But because for self-occupied property NAV is 0, 30% of 0 will also be 0 only. So that is why for self-occupied property we have only one deduction under section 24, and that is the interest deduction. We don't have the standard deduction because it is 0 only anyways. So for self-occupied property we'll start with the NAV. NAV will always be 0. Then we will subtract deductions under section 24. Generally we have two deductions, but for self-occupied property we will have only one deduction, which is interest on borrowed capital. Now that interest is generally of two types, pre-construction interest and current year interest. I'll come to this part a little later. Okay, so from 0 we will be subtracting interest, therefore the net number will always be a loss only. But also, guys, it can also be 0, right? Like for example, if my NAV is 0 and my SSE is not having any interest, let's say, so interest is 0, so 0 minus 0, my net number will be 0 only, my IFHP will be 0 only. So in the normal regime, if it is self-occupied property, my answer will either be a negative number and hence a loss, or it will be 0. Okay, but now let's talk about the default regime. See, guys, in our salaries head of income, there were 4 changes because of the change of regime. But in our IFHP head of income, in the entire head, if assessee follows the default regime, there will be only one change, and the change is in self-occupied property. In let-out property, there is going to be no change. In let-out property, whether assessee is following default regime or normal regime, answer will be the same only. Because of the change of regime, because assessee is following default regime, the answer will change only in self-occupied property. That too, nothing much, guys. Self-occupied property, how do you start, guys? NAV will always be 0. If assessee is following default regime, then interest we will not allow. So interest also will always be 0 only. Therefore, your net number will always be 0 in default regime. Getting it, guys? So in default regime, there is only one possibility, and that is in self-occupied property, your answer has to be 0 only. It can't even be a negative number because interest is never allowed under the default regime. Got it, guys? So giving you a summary, giving you a revision of the revision in the entire IFHP head. Because of the change of regime, there will be a change only in which property? In self-occupied property. That a big change or small change? Small simple change only, guys. What is the change? In the default regime, interest is not allowed. So therefore, NAV will anyways be 0. Interest will also always be 0. So 0 minus 0, your net IFHP will be 0 only under the default regime. So if I have to make one small summary for you, listen to me carefully, okay? One small simple summary I'll make for you. I'm going to compare two things. I'm going to compare the normal regime and I'm going to compare the default regime. Okay. Now, if my assessee is following the normal regime in self-occupied property, by the way, can the answer ever be a positive? Can we have income from house property if it is self-occupied property? No, guys, answer cannot be positive because 0 minus interest, it will always be negative only. So it can't be positive. Even in default regime, it can't be a positive number. Then can it be a negative number? Like 0 minus interest, it will be a negative number under the normal regime. So it can be a negative number. But in default regime, I'm not going to let you subtract the interest. So 0 minus 0 only, it will always be 0 only. Negative number is not possible. Can it be 0? In normal regime, yes, it can be 0. I had given you the example here already. In default regime, it will always anyways be 0 only. So conclusion, in the normal regime, in self-occupied property, your answer will either be negative or it will be 0. In default regime, it will always be 0 only. Simple, guys. Nothing complicated, very easy. That's it about a self-occupied property IFHP computation. Now let's see how to do the computation if it is a let-out property. Let-out property, you will have one single learning only. Whether assessee is following normal regime, whether he is following default regime, there will be no change. In our entire IFHP chapter, if assessee follows default regime, there will be change only in one concept, and that is in self-occupied property concept. Okay, let's move on to let-out property now. Let-out property, you start with GAV, gross annual value. self-occupied property, you start with net annual value, right? Lettered property, you start with gross annual value. How to compute gross annual value, I'll teach you a little later. So from the gross annual value, you will subtract municipal taxes paid, you'll get the net annual value number. From the net annual value, you will subtract 2 deductions under section 24 and you will get the IFHP number. So GAV less municipal taxes paid, you will get the net annual value, and from net annual value, you will subtract 2 things, 2 deductions under section 24, standard deduction and interest on borrowed capital, and you will get income from house property. Okay guys, GAV we'll see a little later. Let's talk about municipal taxes first. 3 points, okay. Point number 1, municipal tax is also called as property tax. It's also called as sewage tax. Then point number 2, it has to be paid. It has to be paid. Basically, it is allowed only on payment basis. Remember, even in salaries chapter, we saw something which will be only on payment basis. Can you tell me? Salaries chapter, there was one thing we learned which is allowed only on payment basis, somewhere in section 16 deductions. Professional tax, guys, even professional tax, even municipal tax, both are allowed only on payment basis. And my third point with respect to municipal tax, okay, municipal tax has to be paid, but it has to be paid by whom? It has to be paid by the owner, by the assessee himself. Okay guys, now see, one small comparison I will show you. Professional tax and municipal tax. Okay, professional tax is allowed under the salaries head. Municipal tax is allowed under the IFHP head. Professional tax is also payment basis. Municipal tax is also payment basis. Both are allowed on payment basis. But under section 16, professional tax can be paid either by employer or by employee. Total professional tax paid, whether paid by employer, whether paid by employee, the total amount will be allowed for you under section 16 in salaries head, guys. But municipal tax under IFHP head will be allowed only if it is paid by the owner of the property. That is, if the tenant of the property has paid the municipal tax, you will not allow it. Okay, one small comparative analysis, especially this last point, I hope you've registered it in your mind. In section 16 in salaries head, professional tax can be paid by the employer or by the employee. Doesn't matter. Whoever is paying, total professional tax paid you allow under section 16. But municipal tax has to be paid by the assessee. Who is assessee in your IFHP head, guys? The owner of the property. So if the tenant is paying municipal taxes, you will not consider. Okay guys, so GAV less municipal taxes paid, you will get NAV. Then you will subtract deductions under section 24. 2 deductions you will have. Standard deduction will be 30% of your NAV number, and interest on borrowed capital. Always, as soon as you come to interest on borrowed capital, immediately 2 things you will think about: pre-construction interest and current year interest. Simple guys. Now listen, let's focus on this GAV number. How to compute GAV? Let's talk about that now. So to compute GAV, I have to follow 6 steps. Okay. My first step is municipal value of fair rent, whichever is higher. My step 2 is the step 1 number or standard rent, whichever is lesser. This step 2 number is also called as reasonable expected rent or expected rent. You know, nowadays in a lot of questions, they are straight away giving you the expected rent number, guys. That is, they are straight away giving you the step 2 number. So be careful in the examination, in the question, if they use the word expected rent, it is nothing but step 2 number. Okay, so step 1 is municipal value of fair rent, whichever is higher. Step 2 will be step 1 or standard rent, whichever is lesser. Step 3 will be actual rent minus unrealized rent. Unrealized rent, wait, we'll talk about it. Then step 4 will be step 2 or step 3, whichever is higher. Then step 5 will be vacancy loss, and step 4 minus step 5 you will get your GAV number. Come on, once again. Municipal value of fair rent, whichever is higher, step 1. Then step 2 is step 1 or standard rent, whichever is lesser. This step 2 number is also called as reasonable expected rent. Then step 3 is actual rent minus unrealized rent. Then step 4 is nothing but step 2 or step 3, whichever is higher. Then step 5 is vacancy loss, and step 4 minus step 5, I'll get my GAV number. Always remember, you subtract vacancy loss in step number 5 only if in step 4, step 3 is higher. Like step 4 is step 2 or step 3, whichever is higher, right? So either step 2 can be higher or step 3 can be higher. If step 2 is higher, you will not consider vacancy loss. Only if step 3 is higher in your step 4, if step 3 is higher, only then you can consider vacancy loss in step 5. So that is why I've written over here, vacancy loss you will subtract only if step 3 is higher in step 4. So in step 4, if step 2 is higher, then no vacancy loss, you will not subtract. But in step 4, if step 3 is higher, then only you will subtract vacancy loss in step 5. Got it, guys? So this was how do you compute your GAV number. Then sometimes what happens is in the question, municipal value, fair rent, standard rent, all the 3 numbers they will not give. Okay, even one they are not giving. Neither municipal value nor fair rent nor standard rent, none of the 3 numbers they have given to you. Then in that case, to compute GAV, you can use shortcut. What's a shortcut? Actual rent minus unrealized rent minus vacancy loss. Okay guys, unrealized rent, don't worry, little later I'll show you the conditions and all. So for now, the broad framework of IFHP computation is clear. Okay, now let's talk a little bit more about the interest point, interest on borrowed capital. See, you subtract interest on borrowed capital under section 24 guys. Even in self-occupied property you're subtracting, even in let-out property you're subtracting. In self-occupied property, in default regime, you will not subtract the interest, but in the normal regime you will subtract the interest. In let-out property, irrespective of the regime, you will subtract the interest. Okay, now for this interest on borrowed capital, you have two limits guys. You have the 2 lakh limit and 30,000 limit, but please know that all these limits will apply only in self-occupied properties. If my property happens to be a let-out property, then whatever is my interest on borrowed capital, it will be fully allowed under section 24. There is no limit guys. 2 lakh limit, 30,000 limit, nothing will apply for let-out property. Only for self-occupied property we have two limits, 2 lakh limit and 30,000 limit. Of course guys, we want the 2 lakh limit only, but if you want the 2 lakh limit, you have to fulfill 3 conditions. Condition number 1 is that the date of borrowing has to be on or after 1st April 1999. See, not the date of sanction, the date of borrowing I'm talking about. See, I'll tell you why I've mentioned date of sanction and I've struck it off. I'll tell you why I've done that, okay? A little later in chapter 6A, you will have section 80EE, 80EEA, the sections which talk about your interest on housing loan. Then you have 80EEB, the section which talks about interest on electric vehicle loan. In these 3 sections and all, we will talk about the date of sanction of the loan guys. But in this 2 lakhs limit, I am talking about the date of borrowing and not the date of sanction. There's a difference guys. Date of borrowing and date of sanction are different guys. Date of sanction is nothing but the date on which the loan was approved for me. Date of borrowing is nothing but when did the lender actually give me the loan, that is the date of borrowing. Date of sanction is nothing but the approval date. When was my loan approved? When was my loan sanctioned? Okay, so I don't care about the loan sanction date, I care about the date of borrowing. Date of borrowing has to be on or after 1st April 1999 in condition number 1. Condition number 2, the loan should be borrowed for the purpose of purchase or construction, not reconstruction, not renovation, not repair, not renewal. Did you hear what I said? Not reconstruction. See, construction, reconstruction, not the same. In reconstruction, renovation, repair, renewal, they are all the same. Reconstruction is nothing but renovation of the property guys. The loan should not be for all that. Loan should be only for purchase or for construction. And condition number 3, the purchase or construction should be completed within 5 years from the end of the year of borrowing. Like for example, let's say the loan was borrowed on the 1st of April 2012 for the purpose of purchasing one property. Is the date of borrowing after 1st April 1999? Yes. Is a loan borrowed for purchase or construction? Yes. Now the third condition, listen to me carefully. Let's say the loan was borrowed on 4th of April 2012. Okay. Now, what is the year of borrowing? What is the previous year of borrowing? It is previous year 2012-13 guys. This is the previous year in which the loan is borrowed. Now, what is the end of this previous year? The end of this previous year will be 31st March 2013. From the end of the previous year plus 5 years, that is by 31st March 2018, you must complete the purchase or construction as the case may be. Understanding? So, purchase or construction should be completed within 5 years. Don't remember just 5 years. Also remember 5 years from when? 5 years from the end of the year of borrowing. Okay guys, so if all the 3 conditions are fulfilled, then the maximum limit for interest in self-occupied property will be 2 lakh rupees. No limit in let-out property. Limit is only in self-occupied property. Okay, but in case even one condition is not fulfilled, then 30,000 limit will apply. Got it guys? So point 1, point 2, clear. Now listen to my next point. What is the meaning of interest? Now see, the meaning of interest is given in section 2 clause 28a. Okay. Now the interest definition very clearly says that interest also includes loan processing fees, loan application fees. Very simple guys. Whenever you go to apply for a loan, you have to pay loan application fees, loan service fees, loan processing fees, all that. Even all these fees also will be considered as interest for the purpose of Income Tax Act. Okay. Remember this definition because later in tedious revision, when I come to 194A, there the same interest point will come again. So remember this till then, okay? So coming back to my interest discussion, interest also includes loan processing fee, loan service fees and loan application fees. But in IFHP chapter, interest means interest only. In IFHP chapter, interest does not include all these fees. Generally, interest includes loan application fees, loan processing fees and all. But for the purpose of section 24, for the purpose of IFHP chapter, interest does not include the loan processing fees and all that. Small point, remember. Okay, then comes my next point under interest. Who is a lender? Doesn't even matter, guys. Life is simple in IFHP head. Lender can be a bank, lender can be a financial institution, lender can be NBFC, lender can be a money lender, friend, relative, any person, doesn't matter. It doesn't matter from whom are you borrowing the loan, just that you must have borrowed one housing loan. Okay, guys. Then one more point about this interest. Okay, this interest is allowed on accrual basis, guys, which means I don't care whether you've paid the interest or not. You should have incurred the interest. If you've incurred the interest, we will allow it under section 24. Alright, guys. Then comes the most important discussion of your interest concept, the most important adjustment in your entire IFHP chapter, pre-construction interest. See, listen, under section 24, you have two deductions. You have standard deduction and you have interest on borrowed capital. Whether let out property, whether self-occupied property. As soon as you come to the interest on borrowed capital step, immediately two bulbs should glow in your mind. Current year interest, pre-construction interest. Current year interest is simple. Whatever is the current year's interest, you will put it over there. Now, pre-construction interest, you will have only if first of all two conditions are fulfilled. But please know that whatever I'm going to be talking to you about in pre-construction interest applies to both self-occupied property also, let out property also. Okay, but before you can do the steps, your checkpoint, you have to check two things. Only if both these conditions are fulfilled, only then you will have pre-construction interest. Okay, condition number one, why did you borrow the loan? You should have borrowed the loan for purchase or construction of the property. See, even though we are saying pre-construction, it is not necessary it has to be construction only. It can be purchase or construction. Remember, in your entire IFHP chapter, purchase and construction go hand in hand. In fact, in your entire income tax syllabus, purchase and construction go hand in hand except in section 80EE and 80EA. 80EE, you will be learning in your chapter 6A. There we have a special treatment for purchase and special treatment for construction. Okay, so except these two places, in all other places in your income tax syllabus, purchase and construction, these two words will go hand in hand. Okay, so even though we are saying pre-construction interest, it's okay, the loan can also be borrowed for purchase, that is also fine. Okay, then comes one more condition, pre-construction. Pre-construction means what? Before construction. So we should have borrowed the loan before construction. That is, the date of borrowing should be before the date of construction completion. Okay, so if both these checkpoints are fulfilled, only then you will have pre-construction interest. So point number one, pre-construction interest concept is applicable under self-occupied property and let out property. Point number two, you will have pre-construction interest only if two checkpoints are fulfilled. Checkpoint number one, date of borrowing has to be before the date of construction completion, and checkpoint number two, the loan should be borrowed for purchase or construction of the property. Okay, now if both of these checkpoints are fulfilled, then you will have pre-construction interest, guys. For that you will do 6 steps. Your first step will be the date of construction completion. Like, let's take one small example. Let's say the date of borrowing is 1st October 2022 and the date of construction completion is 1st June 2025. So point number one, date of borrowing is before the date of construction completion. So my checkpoint number one is fulfilled. Then checkpoint number two, let's say the loan is borrowed for purchase or construction, which means checkpoint 2 is fulfilled. So welcome to pre-construction interest. Now I have my 6 steps. Simple 6 steps, guys. Nothing to worry. My step number 1 is date of construction completion. What's my date of construction completion here? 1st June 2025. Then comes preceding 31st March, which means before 1st June 2025. What is the preceding 31st March? That will be 31st March 2025, guys. Then date of repayment. Let's say there is no date of repayment, so not applicable. So out of these two numbers, whichever is the earlier date, which is the earlier date over here, 31st March 2025. Okay, guys. So step 1 is date of construction completion. Step 2 is preceding 31st March, before the date of construction completion, the preceding 31st March, or date of repayment, whichever is earlier. Okay. Then comes step 3, the most important step, guys. You always slow down at this step. Step 3 is nothing but your pre-construction period. Your pre-construction period will start on the date of borrowing, which is 1st October 2022, and it will go on till your step 2 date, that is 31st March 2025. In this step, to avoid silly mistake, write how long this period is. Like over here, October, November, December, Jan, Feb, March. So 6 months in 22-23, then 12 months in 24-25. So totally, I will have 18 months over here. Understanding? So this becomes your pre-construction period, 18 months. Okay. So your first step is date of construction completion. Your second step is a preceding 31st March before the date of construction completion, or the date of repayment, whichever is earlier. earlier. Okay, then your step 3 date, which is the most important step, is your pre-construction period. Pre-construction period will always start on the date of borrowing and it will end on the step 2 date. Okay, so whatever is this period, however long this period is, that becomes your pre-construction period. Always mention how many months or how many years, mention over here to eliminate silly mistake in this discussion. Okay, then comes step 4. For these 18 months you will find interest, that will be pre-construction interest. That pre-construction interest in step 5 you will divide by 5 because pre-construction interest is allowed across 5 years. Now which 5 years? That's your step 6. Which 5 years? Starting from the year of construction completion. What is a year of construction completion? 25-26 guys. So plus 4 more years. So 26-27, 27-28, 28-29 and 29-30. In our examination, our previous year is going to be 25-26. So yes, my current year is in this list of 5 years, which means in the current year I will have pre-construction interest. Please know that if our current year is not in this list of 5 years, then we will not have pre-construction interest at all. In simple words guys, only if my current year is in this list of 5 years, only then I will have pre-construction interest in the current year. Okay, are you clear? 6 simple steps guys. You will start with the date of construction completion, then preceding 31st March or date of repayment, whichever is earlier. Then you will see your pre-construction period. Pre-construction period will start on your date of borrowing and it will end on your step 2 date. Then for that pre-construction period you will find the interest. That interest you will divide by 5 and you will allow across 5 years. Which 5 years? Starting from the year of construction completion plus 4 more years. Then you will ensure your current year is in this list of 5 years. Only then you will have pre-construction interest in the current year. Okay, now see one small eye opener for you. Listen to me carefully. In our example, what was the date of borrowing? Our date of borrowing was 1st October 2022 guys. And remember our pre-construction period, if you see, we are ending it on 31st March 25. Till 31st March 25 we are ending our pre-construction period. But actually construction got completed when? Actually construction got completed only on 1st June 2025. Okay, leave all this, just till here I am talking about right now. So my date of borrowing is 1st October 2022. My date of construction completion is 1st June 2025. But I am stopping my pre-construction interest on 31st March 2025 guys. That's how I did it for you in the computation. Pre-construction period is only till 31st March 2025. Now see, the question arises that, okay fine, till 31st March 2025 we are calling it pre-construction interest. Construction got completed on 1st June 25. So okay, after that till the loan is repaid, whatever is the interest, that will become my current year interest. Fine. The question is, what will happen to these 2 months interest guys? Like after 31st March but before 1st June we have April and May, we have 2 months. Now in these 2 months the property is still under construction, right? Construction got completed only on 1st June. So April and May the property is still under construction. So these 2 months interest, will this also become pre-construction interest? No, because pre-construction interest we stopped on 31st March 25. So these 2 months interest also has to be current year interest only. Always remember guys, it is current year interest. It is not post-construction interest. So in current year, a part of the year might be still under construction. It is okay. It is not post-construction interest. It is current year interest. So current year, what's my current year? My current year is 25-26. So in 25-26, whatever interest I have incurred, it is current year interest. In this 25-26, some months may still be under construction. Some months maybe construction is over. So whether construction is still going on, whether construction is over, doesn't matter. It is current year interest. It is not post construction interest. So even though some months in my current year are still under construction, it is okay. Even that will come under current year interest. Okay guys, so when it comes to interest, we first spoke about the 2 limits, then we discussed the meaning of interest, we said lender can be any person, and then we spoke about pre-construction interest. Okay, now listen, come to section 25. Come on guys, it's last 2-3 points with respect to interest. See, under section 25 we have a very important point. Okay, it's kind of an untested area, so be careful. So let us say I have to pay interest outside India. Okay, let's say like for example I'm borrowing a housing loan from a foreign lender, so I have to pay interest outside India. That's my first condition, interest is payable outside India. And condition number 2, but the house is in India and assessee is a resident. If all these 3 conditions are fulfilled, if you're paying interest outside India for a house situated in India and assessee is a resident, then that interest which you're paying outside India will be allowed in your IFHP computation only if tax is deducted at source. TDS you have to deduct at source, tax you have to deduct at source. only then we will allow interest which you are paying outside India. Okay guys, so the precondition that you have to deduct tax at source, this precondition will apply only if the interest is payable outside India. If the interest is payable in India, like if you're borrowing a loan, a housing loan from an Indian lender, then there is no such condition. This condition will apply only if you're borrowing a loan from a foreign lender. So if the interest is payable outside India, house is situated in India, and assessee is a resident, if all these three conditions are fulfilled, then there's a precondition. You have to deduct tax at source, only then that interest will be allowed in IFHP computation. Okay guys, then last 3 points with respect to interest. Interest on another housing loan borrowed to repay the first housing loan. Like for example, let's say I borrowed housing loan number 1, okay, I was not able to repay it, so I borrowed one more housing loan number 2, to help me repay the first housing loan. Now I'm having two housing loans, so I'll have two interests. Both the interests will be allowed. Housing loan 1 interest also will be allowed, housing loan 2 interest will also be allowed. But however, housing loan I borrowed, let's say housing loan number 1 I borrowed, but this housing loan I am not able to pay the interest. Because I'm not able to pay interest on the housing loan, they are levying on me interest on interest. Interest on unpaid interest. This is like penalty guys. This is like a fine, like a penalty. Interest on unpaid interest will not be allowed. Okay, if I borrow one more housing loan to help me repay the first housing loan, now both the housing loan interest will be allowed, but interest on unpaid interest will not be allowed. Also, any interest on loan borrowed to pay municipal tax, even that will not be allowed. See, you should be borrowing the housing loan to purchase a property, to construct the property, or to repair the property, or to reconstruct, renovate, or renew the property. But if you're going to borrow a loan to pay municipal tax, then that's not a housing loan. So if it's not a housing loan, then the interest on that loan will not be allowed under section 24. So interest on unpaid interest, not allowed. Interest on loan borrowed to pay municipal tax also not allowed. Okay guys, this was our entire discussion with respect to interest. Now listen, okay, moving on to the next part. See, whenever you have any house property, either the house property will be assessed under the IFHP head, sometimes it will go under the IFOS head, and sometimes it will come under the PGBP head. Okay, when will a house property come under the IFHP head guys? We learned in the beginning of the chapter itself, two conditions have to be fulfilled. Condition number 1, there must be a house property, and condition number 2, assessee must be the owner of the house property. Okay, then when will a property go under the IFOS head? Either if it is a piece of land, that is there is no superstructure, there's only a piece of land, in that case whatever rental income you're getting from a piece of land, it will go under the IFOS head. Also, if a house property is still under construction guys, if a house property is still under construction, even that will come under the IFOS head only. I'll give you one simple example. Okay, let's say there's a building which is still under construction. Now some film producer has reached out to the person who's constructing this building, and he's saying that give us your under construction building on rent for 2 days, we have to do some movie shooting in that under construction building. So the person who's constructing that building, he's getting 2 days rent from an under construction building guys. That rent will come under the IFOS head only. You're understanding? If a property is still under construction, welcome to IFOS head. If there is no superstructure, only land, welcome to IFOS head. Okay guys, IFHP head, you can bring the property under IFHP head only if there is a superstructure and assessee is the owner of that superstructure. Okay, then what about the PGBP head? That is what we're learning right now. There are only 2 situations guys when a house property is assessed under the PGBP head. Number 1, when I'm self-occupying the property for my business or profession. Like for example, let's say I'm owning this building, and in this building only I'm running my business. I'm using this building for my profession. So I'm self-occupying the property for my business or profession. Now this property will be assessed under the PGBP head. So all the expenses which I'm incurring for this building, whatever fire insurance premium I'm paying for this building, whatever repairs I'm doing for this building, will all become my business expenses. On this building I will also claim depreciation under the PGBP head. Understanding? So if I'm self-occupying the property for my business or profession, then that property will be assessed under the PGBP head. Then comes the second situation, the important situation, if the assessee is in the business of letting out commercial properties. Now this is a very interesting point. I know, and also a lot of students get confused over here, so listen to me carefully. I'm going to show you 2 businesses, okay? In the first business, I buy properties, okay? Those land, building, whatever I've purchased, they're all my stock in trade, okay? And then I buy and sell these properties. So I'm into, this is nothing but my real estate business, okay? So my business over here is buying and selling properties. I'm in the real estate business. I'm literally trading in properties, alright? Then comes my second business. Here what happens is, I am buying some house properties. Now these house properties are becoming my fixed assets. In my earlier example, the house property was becoming my stock in trade. Now that house property is becoming my fixed asset. What I'm doing with this house property is that I am giving these properties on rent. This is my business, guys. My business is buying houses and then giving them on rent. First of all, do you understand that this first business is different and the second business is different, guys? In my first business is the real estate business, where I am simply trading in properties. I'm just buying and selling properties. I'm just trading in properties. This is real estate business, the first one. The second business is not real estate business. In second business, I'm not trading in properties. In the second business, I'm just giving properties on rent. My business is buying properties and giving them on rent. So right now, I am talking about the second example. I am not talking about real estate business. I am talking about the second example. I am talking about a situation where my assessee's business itself is to let out commercial properties. So my assessee's business itself is to keep buying commercial properties. Those commercial properties will become his fixed assets, and then he will keep giving those commercial properties on rent. See, he is not in the business of buying and selling commercial properties. No, he is not into real estate business. Instead, his business is buying commercial properties and then giving them on rent. So here, whatever rental income he gets from these commercial properties, that will go under the PGBP head. Okay, guys, now listen to me. What if your assessee is in the business of giving residential properties on rent? Then in that case, the rental income will come under the IFHP head only. Only if assessee is in the business of giving commercial properties on rent, only then the rental income will go under the PGBP head. This is a very strict provision, guys. Only in these two situations, the property will go under the PGBP head. In any other situation, even if it sounds logical, no, property will not go under PGBP head. Only in two situations, property will go under the PGBP head. Number one, when the assessee is self-occupying the property for his business or profession, that is, he owns a building and is running his business or his profession in that building. And situation number two, when assessee is in the business of letting out commercial properties. Okay, guys. Now listen, you will wonder that, okay, fine, we excluded real estate business from this entire discussion. What will happen if assessee is into real estate business? In that case, guys, there are three separate transactions. Okay, transaction number one, assessee is, see, in real estate business, assessee is buying and selling properties. Assessee is trading in properties. So whatever income assessee gets from buying and selling properties, from trading in properties, that will go under the PGBP head, guys. From the trading in properties, buying and selling properties, whatever income he gets, it will go under the PGBP head. Okay, now let's take one example. Let's say I'm into real estate business. I am having this building. This is my stock in trade. I want to sell away this building. It's my stock in trade. Okay, but I'm not able to find any buyer only, guys. Nobody wants to buy this building, but I am in need of money. So something is better than nothing for me. So what I decide is, okay, fine, till I get a buyer, let me give this building on rent. So I'm getting rental income from my stock in trade. This rental income, will it go under the PGBP head? Question arises because I'm getting rental income from my stock in trade. So will this rental income come into PGBP head? No confusion, guys. Only two situations, property will come under PGBP head. Number one, when I'm self-occupying the property for my business or profession. Am I self-occupying the property? No, guys, I'm giving it on rent. Number two, assessee is in the business of letting out commercial properties. Am I in the business of letting out commercial properties? No, I'm into real estate business. So first of all, do you agree that this rental income will not come under the PGBP head, guys? Right, it will not come under the PGBP head because none of the two situations are existing over here. Then where will this rent go? There's a superstructure. I own the superstructure. IFHP head. This rent will come under the IFHP head only. Understanding? So if I'm into real estate business, whatever income I earn from the buying and selling of properties, that will go into PGBP head. Whatever rental income I get, that will come under IFHP head only. And now comes a very important point. And also this point is so important, guys, because it is not a very highly tested area. It has never really been tested in the examinations as such, okay? So be very careful. Listen to me. Leave this, straight away come to my discussion over here. I'll help you understand. Let's say I am into real estate business, okay, which means I am having some house property which is my stock in trade. Okay, guys, first tell me, this house property will be assessed for me under which head of income? It's a house property. I own the house property. It will come for me under the IFHP head of income. It won't go into PGBP head because only in two situations it will go under PGBP head. I am neither self-occupying the property for my business or profession, nor am I in the business of letting out commercial properties, therefore no PGBP head. So this house property will be assessed under IFHP head only, guys. Now, if I'm into real estate business and if I'm having house property which is my stock in trade, from this house property the IFHP will always be 0, provided some conditions are fulfilled. Are you understanding in which direction I'm taking you? Generally, in real estate business, whatever income I get from the trading in properties, that will go under the PGBP head. By chance I have rental income, that will come under the IFHP head. But my IFHP from this stock in trade in my real estate business, the IFHP from these house properties in my real estate business, the IFHP will be 0 if some conditions are fulfilled. Listen to me. Condition number 1. Those house properties should be my stock in trade, which means I'm into real estate business. Condition number 2. These properties should be lying vacant. See, if they're not lying vacant, if I'm having rental income, and I've already told you rental income will come under the IFHP head. But in my situation right now, the properties are lying vacant. Okay. Condition number 3, these are new properties. New properties means what? New property means, listen to me carefully. You will see what is the date on which we got the construction completion certificate. When the property's construction is over, the authorities will give us construction completion certificate. We will see what is the date of construction completion certificate. We will see in what year we got the certificate. We will see what is the end of this year. So end of this year, from that date for 2 years. Till this 2 years, we will consider this property as new property. So, in case my property is stock in trade, and if it is lying vacant, and we are within 2 years from the end of the year of construction completion certificate, if all these 3 conditions are fulfilled, then IFHP will be 0. Once 2 years have lapsed, after 2 years, then we will have IFHP, guys. For the first 2 years, from the end of the year in which we got the construction completion certificate, for the first 2 years like this, the IFHP will be 0. But what if any condition is not fulfilled, guys? Then IFHP you will do computation. Like for example, what if I'm having rental income? What if it is not vacant? What if I'm having rental income? Then you will do IFHP computation. What if 2 years have lapsed? What if I'm in the 3rd year? You will do IFHP computation. IFHP will be 0 only if they are my stock in trade. The units are my stock in trade. They are lying vacant and we are within 2 years from the end of the year in which we got construction completion certificate. Now what is a silly mistake area over here? Listen to me. See, 2 years will be counted not from the date of construction completion certificate. No, 2 years will be counted from the end of the year in which we got the construction completion certificate. Got it, guys? That's it. So this was our entire discussion about when the property will be assessed under which head. Okay, can I give you one quick revision of this entire discussion, guys? Listen to me. So we are talking about which property will go under which head. Point number 1, I'll just keep asking you questions, keep answering, everything will get sorted for you very easily. In my first situation, I am having a piece of land which I have given on rent. This rental income will go to which head, guys? This rental income will go under the IFOS head. Why? I own the land, but why IFOS head? Why not IFHP head? Because there is no superstructure. Only if there is a superstructure, I will come into the IFHP head. Okay. Then listen to my second situation. I am having a house property, but this house property is still under construction. Okay. And from this house property, I am having some rental income. Where will this rental income go? Even this will go under the IFOS head. Right, guys? Only when the house property's construction is complete, only then it will come under the IFHP head. Then comes my third situation. I have a house property. There's a superstructure and I'm also an owner of the property. Both my conditions are fulfilled. Now whatever income we have from this property, this will be assessed under which head? This will be assessed under the IFHP head. Okay, guys. Then tell me my fourth situation. In how many situations will a house property be assessed under the PGBP head? In how many situations, guys? Only and only in 2 situations. Very, very strict provision. This is only 2 situations. What are the 2 situations? The first situation, I am self-occupying the property for my business or profession, which means I own a property and I'm carrying on my business or profession in that property. Like for example, I own a building and I'm running my CA practice profession in that building. So I'm self-occupying the property for my business or profession. Now this property will be assessed under PGBP head, which means whatever expenses I'm incurring for this property, whatever taxes I'm paying for this property, whatever insurance I'm paying for this property, all of these will become my business expenses under the PGBP head. Okay. Also on that building, I will claim depreciation under the PGBP head. Okay. Then comes my second situation. In my second situation, I'm having rental income. Rental income from what? I'm having rental income from commercial properties, and my assessee is in the business of letting out these commercial properties. So if my assessee is in the business of letting out commercial properties, whatever rental income we get from these commercial properties, even this will go under the PGBP head. So we have only 2 situations where house property will go under the PGBP head. Then we learned independently about real estate business. If assessee is having a real estate business, and now if assessee is having any rental income, will that also come under the PGBP head? No. We learned real estate business is separate and business of letting out commercial properties is separate. Okay. Answer my question now. In real estate business, in case of, first of all, what is our stock in trade? In real estate business, a stock in trade will be our immovable properties, guys, land, building, both. Then answer my second question. In case you have any income from trading in properties, in real estate business, what do? You trade in properties, you buy and sell properties. So whatever income you get from trading in properties, that will go under your PGBP head, guys, no doubt about that. Then by chance you have any rental income from your stock in trade. You have your stock in trade, you're giving on rent, you're having rental income. Even though it is rental income from stock in trade, still, that rental income will still come under the IFHP head only. Why? Why not PGBP head? Because PGBP head only in two situations. None of the two situations are applicable over here. So rental income, in case I have a rental income in real estate business, it will come under the IFHP head only. Then tell me, in which situation in real estate business will you say that IFHP is 0? In which situation? Some conditions have to be fulfilled. Condition number 1, that house property has to be my stock in trade, which means I am in the real estate business. Condition number 2, it is lying vacant, which means I'm not having any rental income and all. Condition number 3, it should be a new property. Now, new property means what? New property means I will see when did I get the construction completion certificate. I will see in which previous year I got the certificate. I will see what is the end of that previous year. From the end of the previous year, for 2 years, it will be considered as a new property. If all these conditions are fulfilled for these 2 years, IFHP will be 0 only. After 2 years, normal usual computation you will have. Got it, guys? So this was our entire discussion that we had just now with respect to the heads of income. Now answer one more question. Let us say my assessee is having some rental income. Okay, and this rental income is from a residential property. My assessee's business itself is to let out these kind of residential properties. So whatever rental income he is having from letting out residential properties, this rental income will go to which head? Will it come under the IFHP head or will it come under the PGBP head, guys? See, only if you're having rental income from the business of letting out commercial properties, that only will go into PGBP head. Because it is residential property, it will stay under the IFHP head only. Thorough, guys? Yes, so this was our entire discussion about the heads of income. Now come on, guys, you're thorough till here. Now let's move on. See, sometimes the question says that, let's say assessee is having one property and assessee is using it for residence come office. Let's say, for example, 40% of the property he is self-occupying for his residence and the remaining 60% of the property he is using it as his office. So he is using this property for his residence come office. Okay, whenever you have a situation like this, divide and rule. You look at each property, each unit separately. This 40%, guys, I'm self-occupying it for my residence. This will be treated as a normal self-occupied property. I'm self-occupying it for my residence. It will go under the IFHP head, guys. But what about this 40? What about the 60%? The 60%, I am self-occupying the property for my business or profession. So this 60% will go under which head? This 60% will go under the PGBP head. Got it, everybody? So if the property is used for residence come office, you will see what is a percentage given in the question. How much percentage is used for residence? How much percentage is used for office? Accordingly, you will split it into IFHP head and PGBP head. What if the question doesn't say any percentage? Then you will assume 50-50. You will assume 50% used for residence, 50% used for office. Okay. Then coming to my next provision, what if the what if the question says that the house property for a few months it is self-occupied and for a few months it is let out? Like for example, let's say first 6 months it is self-occupied, last 6 months it is let out. Then what will you do? See, part of the year self-occupied, part of the year let out, you will treat as if it is fully let out. Like for example, guys, let's say April to October. April, May, June, July, August, September, October. 7 months the property is self-occupied. Okay. November to December. 2 months the property is let out. Then 1st Jan my assessee sold the property. So my assessee owns a property for 9 months, 7 months self-occupied, 2 months let out. Now what you will do is you will treat as if it is fully let out. Are you noticing? I am not saying let out for the whole year. I am saying that I will treat it as if it is fully let out. Now see, I'll tell you why I am trying to play around with the words. A lot of times students have this sentence in their mind, nicely registered in their mind, that part of their self-occupied, part of their let out, I will treat as if let out for the whole year. Tell me, that is the sentence which comes in your mind, guys. Part of their self-occupied, part of their let out, I will treat as if it is let out for the whole year. You are having it so strongly in your mind, you will straight away do all 12 months let out. Will that be correct in this question? No, right? When I own the property itself for 9 months, how can you do IFHP calculation for 12 months? That is why I always say, don't learn it as let out for the whole year. No. instead say that it will be fully let out, which means whatever is the period that we have, whatever is the period for which we own the property, for this entire 9 months, we will treat as if it is let out. We will treat as if it is let out means what? We will do let out property calculation. Now to do let out property calculation, you need municipal value, fair rent, standard rent, all those numbers you will take for all 9 months in my example. Basically, all the 9 months, even though partly self-occupied, partly let out, all the 9 months you will treat as if let out. Okay, but actual rent, when you're doing let out property calculation, you need actual rent, right? That you will take only for the actually let out period, which in our example is only 2 months. Okay, so everything else you will calculate as if all 9 months, as if fully let out, but actual rent alone you will take only for, like for example, let's say my assessee is having 3 floors in his building. Okay, now out of the 3 floors, 2 floors he is self-occupying and 1 floor he is letting out. So you will treat as if they're 2 separate units, guys. Self-occupied property, the 2 floors you will do separate calculation, and the let out property you will do a separate calculation. Okay, so when part of the house is self-occupied and part of the house is let out, you will treat as if they are 2 separate houses. Simple point. Then comes our next discussion, which is about co-ownership. This is important. Here what happens is, let's say there's one property. This one property is co-owned by both A and B. So 2 owners we are having. Let's say A is owning 60% of the property and B is owning 40% of the property. So A and B are co-owning the property. In simple words, joint ownership, guys. They jointly own the property in the ratio 60:40, let's say. So if there's co-ownership, first of all you will see, are the shares ascertainable or are the shares not ascertainable? Like in my example over here, the share is ascertainable. 60:40, the share is ascertainable. In case it is not ascertainable, then you will imagine as if there is one AOP. In the hands of the imaginary AOP, you will do the IFHP computation. Okay. But if the shares are ascertainable, which is so in our case where the shares are ascertainable, you will check whether the property is let out property or is it a self-occupied property. If it is a let out property, you will do one single computation first. As if there is one single owner, you will do only one single computation first. The final IFHP number that you get, that you will split between my 2 co-owners A and B in the ratio 60:40. Okay, simple. But if it's a self-occupied property, then from the beginning itself you will do separate calculation. Because in self-occupied property you have limit of interest, right? 2 lakhs and 30,000, you have limit on interest in self-occupied property. So each co-owner will get independent limit. That is why if it is a self-occupied property, you will do a separate calculation from the very beginning for each co-owner. But if it is a let out property, you will do one single calculation as if there is one single owner, arrive at the final answer, and that final answer you will split between the 2 co-owners. Easy, guys. This is about co-ownership. Okay, then coming to my next discussion, is there a limit on how many properties you can have? Yes, there's no limit on the let out properties, but there is a limit on the self-occupied properties. See, self-occupied property means what? I'm occupying the property for my residence. Okay, unoccupied property, there's one more concept called unoccupied property. Unoccupied property means the property is unoccupied. I'm neither self-occupying it nor I'm letting it out. It is just lying unoccupied. Okay, why is it unoccupied? I don't care. It can be unoccupied because of any reason. So self-occupied property, unoccupied property, we give them the same treatment only. If it's an unoccupied property, you will do IFHP as if it is self-occupied property only. So let out property, there is no limit. I can have any number of let out units. But self-occupied property, unoccupied property put together, we can have maximum 2 only. What if I have 3? What if I'm Amitabh Bachchan who has 3 houses? Then what will you do? In that case, only 2 houses you will treat them as self-occupied, unoccupied, whatever. The remaining house, that is the third house, will be deemed to be let out property. Deemed to be let out means what? In reality, it is not let out. You will treat it as if it is let out. So you will do full IFHP computation as if it is let out. Let out property means you start with GAV, less municipal taxes paid, you'll get NAV. So normal, usual let out property calculation you will do. Only one thing you have to be careful about. If it is let out property, you will start with GAV, guys. In GAV, remember 6 steps I taught you. But however, if it is a deemed to be let out property, for GAV, you will stop with your step 2 number. That is, you will stop with your reasonable expected rent number. I'll show you. When I had taught you about let out property calculation for GAV, I had given you 6 steps, right? But if it is a deemed to be let out property, you will have only the first 2 steps. You will stop with the reasonable expected rent number. This itself will become the GAV for deemed to be let out properties. Now understood, guys. So coming back to my discussion, self-occupied property, unoccupied property put together, we can have only 2. In case we have more than 2, the excess number of properties beyond 2, the excess will be deemed to be let out. Deemed to be let out means you will treat it as if it is let out. As if it is let out means you will do GAV computation and all. For GAV, you will stop with your step 2 number with a reasonable expected rent number. Okay, guys, that's one small simple point on the limit on the number of properties. Okay, now listen, this is a very interesting discussion. Okay, and for many of you this might be an eye opener, because there's only one question in your study material which actually tests you on this point. Listen to me carefully. Okay, very logical point. In self-occupied properties, you have limit on the interest. No, 2 lakh limit, 30,000 limit. You have limit on the interest. This discussion is about that limit. Now you know when to apply the 2 lakh limit. You know when to apply the 30,000 limit. But what if I have multiple self-occupied properties? Like maximum 2 self-occupied properties I am allowed, guys. Straight away come to my examples. 3 examples I will show you. My entire concept will get covered. Look at this, okay. I am having 2 self-occupied houses, house 1 and house 2. First I will do the calculation for each house separately. House 1, my interest is 1,80,000. But limit applicable is 2 lakh only. Okay. And therefore my interest is within the limit, guys. Therefore, full 1,80,000 will be allowed for house 1. Are you noticing? I am first doing for each house separately. Then coming to house 2. Here the interest is 30,000 only. Limit is 2 lakhs. Again in my house 2 also, the interest is within the limit, guys. So 30,000 will be fully allowed. So first I am doing for each house separately. House 1 I have concluded that 1,80,000 will be allowed. House 2 I have concluded 30,000 will be allowed. Total is how much? Total is 2,10,000. Now listen, just know that this total interest also has to be restricted. So for self-occupied, unoccupied houses, self-occupied and unoccupied houses, in both of these houses, not only will you apply the limit for each house separately, even on the total interest also you will apply the limit. Understanding? So first I applied the limit for each house separately. I found the total interest. Now on this total interest also I will apply one limit. What limit? It depends. 2 lakh for the first house 2 lakhs, second house 2 lakhs. So if it is 2 lakh like this, then the total interest also has to be restricted to 2 lakhs. Understanding? If for house 1 the limit is 2 lakhs and house 2 the limit is 2 lakhs, then the total interest also has to be restricted to 2 lakhs. So not only will you apply the limit for each house separately, you will also apply the limit to the total interest. Okay, guys, come to my second situation now. In my second situation, for house 1, let's say my actual interest is 2,80,000 and my limit applicable is 2 lakhs. So for house 1, my interest is more than the limit, guys. So you will restrict it to 2 lakh rupees. So for house 1, you're going to allow 2 lakh interest. Then house 2, let's say my interest is 1,30,000. But for house 2, let's say limit applicable is only 30,000. So my interest is more than the limit. So you will restrict the interest to 30,000 only. You will restrict it to the limit. So therefore, for house 2, total interest you will allow is 30,000. Now first, same thing. You applied the limit for each house separately. Now total interest, how much are you allowing? 2,30,000. On this total interest also you will have to apply a limit. What limit? If for house 1 the limit is 2 lakhs and for another house the limit is 30,000, then 2 lakhs and 30,000, the total interest will be restricted to 2 lakhs only. Understanding? For house 1, if the limit is 2 lakhs, house 2, if the limit is 2 lakhs, the total interest will also be restricted to 2 lakhs only. If for house 1 the limit is 2 lakhs and house 2 the limit is 30,000, then the total interest will also be restricted to 2 lakhs only. Okay, guys, so 2,30,000 interest, but I will restrict it to 2 lakhs. Now comes my third situation. In my third situation, again I am having 2 houses, 2 self-occupied houses. House 1, my interest is 1,80,000. Limit applicable is 30,000. Interest is more than the limit, so therefore you will restrict the interest to 30,000, guys. House 2, if you see, my interest is 30,000 and the limit applicable for me is 30,000. So my interest is within the limit. So full 30,000 you will allow for house 2. Every time I will first calculate for each house separately. Then I will see the total interest. Now total interest I have to restrict. I'll restrict to how much? Listen to me. If for one house the limit is 30,000 and for another house also if the limit is 30,000, then the total interest also has to be restricted to 30,000. Understanding? So 60,000 is the total interest over here, which will be restricted to 30,000. Getting it? So 2 lakhs, if 2 lakhs and 2 lakhs is a limit for each house, that is for house 1 the limit is 2 lakhs, house 2 also the limit is 2 lakhs, then the total interest also the limit will be 2 lakhs. If for house 1 the limit is 2 lakhs and for house 2 if the limit is 30,000, then for the total interest also the limit will be 2 lakhs. If for house 1 the limit is 30,000 and for the second house also the limit is 30,000, then on the total interest the limit will be 30,000. So basically what I'm trying to communicate to you over here is, don't apply the limit just for each house separately. After that, also remember to apply the limit for all the houses put together. But please know that let out property, there is never any limit on interest. This entire discussion on these limits and all is only for self-occupied and unoccupied properties. Okay guys, then one small discussion with respect to municipal tax. Most of the points I've already told you. Remember, I had already told you it's also called as property tax and sewage tax. Then municipal tax we subtract only in let out property, guys. In self-occupied property, we don't even talk about the municipal tax point. Then municipal tax has to be paid. Remember, it's only allowed on payment basis. Then you can pay municipal tax in India or outside India, doesn't matter. But it has to be paid by whom? Paid by the assessee himself. Which means if the tenant pays municipal tax, we don't consider. You know about this. So now if you see, interest on borrowed capital in your IFHP head, that we are allowing on accrual basis. But municipal tax we allow on payment basis. Okay guys, now coming to the last few concepts now for let out property, how to do the computation. I had already shown you guys GAV computation and all that. We had already seen the format. Now always remember, we do computation only for the period for which assessee owns the property. Like if the assessee is selling the property on 1st Jan, then my assessee is owning the property only from April to December. Only for 9 months he owns the property. So whole IFHP computation only will be for these 9 months only. So computation will be only for the period for which the assessee owns the property. Okay, now let us say assessee owns a property for only 9 months. Okay, they have given you municipal value, fair rent, standard rent and all for the whole year. So in that case, be careful. Remember to do proportionate calculation. Whatever number they have given to you, you should be doing into 9 by 12. Okay, so if they give, if the property is owned by the assessee only for 9 months, but they've given you municipal value, fair rent and standard rent for the entire year, then you have to do proportionate only for 9 months. Remember to do that. Okay, then sometimes what happens is, let's say the entire property, if you see, only 60% of the property is let out. The balance 40% is, let's say, self-occupied. So in that case, you will be doing the let out property calculation only for the 60%, guys. So again, in those cases, many times in the question, municipal value, fair and standard rent and all, they will give you for the entire property. So in that case, again, you have to do proportionate calculation. You have to do into 60%. That's how you will get the municipal value of just this portion of the property, fair rent of just this portion of the property. Okay, so proportionate calculation you might have to do of municipal value, fair rent, standard rent and all in two situations. Situation number 1, whenever the property is owned by the assessee only for a part of the year. So in that case, you have to do computation only for a few months, not for the entire year. And also when only a part of the property is let out, again in those cases you need municipal value only for the let out portion only. So again, you'll have to do proportionate calculation. Okay, remember these two from computation point of view. Then comes an unrealized rent. I'll take you back to the format. I had told you, when you're doing the computation of GAV for let out properties, in step 3, from actual rent, we subtract unrealized rent, guys. And this I had told you I'll discuss with you later. Now is that later. Come on, guys, let's discuss. Unrealized rent means what, first of all? First, understand the meaning. Unrealized rent means a tenant. Defaulting tenant, guys. He was living in my house. He was occupying my house, but he was not paying me rent. Treat it just like bad debts. Just like how in business you have bad debts, no. Same way, if it is bad debts of rent, it will become unrealized rent. Tenant is living in your house, but he is not paying you rent. That is your unrealized rent. Now from actual rent, we are letting you subtract unrealized rent. We're giving you a benefit. We're letting you subtract unrealized rent from actual rent. But that subtraction you can do. You can deduct unrealized rent from actual rent only if rule 4 conditions are fulfilled. 4 conditions are there. Nicely, thoroughly, you have to remember these 4 conditions. The first condition is that the tenancy is bona fide. Bona fide means there must be proper tenancy agreement between the assessee and the tenant. Okay. Now condition number 2, the defaulting tenant, guys. This guy is not paying you rent, no. Will you let him to continue to stay in your house without paying rent? If he is not paying you rent, you will ask him to get out, right? You will evict him. You will ask him to vacate the property. So second condition is that either the defaulting tenant should have already vacated the property, or at least we should have started taking steps to get the property vacated. Okay, now you yourself tell me, the same defaulting tenant, will you give to that person other properties of yours on rent? No, right? You don't trust this tenant anymore. You don't like this person anymore. So the third condition is that the defaulting tenant does not occupy any other property of the assessee. Okay, then comes your fourth condition. Listen to me carefully, very logical, guys. One tenant, he was living in your house. He did not pay you rent. You were having unrealized rent. You asked him to leave the house. He vacated the house. Are you happy? No, guys, 2-3 months rent he did not pay you, right? You want that. Okay, fine, he has vacated the property. But what about the rent which I lost? What about the unrealized rent? You want to recover it, no? So what will you do to recover it? You will file a case against him. That's all, guys. Fourth condition is that you have to file legal proceedings against a defaulting tenant, or at least prove to the AO that legal proceedings will be useless. So if all these 4 conditions are fulfilled, only and only then I will let you deduct unrealized rent from the actual rent. If even one condition is not fulfilled, then I will not subtract unrealized rent from actual rent. Okay, guys, tenancy should be bona fide, defaulting tenant should have vacated the property, or steps should be taken to get the property vacated. The defaulting tenant does not occupy any other property belonging to the assessee, and the assessee has instituted legal proceedings against a defaulting tenant, or at least prove to the AO that legal proceedings would be useless in this case. If even one condition is not fulfilled, you will not subtract unrealized rent. Okay, guys, then a house property is still under construction. I already told you this. This will go under the IFOS head. Remember my movie shooting example. Then unrealized rent recovered, arrears of rent recovered. What about all this? I am having a defaulting tenant. He is not paying me rent. I chucked him out. Okay, I asked him to vacate my property. After vacating my property, that fellow went to the Himalayas. Who? The defaulting tenant. He went to the Himalayas. Went over there, nicely meditated for 4-5 years. Came back as one changed person. He came to me feeling all guilty that Anushree, I did not give you rent for 3 to 4 months. Here, keep your money. So I am recovering my unrealized rent. Earlier, when I incurred the unrealized rent, you let me subtract it in my IFHP computation, guys. Now I am recovering the unrealized rent. When I recover the unrealized rent, I will get flat 30% deduction. The balance 70% will be taxed for me under the IFHP head. Whenever I recover it, in the year in which I recover it, in that year 70% of the money which I am recovering will be taxed for me under the IFHP head. Understanding? See, earlier I had unrealized rent. I fulfilled my 4 conditions. You let me subtract it in my IFHP computation. Now when I recover the unrealized rent, you will give me 30% deduction, balance 70% you will tax it for me. What if earlier some condition was not fulfilled? If some condition was not fulfilled earlier, any rule for condition was not fulfilled, then you will not let me subtract it in my IFHP computation, guys. You will not let me subtract the unrealized rent in my IFHP computation, guys. If you don't let me subtract unrealized rent, later when I recover it, you will not tax it. Okay, guys, simple, logical, right? Only when you let me subtract it earlier, only then now when I'm recovering it, you will tax it for me. But if you did not let me subtract it earlier because maybe some condition was not fulfilled, then now when I recover it, you will not tax it for me. Okay, guys, now one small twist is possible. What if in the year of recovery, what if in that year I don't own the property? After 5 years, that defaulting tenant came to me and is returning the money. No. By then, I've sold the property. I don't even own the property by then. In that case, what will you do? I don't own the property. Will you still tax it for me under the IFHP head? Listen to me. In the entire IFHP head, no doubt, assessee has to be the owner of the property. Only then IFHP head will come into the picture. But arrears of rent recovered, unrealized rent recovered is an exception. In the year in which I recover, whether I own the property, whether I don't own the property doesn't matter. In the year in which I recover, 70% will be taxed. Simple story over. Got it, guys? Yes. Then comes my next discussion, composite rent, guys. Composite rent. Composite. The word composite means it has multiple components. Like for example, I'm charging from the tenant not only rent. I'm also charging from him other charges like lift charges, maintenance charges, water charges, power backup charges. I'm charging other charges also. So my rent is having 2 components now, rent and other charges. This becomes composite rent. Okay. Very simple. In this case, rent alone will go into the IFHP head. Whatever other charges I am collecting from him like power backup charges, maintenance charges and all, all that will go into the IFOS head. Okay, now composite rent has one more form, guys. I can charge from the tenant not only rent for the property but also rent for other assets. Like for example, I can give the tenant my house and I can also give him a car. So when he's giving me rent, he will give me not only rent for the house, he'll also give me rent for some other asset, that is car, guys. So now again my rent is having two components over here, house rent also, car rent also. So whenever I give to the tenant not only the house but also one more asset on rent, even here composite rent concept will come into the picture. Okay, now in this case we'll have to see whether the house and the other asset are they separable or not. Now separable means what? Separable means, is it possible for me to give the house on rent to one person and the car on rent to another person? Yes, guys, it is possible. In that case you will say house and the other asset are separable. If they are separable, house rent alone will come into the IFHP head, car rent will go into the IFOS head. Simple, guys. Are you listening to me? See, nothing to get confused. There are two kinds of composite rent, guys. One is where I'm charging from the tenant rent and other charges. Okay, here rent alone will come to IFHP head, other charges will go under IFOS head, story over. Okay, our whole focus now is on this part. In the second type of composite rent, we are charging from the tenant not only rent for the property but also rent for some other asset. Here you will check whether the house and the asset are separable or not. Separable does not mean separate rent. Separable means, is it possible to give house on rent to one person and the other asset on rent to another person? If it is possible to give like that, then the house alone will come under IFHP head, other asset will go under IFOS head. Okay, but what if it is not possible to give like this to separate person, guys? Like for example, what if I'm giving one auditorium on rent to you? Now I'm not only giving to you the property, I'm also giving to you the music system, the lighting system, the furniture, everything is going along with the property, guys. So I'm not only giving you the property, I'm also giving you other assets also, like light system, music system, the furniture, the stage and all of that. So in this case, the asset and the house, they are not separable. You tell me, is it possible for me to give the light system alone on rent to one person and the auditorium alone on rent to another person? Not possible, no. So here you will say that the property, the house property, the auditorium and the other assets are not separable. If they are not separable, guys, the entire rent will come under IFOS head. Easy. So if the house property and the asset are separable, then the house rent alone will come to IFHP head, other asset rent will go to IFOS head. But if they are not separable, then the entire rent will go into the IFOS head. Alright, everybody is clear, no tension, no doubt, right? Entire rent will go into the IFOS head if they are not separable. Separable does not mean separate rent. Separable means, is it possible to give house property on rent to one person and other asset on rent to another person? If it is possible, then it becomes separable. If it is not possible to give to different people, then it becomes inseparable. If inseparable, then entire rent will come to IFOS head. Okay, guys, then with this we're done with the major learning part of IFHP head. In IFHP you have to also remember the default regime point. This I already told you. If assessee follows default regime, let-out property, no change. Self-occupied property, interest you will not get deduction. Okay, this you are already aware of. We've spoken about this multiple times. Now let's talk about this. Okay, this part, basically the loss from house property part. It's actually set off in carry forward chapter. I'll finish it for you now itself. See, we'll go step by step. No tension, no hurry. Normal regime. Okay, in the normal regime, self-occupied property, interest deduction will you allow? Yes, interest will be allowed. So self-occupied property, my final answer will either be negative, guys, or it will be 0. But it can't be a positive number. Okay. Then let-out property, normal regime, default regime. In both the regimes, let-out property will remain the same only. A normal, usual computation you will do over here. You can either have a positive number, you can have an income number, or you can have a negative number, or it can be 0. Everything is possible in let-out property. Anyways, this is not even a part of my discussion right now. My whole discussion is self-occupied property only, because you know very well, let-out property, there is no change. Just because of the change of regime, in let-out property there will be no change. Okay, let's talk about self-occupied property only. Now in normal regime, let's say I'm having loss from house property. That loss will either be from self-occupied property, guys, or it will be from let-out property. It can be from either of them. Now that loss you can do intra-head also, which means if I'm having loss from house property and if I'm having income from house property, I can adjust. So intra-head I can do, inter-head also I can do, which means I can adjust loss against other heads, but maximum only 2 lakhs I can do in inter-head. I can also carry forward to the next year, maximum 8 years I can carry forward. I can also bring forward from the last year. So normal regime, in self-occupied property I can adjust interest. In self-occupied property my answer will either be 0 or it will be negative. Let out property, it will be 0 or it will be negative or it will be positive. It can be anything. If I'm having loss from house property in the normal regime, it will either be from self-occupied property or it will be from let out property. That loss, I can do everything. I can do intra-head. I can do inter-head, but maximum 2 lakhs. I can carry forward. I can bring forward. I can do everything. Okay. But under the default regime, self-occupied property, my answer will always be 0 only. Let out property, as usual, in default regime, I can have a positive number, negative number, or 0, I can have anything. So in default regime, if I'm having loss from house property, do you agree? It can't be self-occupied loss. It has to be let out loss only, guys. Because self-occupied answer will be 0 only in default regime. So in default regime, by chance I have loss from house property, it has to be from let out property only. Okay. That loss, guys, you can do only intra-head. You can't do inter-head. You can't carry forward. You can't bring forward, you can't do anything. Default regime is too restrictive with respect to loss from house property. In the default regime, loss from house property, you can only do intra-head. You can't do inter-head, you can't carry forward, you can't bring forward, you can't do anything else. You can only do intra-head. And also don't forget that loss has to be let out loss only, because in default regime, self-occupied will always be 0. So if at all you have a loss from house property in the default regime, it has to be loss from let out property only. So in the normal regime, if you see, this loss from house property can either be from let out property or it can be from self-occupied property. But in the default regime, this loss has to be from let out property only. In normal regime, this loss from house property, you can do everything. Intra-head, inter-head, carry forward, bring forward, you can do everything. But in default regime, you can do only one thing, and that is you can only do intra-head of the loss. Got it, guys? That's it. So this was your entire discussion on the IFHP chapter. So I think we did a very good discussion over here. We spoke about the charging section, section 22. Then we discussed about the deemed owner concept. Then we discussed about the whole computation format. Interest was a nice big discussion we had. Then we spoke about the heads of income, remember? Then we discussed about co-ownership. We spoke about this. This was very interesting. 2 lakh. Total interest also you will restrict to 2 lakhs. 2 lakhs and 30,000. Total interest also you will restrict to 2 lakhs. 30,000. Total interest also you will restrict to 30,000. Then we spoke about municipal taxes, the let out property calculation, then unrealized rent, recovered, composite rent, and then finally we spoke about the default regime. Okay. Now we'll close our second head of income and we'll start with our third head of income, which is PGBP. But before we start this head of income, listen to me for 1 minute. You will promise yourself that you're not going to start this head with tension, with worry, with whatever preconceived notions you already have. No. You will start this head of income with me with a nice fresh perspective, thinking that till here everything we were able to revise so well, we were able to grasp so well, so even PGBP we will be able to handle. Okay. Don't look at it like one big chapter. Instead what we will do is we will break this down into small parts, and that's how we will ace this chapter. Okay, guys. So nothing to worry, no tension. We'll do it together. With me, we'll do it together, okay? Come on. My very first point, in our first head of income, salaries, my charging section was section 15, and in salaries head, who was my assessee, guys? Assessee was the employee. Then in my second head of income, my IFHP head of income, my charging section was section 22, and there my assessee was the owner of the property, the person who owned the house property. Okay. Now comes my third head of income, PGBP. Here the charging section is section 28, and here your assessee is the employer, the person who is running the business. He is running his profession. He is the employer. Okay. Now, so this is the very first point. The charging section is section 28. Now, the question arises that if I'm having an illegal business, like let's say I'm running a smuggling business, so even income from that illegal business, will that also be taxed under the PGBP head? Yes, guys. The business can be legal business or illegal business. It doesn't matter. Both businesses, whatever kind of a business, whatever kind of a profession I'm having, income from business, income from profession will come into my PGBP head. Okay. Then comes my next point. This is important. Okay. Section 28 clause 4. I am saying it is important not because they ask it very often in the exam. I am saying it is important because it is not a tested area in the exam. It is not tested till now. So be a little extra careful. So here what happens is, straight away I'll give you one example, alright. So you know there's something called as ORS, oral rehydration salt. The doctor prescribes this to you whenever you go through dehydration. Now there were some companies, they had brought in tetra packs like fruity, okay, and they had called it as ORSL. So many parents were getting misled into thinking that ORSL and ORS were actually the same, but actually they were not the same, okay. ORSL was nothing but sugary drinks. So therefore what happened is, there was a particular lawyer who fought a case against against these brands in the court, and he won the case, and the courts passed an order saying that these ORSLs have to be withdrawn from the market. Now the lawyer fought the case in the court and won the case. Now, a lot of parents in the country who are not even connected to this lawyer, these parents sent a lot of gifts to this lawyer to thank him that, thanks to you we were saved from this entire mess. So the parents sent a lot of gifts to this particular lawyer. Now think from the lawyer's point of view, guys. Did the lawyer do anything extraordinary? No, guys, it is his day-to-day work to go and fight cases in the court, and that's what he has done. So he has done something in his usual course of business, and parents, they obligated to send gifts to the lawyer? They are not obligated to send gifts. They're sending voluntarily, and it is all connected to the lawyer's profession. So whatever gifts he has so received, this will be taxed for him under the PGBP head for the lawyer under 28 clause 4. Understanding? Always remember, if I'm an employee and if I'm getting a gift from an employer, then that gift will be taxed for me under the salaries head. Similarly, if I'm getting any benefits, any perquisites, or any voluntary payments, any gifts basically if I'm getting relating to my business or profession, it will be taxed for me under the PGBP head. See, these gifts are provided by persons who don't have any obligation to pay me anything. The parents are under no obligation to give anything to the lawyer. It was a voluntary transaction. It is received by the assessee, it is received by the lawyer in the ordinary course of his business. Did the lawyer do something out of the ordinary, guys? No, he did something which is a part of his day-to-day profession. So he has done something in the ordinary course of business or profession. So whatever is the value of these gifts, that value of these benefits that he got, this will be taxed for him under 28 clause 4. Multiple examples I can give you like this. Like for example, let's take one more example, okay? A more practical example, a more common example. Let's say ITC and one stationery shopkeeper. Now ITC is the one that manufactures your classmate notebooks, guys. So ITC is telling stationery shopkeeper that, hey, listen, you have to sell 1,000 classmate notebooks in a particular month. If you sell 1,000 classmate notebooks in a particular month, then I will give you one gold coin. Okay. Now the stationery shopkeeper, he met the target, guys. He sold 1,000 classmate notebooks in that particular month. So ITC gave this shopkeeper one gold coin. Now again, same thing, don't you think, guys? This gold coin is a benefit for the stationery shopkeeper. Did the stationery shopkeeper do something out of the ordinary? No, day-to-day business to sell notebooks. That's what the stationery shopkeeper has done over here. So as a part of his day-to-day business, he got this gold coin from ITC. Again, the value of this gold coin will be taxed for the stationery shopkeeper under 28 clause 4. Understanding? Any benefits, any perquisites you get as a part of your day-to-day business or profession will be taxed for you under PGBP under this 28 clause 4. Okay, guys, so my first point, PGBP charging section 28, assessee is the employer. Even illegal businesses, income will be taxed under the PGBP head. Then in case you get any benefits, any perquisites, any gifts relating to your day-to-day business or profession, even that will be taxed for you under the PGBP head. Okay, guys, then listen, two extra points. Why am I calling them as extra points? They are those two concepts, guys, which we will see in multiple places in our PGBP chapter. So I'm telling about them to you now itself. My extra point number 1, specified mode. See, there are two modes of payment, okay? One is non-cash mode and the other is specified mode. I'm not talking about non-cash mode. Non-cash is simple, guys. Any mode which is not cash is non-cash mode. But I'm talking about specified mode. Specified mode means 4 things: account payee check, account payee bank draft, ECS, and any other electronic payment like UPI, credit card, debit card, and all that. So specified modes, 4 specified modes we have account payee check, then we have account payee bank draft, then ECS, and any other electronic payment. Now what about UPI, NEFT, RTGS? All this will come under electronic payments. So all this will also become specified mode. What about cross-check? See, is cross-check an account payee check? No. Account payee bank draft? No. ECS? No. Electronic payment? No. So cross-check, no doubt, it is a non-cash mode, but it is not specified mode. Small point, tiny point, be careful. Okay, guys, this was one extra point. Then comes one more extra point, section 139(1) due date. Actually, it's a return of income concept, but I'm covering it for you now itself because in multiple places in this chapter, we will require 139(1) date. 139(1) date is nothing but the due date for you to file your income tax return. There are totally 3 139(1) dates. Number 1, we have 30th November, then we have 31st October, and then we have 31st July. And I've always told you, whenever you're identifying the 139.1 date, always go in the reverse order. First, try 30th November 2026. 30th November 2026 is only for those assessees who have specified domestic or international transactions, that is transfer pricing assessees. If 30th November is not applicable, then only you will come to 31st October. Remember guys, the sequence of thinking. 31st October 2026 will apply only for 3 assessees. Number 1 for all company assessees, number 2 for all audit assessees, number 3 if your assessee is a partnership firm or LLP for which audit is applicable, then for that partnership firm or LLP, because audit assessee date will be 31st October. Now that partnership firm, that LLP firm's partners, even for them the 139.1 date will be 31st October. Are you understanding? See, listen to me, okay? If my assessee is a partnership firm or LLP to which audit is applicable, then this entity is becoming audit assessee. Because audit assessee, it is getting fitted under the second point. So therefore 139.1 date will be 31st October. Now this firm's partners, whether active partner, whether sleeping partner, doesn't matter. Whatever be the partner of this entity, for that partner also the 139.1 date will be 31st October. Okay guys, and for all other assessees, that is, if 30th November is also not applicable for you, 31st October is also not applicable for you, all other assessees 31st July. Simple guys. So 3 139.1 dates. Okay. Then comes my next point. How exactly do you compute PGBP? I've taught you 2 methods of computing PGBP, direct method and indirect method. Direct method is an easier method. Here we have only 2 steps. We do the direct method only if in the question the net profit number is not given to us. If net profit number is not available for us and if we have to find PGBP, then we do the direct method, that is 2 steps. And these 2 steps are nothing but I will take all my taxable business incomes and from this I will subtract my allowable business expenses and I will get my PGBP number. Come on guys, basic accounting. From my incomes, I'll subtract expenses and I'll get my PGBP number. Okay, this is my direct method, 2 steps. This I will apply only if net profit number is not available for me in the question. But however, if the net profit number is given to me in the question, then I will apply the indirect method, that is 5 steps. Here, I will start with the net profit number that is given to me. Then I will add all those expenses which are debited, but they are not allowed. In simple words, guys, these are those expenses which should not have been debited, but you've debited them. That means these are your wrong debits. So how will you reverse a wrong debit, guys? By crediting it. Crediting it means what? You will add it back. That's all. So you will add back all those expenses which you debited but you should not have debited. All those expenses which you debited but they are not allowed. Okay. So you will reverse it by adding it back. Then you will add all those incomes which are not credited but they're taxable. In simple words, all those incomes which are actually taxable but you forgot to credit them. Okay. Now credit them. Now credit means what? Now add them. So you will add those incomes. Okay. So first point, you will add all those expenses which you wrongly debited. You will reverse a debit by adding them back. Then you will add all those incomes which you forgot to credit. So you will now credit. Now credit means you will now add it back. Okay. Then you will subtract all those expenses which you forgot to debit. So because you forgot to debit, you will now debit. Debit means what? You will now subtract. Okay. So you will subtract expenses which were not debited. Then you will subtract the wrong credits. Wrong credits means what? As an income, it is credited to the P&L, but it is not taxable. Like for example, agricultural income you earned. It is not a taxable income, but you credit it in the P&L. So how, in simple words, it's a wrong credit, guys. So how will you reverse a wrong credit? By debiting it. Debiting means what? You will subtract it. Simple, right? So you will take your net profit number. To the net profit number, you will add back all those expenses which you wrongly debited. So you will reverse your wrong debits. Then you will add all those incomes which you forgot to credit. Then you will subtract all those expenses which you forgot to debit, and you will subtract all those incomes which you wrongly credited. And that's how you will get your PGBP number. Basically what we do, the 5 steps, the indirect method. Okay guys. So this is how you compute PGBP. Now computation of PGBP, not necessarily that you have to do it in this method only. This, if you have, studied DT from me, then you would have very quickly grasped what I just said. But in case you have not studied DT from me, then don't worry. Your respective faculty would have taught you a different method to compute PGBP. You can follow that. This is just my method wherein I check whether net profit is given to me or not given to me. If it is given to me, then I follow the indirect method, the 5 steps. If it is not given to me, then I follow the direct method, that is 2 steps. Okay guys. Now this is where we are starting our main PGBP chapter. This is where we will start all the adjustments one by one, guys. First of all, I'm starting with depreciation section 32. 2. The biggest adjustment, the most important adjustment, the most valuable adjustment of our PGBP chapter. Once we are done with the depreciation chapter, it will be as if we are done with 1/3 of the chapter already. That's how huge this adjustment is. But with a patient mind, with an urge to learn, with a wish to learn, with a want to learn, with a desire to learn, let's enter into this concept. Okay guys, depreciation, we have two discussions, WDV method and SLM method. SLM we'll take later. Our whole focus first will be on the WDV method only. Okay guys, now depreciation, if you want to claim, before that 3 conditions you have to fulfill. Condition number 1, you have to be the owner of the asset. Condition number 2, asset has to be eligible for depreciation. And condition number 3, you must be using the asset for your business or profession. So 3 conditions. Condition number 1, I must be the owner of the asset. Condition number 2, the asset has to be eligible for depreciation. And condition number 3, you must be using the asset for your business or profession. Only if all these 3 conditions are fulfilled, only then you will claim depreciation. These conditions, we'll keep talking about them as we go through our discussion. Now, first of all, our first main discussion, hire purchase and installment purchase. See, in hire purchase, what happens is, only when I make the payment of the last installment, only then I will become the owner of the asset, guys. But in installment purchase, for example, let's say you decided to go to Chroma and you decided to buy a mobile phone from Chroma on installment basis. So as soon as you purchase the mobile phone from Chroma, you will immediately become the owner. You still have to pay the EMIs. Even though you have not paid the installments fully, you are still the owner. So in hire purchase, first of all, you understood the difference, right? In hire purchase, you will become the owner only when you pay the last installment. So if you don't pay any installment in between, the seller can take away the asset back from you. But in installment purchase, as soon as you make the purchase, even though installments are still pending, even though EMIs are still pending, you will immediately become the owner. Okay guys, now listen carefully. In hire purchase, even though you are not the owner right now, even though you have not paid the last installment right now, even though you are not the owner right now, you can still claim depreciation. But the question that arises is that you will claim depreciation on which amount? See, you're going to be paying installments. You are the buyer, right? You're going to be paying installments. Each installment will have principal component also, interest component also. In hire purchase, whatever is a principal component, that will get capitalized. On that principal component, you can claim depreciation. Then what about the interest component? Nothing, guys. Interest component will become your expense. You will debit it in the P&L. You will allow it in PGBP computation. Easy. So in hire purchase, point number 1, you will become the owner only when you pay the last installment. But right now, even though you have not paid the last installment, even though you are not the owner right now, you can claim depreciation. But you will claim depreciation on which amount? On only the principal component. Then what about the interest component? Interest component will be debited to the P&L. It will be allowed in PGBP. Easy. Now comes the installment purchase discussion. Over here, as soon as you purchase the asset, you've become the owner. So of course you can claim depreciation. Now you will claim depreciation on what amount? Even over here, even in installment purchase, you will be paying installments. Each installment will have interest component also, principal component also. So here the total amount, the interest component also, the principal component also, the entire amount will get capitalized. On the entire amount you will claim depreciation. Okay guys, so here in installment purchase, the interest component you will not debit it to P&L. You will not allow it in PGBP. Instead, on the entire amount you will claim depreciation. Okay, so very simple. In hire purchase, you will claim depreciation only on the principal component. In installment purchase, IP, you will claim depreciation on interest plus principal. IP. You're able to see what I am seeing, right? So in hire purchase, only on the principal component, but in installment purchase, on the interest and principal component, on this entire amount, you will claim depreciation. Okay, this was a very, very important discussion. Now listen, in our conditions, we had learned that the asset has to be eligible for depreciation. Now, what are these eligible assets, guys? We have totally 4 categories of eligible assets. Number 1, building. Number 2, furniture and fixtures. Number 3, plant and machinery. And number 4, intangible assets. Okay, so only 4 eligible assets we have. Every asset has to fit under these 4: building, furniture and fixtures, plant and machinery, intangible assets. And you know very well, in Income Tax Act, plant and machinery is like etc. Like anything which doesn't fit under building, furniture and fixtures and intangible assets, everything else comes under plant and machinery. Like books, plant and machinery; car, plant and machinery; computer, plant and machinery; air conditioner, plant and machinery. So plant and machinery is like etc. It's like the dumping ground. If anything doesn't come under any of the others, if any asset doesn't come under any of the other categories, then you'll dump it under plant and machinery. Okay guys, so this is your next point about eligible assets. Then we had learned that one of the conditions was the asset has to be used by the assessee for his business or profession. Now see, that is our next discussion. Use is of two types, active use and passive use. See, you must be using the asset for your business or profession, which means if I'm using an AC at my house, then I cannot claim depreciation on it. But that same AC, if I'm using in my office, then I can claim depreciation on it. Now the use for my business or profession can be active use or passive use. Active use means I'm actually using the asset. Like for example, I'm actively using this mic right now. But however, passive use means what? Passive use means, like for example, I have one more mic over here. Now this mic is not in active use right now. It is ready for use. As soon as this particular mic, the battery goes off, I will immediately start using this spare mic then. So this is ready for use. This is already charged and it is ready for use. So this becomes in passive use. But this particular mic which I am right now using, this becomes my mic in active use. So use can be active use or it can be passive use. Passive use is nothing but it is ready for use. Okay, so use includes both. Alright, now some more examples of passive use. Fire extinguisher, the classic example. Let's say I have a fire extinguisher. It is not actively in use right now. Right now it's only in passive use. It's only ready for use. Only when there is a fire, that time only it will be actually used, guys. So right now the fire extinguisher is in passive use. Similarly, let's say I bought some spare parts, okay, and they are right now not in active use. Right now they are only in passive use. Only when I replace the spare parts, only when I actually use them, only then they will be in active use. So right now they are in passive use. Similarly, let's say I bought a car in April month and I'm using that car only on alternate days. Let's say Monday, Wednesday, Friday only I'm using the car. So the remaining days, Tuesday, Thursday and Saturday, the car is under passive use. It is ready for use. It's under passive use. Only Monday, Wednesday and Friday I'm actively using the car. So, doesn't matter whether the use is active use or passive use, both will be eligible for depreciation. Understanding, guys? So, my point number one under depreciation, three conditions have to be fulfilled. Assessee has to be the owner of the asset has to be eligible for depreciation, and the asset has to be used by the assessee for his business or profession. Only if all three conditions are fulfilled, only then assessee can claim depreciation on the asset. Then came a second concept, hire purchase and installment purchase. In hire purchase, I will claim depreciation only on the principal component. In installment purchase, I will claim depreciation on both the interest and the principal component. Then we learned that there are four categories of eligible assets for depreciation: building, furniture and fixtures, plant and machinery, and intangible assets. But please remember, guys, goodwill is not eligible for depreciation. Earlier, even on goodwill, we did claim depreciation, but on or after 1st April 2020, that is 1st April 2020 onwards, goodwill is ineligible for depreciation. Okay, then we learned about use. The asset has to be used for business or profession, only then I will get depreciation. That use can either be active use or it can be passive use, doesn't matter. Whether active use, whether passive use, both will be eligible for depreciation. Okay guys, now comes a very important part from the computation point of view. See, in the year in which I acquired the asset, in that year I will see how many days I put the asset to use for. Are you listening to me? In the year of acquisition, I will check how many days did I put the asset to use for. In the year of acquisition, if I use the asset for at least 180 days, then I will get full year's depreciation, guys. But in the year of acquisition, if I put the asset to use for less than 180 days, then I will get only half year's depreciation. In the year of acquisition, if I did not even put the asset to use, then I will get no depreciation. Which means, are you understanding, in the year of acquisition, there are three possibilities, guys. Either I will get full year's depreciation, or I will get half year's depreciation, or I will get no depreciation. See, in accounts, okay, in accounting, if I put the asset to use for 9 months, you will give me only 9 months depreciation, right? In income tax, it's not like that. Either I will get full year's depreciation, or I will get half year's depreciation, or I will get no depreciation. There's no other possibility at all. There's no proportionate calculation and all over here in income tax. So I will simply see in the year of acquisition exactly how many days did I use the asset for. If I use the asset for at least 180 days, I will get full year's depreciation. If I use the asset for less than 180 days, I will get half year's depreciation. And if I did not even use the asset, I will get no depreciation. Guys, be careful, don't get confused. In residential status, we had 182 days. In depreciation, we are having 180 days. So don't get confused, it is not the same. Okay, but please notice very carefully, this 180 days checking and all you will do only in the year of acquisition. In subsequent years and all, I don't care about 180 days. In subsequent year, even if I use the asset for 1 day, I will still get full year's depreciation. One simple example I will give you, properly you will understand without any confusion. Listen to my example. Let's say I acquired the asset. On the 1st of May 2023, okay? And I put the asset to use on the 1st of October, or let's say on the 1st of November 2025. This is when I put the asset to use. Now, what is a year of acquisition, guys? My previous year of acquisition is 23-24. Now, in 23-24, in the year of acquisition, there are three possibilities. If I have put the asset to use for at least 180 days, then I will get full year's depreciation. If I have put the asset to use for less than 180 days, I will get half year's depreciation. If I have not even put the asset to use, then I will get no depreciation. So in this example, if you see, in the year of acquisition, I have not even put the asset to use. I am putting the asset to use only in 25-26. So therefore, in the year of acquisition, I will get no depreciation, guys. So in 23-24, no depreciation. Then in 24-25 also there will be no depreciation. See, 24-25 becomes subsequent year. Now in subsequent year, I don't care about 180 days. I will just see, did I put the asset to use for minimum 1 day? No, guys, I did not even put the asset to use at all in 24-25. So in 24-25 also zero depreciation only. Are you noticing, in subsequent to 24-25, I'm not even talking about 180 days. I'm only checking, did I minimum put the asset to use for 1 day at least? No, I did not even put the asset to use. Go, no depreciation. Then comes the next subsequent year. The next subsequent year is 25-26. Again, because it is subsequent year, I will not look at 180 days and all. In 25-26, minimum 1 day did I put the asset to use. Yes, guys, I put the asset to use on 1st November 25. Minimum 1 day I put the asset to use. Therefore, in 25-26, the full year's depreciation I will get. You're understanding? So in 25-26, actually if you see, I put the asset to use for less than 180 days only, but it doesn't matter. 180 days is a criteria which we check only and only in the year of acquisition. Now are you clear, guys? In the year of acquisition only you check 180 days. If it is subsequent year, then I will check, did I put the asset to use for minimum 1 day? Even 1 day if I put the asset to use, that's all. I will get the full year's depreciation. Easy, guys. So this was our entire discussion about the 180 days point. Alright, now coming to my next discussion. In income tax, right now are we learning depreciation in WDV method or SLM method? Remember, right now our whole focus is on WDV. SLM we will study separately. Now when it comes to WDV, we have this concept called block method, guys. In block method, what happens is, all the assets which belong to one particular category and they also have the same depreciation rate, we put them into a block. In simple words, in income tax, we don't compute depreciation for each asset separately. No. Instead, what we do is we combine assets together into a block. Then once the asset enters into the block, you forget about its individual existence. Now all calculations you do for the block as a whole, guys. You don't do calculations for each asset separately. No. Instead, you do all calculations for the block as a whole. Now a question arises that which asset will fall under which block? See, guys, we have only 4 categories of assets. We have plant and machinery, furniture and fixtures, building and intangible assets. Only 4 categories of assets we have. So all the assets which belong to the same category and also have the same depreciation rate will fall under one block. So there are 2 conditions. They must belong to the same category and they must also have the same depreciation rate. Like for example, let's say I have plant and machinery 15%. I also have plant and machinery 40%, guys. Now will both of these fall under the same block? No, even though they belong to the same category, they are different depreciation rates. So they will fall under separate block. Now let's say I also have some building which is 40%. So tell me now, this plant and machinery 40% and this building 40%, can I put them into one block? No, guys, because you're 2 different categories. You're understanding? They have to be the same category and also the same depreciation rate. Only then you can put them into one block. In my example over here, even though the first 2 are the same category, but because you are having 2 different depreciation rates, they will fall under separate blocks. I'll call this plant and machinery 15% as block 1, this plant and machinery 40% as block 2. Then in my second part of the example, if you see, even though my plant and machinery and building both have the same depreciation rate, still they will fall under different blocks because they are different categories. One is plant and machinery, other is building category. So my building 40% will become my block 3. Understanding? So only if the assets fall under the same category and also have the same depreciation rate, only they will form under one single block. Like for example, car comes under plant and machinery category, guys. AC comes under plant and machinery category, guys, and both are 15% depreciation. So same category plant and machinery, same 15% depreciation. This I'll put into one particular block. Getting it? So same category and also the same depreciation rate, then it falls under one single block. Now what are the depreciation rates possible? Listen very carefully, very important guys. Buildings, if it's a residential building, 5%, generally buildings 10% depreciation rate, temporary erections like wooden structure, temporary buildings 40% depreciation rate. So in buildings we have three depreciation rates, 5%, 10% and 40%. Residential buildings 5%, other buildings, general buildings 10%, and temporary erections, wooden structures and all 40%. Furniture and fittings, only one rate we have, which is 10%. Then when it comes to plant and machinery, general depreciation rate for plant and machinery is 15%. Like cars, oil wells, clinic equipment, the general rate is 15%. Then if it is ship, then 20%. Then if the plant and machinery happens to be a vehicle like motor bus or lorry or taxi, which is used by the assessee in the business of running them on hire. Basically, assessee's business is giving vehicles on hire. So now whatever vehicles he has, whichever he gives on hire, on that 30% depreciation rate will apply. First three clear guys? General depreciation rate 15%, ships 20%, vehicles in the business of giving them on hire 30%. Then molds used in rubber and plastic factory 30%, aeroplanes 40%, air water pollution control equipment, solid waste control equipment, solid waste recycling and resource recovery system, energy saving devices, then your life saving medical equipment, all this will come under 40% depreciation. Okay, then you have computer software, printer, scanner, UPS, books, all of these will come under 40% depreciation. Be careful whether the books are annual publications or whether they are not annual publications, it doesn't matter, all books will come under 40%. Then windmills 40%, electric vehicles also 40%. Crystal clear till here? Plant and machinery generally 15%, plant and machinery ships 20%, vehicles in the business of giving them on hire 30%, then molds and all 30%, aeroplanes 40%, air pollution control equipment 40%, life-saving medical equipment 40%. See, be careful, if it is clinic equipment, normal 15% only, but if it is life-saving medical equipment, then 40%. Okay, energy saving devices is also important, this is also 40%. Then plant and machinery like computer software, printer, scanner, UPS, books and all 40%, windmills also 40%, and electric vehicles 40%. Okay, so you have all of these under the plant and machinery category. Then intangible assets, you know very well, goodwill is not depreciable. Other intangible assets 25% depreciation. Simple, straightforward guys. Now listen to me, moving on. See, this is a very interesting flowchart. Okay, in case my assessee has purchased a car for business or profession, on that car he will claim 15% depreciation guys. But that same car, if it was acquired and put to use by the assessee in this period of 23rd August 2019 to 31st March 2020, then in that case depreciation will become double, it will become 30%. Are you understanding? So generally for car, depreciation rate is 15% only. Only if the car is acquired and put to use in this period, only then for that car depreciation rate will become 30%. Now some of you will think, ma'am, we are in 2025, old provision, why should we remember? Listen to me. What if today your assessee has a car which was purchased by the assessee long back in this period? For that cars, even today 30% depreciation rate will apply, no? So therefore this point is still relevant guys. To what if in 2025 now you have a car which was purchased in this period? For that car, even now depreciation rate is 30%. So understand correctly, I am not saying that only in this period depreciation rate is 30%. I am not saying like that. I am saying if the car is acquired and put to use in this period, for that particular car, forever depreciation rate will be 30%. Okay guys, so hence this provision is still relevant for us. Okay, so this is for car. Now similarly, what if I'm in the business of giving vehicles on hire? Then for all vehicles the depreciation rate is actually 30%. But same thing if the vehicles were acquired and put to use in the same period, 23rd August 2019 to 31st March 2020, then the depreciation rate will become 45%. Okay guys, same thing only. So for car, 15% will become 30%, and all vehicles, if assessee is in the business of giving vehicles on hire, then for all vehicles 30% will become 45%. Alright, now listen. So until now in a depreciation discussion, we first spoke about the three conditions guys. Then we spoke about hire purchase and installment purchase. Then we spoke about the four categories of eligible assets. Then we discussed about active use and passive use. We said use includes both, just that the asset should be used for the purpose of business or profession. Then we spoke about 180 days, remember? In the year of acquisition, I will check 180 days criteria. Subsequent years, even if I put the asset to use for 1 day, I will get full year's depreciation. Then we learned about the block method. We said all the assets which belong to the same category and also have the same depreciation rate, we will put them into one single block. Then we saw all the depreciation rates. Now listen to me guys. How exactly do you compute depreciation? This is your format for computation of depreciation. You start with opening WDV in the beginning of the year. Then you add actual cost of assets acquired. Please notice guys, is it actual cost of assets put to use? No, it is actual cost of assets acquired, which means if you have acquired an asset during the year, it will enter into the block. Even if you don't put the asset to use, it will enter into the block. It is actual cost of assets acquired. It is not actual cost of assets put to use. It is actual cost of assets acquired. Listen to me very carefully. I acquired the asset, okay? And let's say I did not put the asset to use. I acquired the asset, but I did not put the asset to use. And one more asset I acquired during the year, and I also put it to use. Now my question number 1, will this asset enter into the block? See, as soon as you acquire the asset, yes, it will enter into the block. Will you get depreciation on the asset? Only when you put the asset to use, you will get depreciation. If you don't put the asset to use, right now you will not get depreciation. So what this teaches you is that as soon as you acquire an asset, whether you put it to use or not, I don't care, it will enter into the block. But in case you don't put the asset to use, okay, you will not get depreciation, but it will still enter into the block because it is actual cost of assets acquired, not actual cost of assets put to use. It's actual cost of assets acquired. So as soon as you acquire an asset, even if you don't put the asset to use, it will enter into the block. If you don't put the asset to use, okay, fine, don't give me depreciation, but it will still enter into the block. Okay guys, so opening WDV in the beginning of the year, add actual cost of assets acquired. Now whenever you add assets over here, always remember to check for 2 things. Remember, we've made one rule over here. You will check for 2 things. Number 1, was it put into use for at least 180 days in the year of acquisition or not? And number 2, will I get additional depreciation or not? Check these 2 things at this stage itself. Then you will subtract monies receivable for assets sold. Basically, if you sold any asset during the year, then whatever is your selling price of the asset, you will subtract it over here, and that's how you will get the closing WDV at the end of the year. Now this closing WDV has to split into 3 things guys. Number 1, WDV which is put to use for 0 days, then WDV which is put to use for less than 180 days, and balance WDV. Now see, the first 2 numbers, that is WDV put to use for 0 days and WDV put to use for less than 180 days, both of these you will get to know from the second step. That is, in case you have acquired any asset during the year which is not put to use at all, it will fit into my first bucket. If you have acquired any asset during the year which you have put to use for less than 180 days, it will come under the second bucket, and your balance WDV will fit under the third bucket. Okay. If you have acquired assets during the year and if you have not put them to use at all, then you will get no depreciation. If you have acquired assets during the year and if you have put them to use for less than 180 days, then you will get only half the year's depreciation. Balance WDV, you will get full year's depreciation. So these 3 depreciation numbers put together will become your total depreciation. So closing WDV minus depreciation will give you the opening WDV for the next year. You're understanding, right? See, till here, till the closing WDV, till here you understood without any tension. Yes, opening WDV in the beginning of the year, I will add actual cost of assets acquired, then I will subtract monies receivable for assets sold, and I'll get closing WDV. Then I will come to my, then this closing WDV number is there. No, this number I will split into 3 parts. Okay, my first part will be out of the new assets acquired, how much assets I have not even put to use, 0 days. Okay, then out of the assets which I have acquired, how many assets I have put to use for less than 180 days. So my first 2 points, my first 2 buckets I will get from my second step, from my add actual cost of assets acquired step. So out of the assets which I have purchased during the year, how many I have put to use for 0 days, how many I have put to use for less than 180 days. If I have put them to use for 0 days, then I will get no depreciation guys, and if I put them to use for less than 180 days, then I will get only half year's depreciation. Then whatever is a balance WDV, on that I will get full year's depreciation. Okay, now let's take one small example to help us get a little more clarity. Listen to me. Let's say my opening WDV was 100. Okay, and let's say I purchased 3 assets during the year. I purchased one asset which I put to use for 0 days, and that was, let's say, for 10 rupees. Then I purchased one more asset which I put to use for less than 180 days. Let's say that asset I purchased for 20 rupees, and I purchased one more asset, let's say, which I put to use for more than or equal to 180 days, and that asset, let's say, I purchased for 25 rupees. Okay, so 20 plus 25, 45 plus 10, 55. So 55 becomes my add actual cost of assets acquired. Point number 1, observation number 1, are you noticing even the asset which I am putting to use for 0 days, even this is entering into the block. Okay guys, then money is receivable for assets sold. Let's say I did not sell away any assets, I did not sell anything. Okay, so my closing WDV at the end of the year will be 155. Now on this 155 I have to claim depreciation. This 155 I will split into 3 parts. Number 1, what is the asset which I have put to use for 0 days? Remember, again and again I'm telling you, the first closing WDV will be split into 3 buckets, but out of the 3 buckets, the first 2 buckets you will get the number from your add actual cost of assets acquired step. So out of this number, out of this 55, how much was put to use for 0 days? Only 10. On this 10 you will get no depreciation. Then out of this 55, how much was put to use for less than 180 days? 20. On this 20 you will get only half year's depreciation. Now what's your balance WDV? So your total WDV is 155. You have already put 10 in the first bucket. You've already put 20 in the second bucket. So your balance WDV will now be 125. On that 125 you will get full year's depreciation. Now did you understand guys? So my closing WDV will be split into 3 buckets. Out of the 3 buckets, my first 2 buckets I will get the numbers from my add actual cost of assets acquired step. So be careful. Alright. Now sometimes I'll tell you what will happen, okay. Sometimes we will have monies receivable for assets sold. Like we might have a number over here. We are subtracting it over here. Because of that, there's a possibility that this number, for example, is only 5 rupees. For example. Then what will you do? Let's say you subtracted something over here. Let's say you subtracted 150. Let's say money is receivable for assets sold is 150. Now your closing WDV is only 5 rupees. Now closing WDV has to split into how many parts? It has to be split into 3 parts. My first part is my first part and second part I will get the numbers from add actual cost of assets acquired step. Are you listening? So now the whole question is, will I split this 5 in these 3 parts proportionate basis? Nothing guys, don't do over drama over here. You have to follow a sequence. Point number 1, in your add actual cost of assets acquired, do you have any asset put into use for 0 days? Yes, I have 10. So I'll write 10 over here. Then I will see, oh, I can't write 10 over here. WDV itself is 5 only. WDV is insufficient. So WDV is 5. How can I write 10 over here? So therefore, I will just simply write 5 over here. Now, do I still have any WDV left for less than 180 days? In reality, I do have less than 180 days of 20 rupees. But I'm not having any WDV left, guys. See, this WDV only has to be split into these 3 parts, right? But my WDV is only 5 and I have to follow a sequence. First 0 days, then less than 180 days, then balance. I have to follow a sequence. So therefore, 0 days I actually have 10 rupees, but I can't write 10 rupees over here because WDV only 5 I'm left with. So whatever I'm left with, I'll write over here. So my entire WDV becomes 0 days. So therefore no depreciation. Do I have any WDV left for less than 180 days? Actually less than 180 days we do have an asset for 20 rupees, but I don't have any WDV left, guys. So 0. Then what about my balance WDV? See, my total WDV is 5. Minus 0 days 5, minus less than 180 days 0. So my total balance WDV will be 0 only. Getting it? Now on the WDV which is put to use for 0 days, that is on this 5 rupees, there will be no depreciation, guys. So 0 depreciation. On the WDV which is put to use for less than 180 days, I'll have only half year's depreciation. But this WDV is 0. 0 into half year's depreciation will be 0 only. On the balance WDV, I will get full year's depreciation. But balance WDV is 0. So 0 into full year's depreciation will be 0 only. So my total depreciation over here will be 0 and my opening WDV for the next year will be 5. So the whole point that I'm trying to communicate to you through this example is that please follow a sequence. You have to first fill 0 days, then you have to fill less than 180 days and then you have to fill balance. Follow the sequence, please. Alright everybody, and also don't forget the first 2 buckets of your WDV you will take from your add actual cost of assets acquired step. Okay, so this was your first discussion about how do you compute depreciation using the block method. Now listen to my next point. All this I've already told you about. Come to my next point about add actual cost of assets acquired. Interesting point. See, even if the asset is not put to use, it will still enter into the block. I already told you this. It is add actual cost of assets acquired, not put to use. So therefore, even if I don't put the asset to use, it will enter into the block. If I don't put the asset to use, okay fine, don't give me depreciation, but it will still enter into the block. Point number 1. Then point number 2. In case I purchased one asset, now I have to make payment for the asset, guys. If I'm making payment more than 10,000 rupees to one single person in one single day for one single asset, if I'm making payment of more than 10,000 rupees, I have to make the payment in specified mode only. 4 specified modes we learned, remember? Account pay check, account pay bank draft, ECS, and any other electronic payment. So like for example, let's say I purchased one plant and machinery for 45,000 rupees. Okay, now this 45,000 rupees I made payments on 2 days, on Monday and on Tuesday. On 2 days I made payment. Monday, let's say I paid 25,000, and Tuesday, let's say I paid 20,000. This 25,000 I paid in cash, guys, and this 20,000 on Tuesday I paid through account pay check. Okay, now this 25,000 is more than 10,000. I am paying in cash. I'm paying in non-specified mode. So this 25,000 will not even enter into the block. Come on, guys, if it doesn't even enter into the block, I won't even get depreciation on that 25,000. It'll be a big demotivation for me, guys. So that is why nowadays people are so particular about the mode of payment. So if you're making payment of more than 10,000 rupees, it has to be in specified mode only. Now, so therefore in my example, 25,000 more than 10,000, I made the payment in non-specified mode. Therefore this 25,000 will not enter into the block. Therefore, guys, what about the balance 20,000? That is also more than 10,000, but that I have paid by account pay check, which is a specified mode. So in my example, only 20,000 will enter into the block. We will get depreciation on this 20,000 number only. Okay, and see, guys, later when we talk about section 40A subsection 3, okay, there we will learn that in case we have to make payment to a transport operator for trucks and all, then the limit will become 35,000. When we have to pay retirement benefits, that time the limit will become 50,000. Generally the limit is 10,000, but if you are taking a vehicle on hire, let's say you have to pay for plying, hiring, leasing carriages, then the limit will not be 10,000, limit will be 35,000. Up to 35,000 pay however you want, more than 35,000 pay in specified mode. If you're paying retirement benefit, the limit will become 50,000. But guys, all this is only in 48 subsection 3. In our depreciation discussion, in our actual cost of assets acquired discussion, only one number we have, 10,000 number only. Okay, guys, we don't have 3 numbers, we have only one number here, which is a 10,000 number. That's why I've struck off 35,000 and 50,000. These two numbers you will find in 48 subsection 3, but not in our actual cost discussion. Alright everybody, can I show you one more point to help you understand the real implication of these numbers? Listen to me, okay? Let's say I purchased the asset for 45,000 rupees, okay? And this 45,000 I paid by account pay check. So full 45,000 will enter into the block. Then you know, right, whatever expenses you are incurring before you put the asset to use, all those expenses you capitalize. All those expenses also you add to the actual cost. Like for example, before you put the asset to use, whatever freight you are incurring, or before you put the asset to use, whatever interest you are incurring, even all that you put into the block itself. So before you put the asset into use, let's say you incurred some freight, guys. You incurred some freight of 30,000 rupees. Now this 30,000 rupees you paid in cash. Now the question is, what is the amount that will enter into the block? This 45,000 will definitely enter into the block, no doubt, because you've made the payment in account pay check. The whole question is about this 30,000 rupees. Very simple, okay? I'll tell you how to think. This 30,000 rupees you have incurred before you put the asset to use. So first of all, this 30,000 rupees has to be capitalized. Capitalized means what? It has to be added to actual cost. So when you're adding to actual cost, how many numbers you have? Only one number you have, and that is 10,000 number. More than 10,000 rupees you have made the payment in non-specified mode. Therefore, this 30,000 will not enter into the block. Got it, guys? In simple words, whenever you have to put any number into the block, only one limit you have, and that is a 10,000 limit. Up to 10,000, make the payment however you want. More than 10,000, if you want to put the number into the block, the payment has to be by specified mode only. Okay, guys, now the same situation, let's twist it a little bit. What if this 30,000 rupees freight was incurred by your assessee after the asset was put to use? Then in that case, there is no question of putting the money into the block, guys. So then in that case, what will happen to this 30,000 freight? It's a normal business expense. You will debit this expense to your P&L account. Now in your PGBP computation, this will become like your normal business expense. Now you will apply section 40A subsection 3. See, just like how in our actual cost discussion, I'm telling you that if the payment is more than 10,000, you have to make the payment in specified mode only. Similarly, all the expenses which are debited to P&L P&L account, for that we have 40A subsection 3. 40A subsection 3 says if something is debited to P&L account and if you're making payment of that expense more than 10,000 rupees, make the payment in specified mode only. But however, in 40A subsection 3, we also have the 35,000 number, guys. 40A subsection 3 says if you're making the payment of freight, if you're making the payment for trucks, let's say you're hiring trucks and all, for that whatever payment you're making, for that the limit is 35,000. Up to 35,000, pay however you want. More than 35,000, you have to make the payment in specified mode. Here, if you see this 30,000 freight which I incurred after putting the asset to use. Therefore, no question of capitalizing, guys. No question of putting it into the block and all. I simply debited it in the P&L account. So on this 30,000, I applied 40A subsection 3. Is it more than 35,000, guys? See here, 10,000 number will not apply. 35,000 number will apply because it is freight. So in 40A subsection 3, for freight, we have the 35,000 number. Here the amount is within 35,000. So pay whatever mode you want, doesn't matter. This 30,000 will be fully allowed. Okay, had it been 40,000, then I'll say, oh, more than 35,000, you made the payment in non-specified mode. This 40,000 I will not allow. Not allow means I will not let you debit in the P&L. If you have already debited, I will reverse a debit, I'll credit it, I'll add it back. Are you understanding? So this entire big discussion, the only reason why I'm doing this big discussion is to tell you that, listen to me, I'll tell you the summary now. One big kachara we created over here, I'll give you one proper summary. See, listen to me. Two things I'm comparing. Add actual cost of assets acquired, that will enter into the block, and other expenses which are debited to your P&L account. I'm comparing these two numbers, okay? So if you have purchased some asset, if it's a general payment, you've purchased some asset and you're making payment. For that, the limit is 10,000 rupees, guys. If you're making the payment more than 10,000 rupees, then only you have to make the payment in specified mode. Similarly, general expense you have incurred, which is debited to P&L, even here the limit is 10,000 rupees. If you make the payment of more than 10,000 rupees, then you have to make the payment in specified mode. Then what about freight? First of all, when will freight even come under the block calculation? Freight will come under the block calculation only if you have incurred the freight before you put the asset to use. If you incur that same freight after you put the asset to use, then it will become an expense which you will debit it into P&L account. Okay. Now, if you have incurred this freight before you put the asset into use, if you're going to capitalize the freight, if you're going to add it to the block, then the limit will still be 10,000 only. If it is up to 10,000, pay however you want. If you're paying more than 10,000, then make the payment in specified mode. But however, if you're incurring the freight after you put the asset to use, which means if it's an expense which you're going to debit to P&L account, then in this case for freight, the limit will become 35,000 rupees. This is my summary, guys. Now are you clear? So here I have applied 40A subsection 3. The reason why we spend so much time on this one particular concept is because it comes so often in the exam, guys, and every time students make a lot of silly mistakes over here. I hope you will not ever forget this. Right, guys? Generally, limit is 10,000 only. But for freight, in 40A subsection 3, limit is 35,000. But in add actual cost of assets acquired, there the limit will always be 10,000 only. Okay, guys, now please let me come back and let me finish the remaining discussion. Now see, in case you're getting any subsidy, okay, like for example, let's say the government has given you some subsidy to purchase the asset, then you will subtract that amount from your actual cost. So basically, what amount will enter into the block? Whatever you incurred for the asset, the actual cost of the asset, then you will add whatever expenses you incurred before putting the asset to use. Right now, I gave you the freight example, then interest example. So whatever expenses you have incurred before you put the asset to use, you will add all that to the block. Then you will subtract subsidy. In case you got any subsidy to acquire the asset, you will subtract that net amount. This is what will become your actual cost. This is what will enter into the block. Understanding? To the actual cost, you will add all the expenses which you have incurred before you put the asset to use. You will subtract whatever subsidy you received. Okay. Then comes the next discussion. What if you sell away a depreciable asset? When you sell away the depreciable asset, whatever is the selling price, you will subtract that over here, guys. Money is receivable for asset sold. This is where you will subtract your selling price. Now see, whenever your assessee sells away an asset, there will be huge tax implications. Okay, I'll draw one small flowchart for you over here. Let's say my assessee has sold an asset. What kind of an asset? A depreciable asset your assessee has sold. Okay. The first thing you will check is, after the sale of depreciable asset, is your block empty or is your block not empty? Like for example, let's say in my block I have two plant and machineries, plant and machinery A and plant and machinery B. Now I sold both, which means my block has now become empty, guys. So if my block becomes empty, you yourself tell me, guys, apply logic and tell me, is there even any sense in me claiming depreciation? Block itself has become empty, so for that block itself there will be no depreciation. That's all. I'll ignore the block. I'll straight away come to capital gains. Either I'll have short-term capital gains, or I'll have short-term capital loss. Okay, guys. So if my block is empty, then point number 1, no sense of me calculating depreciation. I'll straight away have capital gains only. In capital gains, either I will have STCG or I will have STCL. Okay. But however, if my block is not empty, okay, like for example, I have two assets in my block A and B. I sold only B. I'm still having A, which means block is not empty. At the end of the year, I still have some machinery over here. Because I still have some asset in the block, therefore, of course, first I will try depreciation. But by chance, depreciation is not possible. Only then I will come to capital gains, and in this case, I will have STCG only. I cannot have STCL. This is my main flowchart. So whenever I sell away a depreciable asset, the first thing you will check is my block empty or is my block not empty. If my block is empty, no sense of claiming depreciation, straight away I'll come to capital gains. But if my block is not empty, then first I will try depreciation. If depreciation is not possible, then only you will have capital gains, and that too STCG only. STCL is not possible. In this situation, STCL is not possible. Okay. Now listen, I'll give you 3 examples. In my first example, let's say our opening WDV in the beginning of the year was 100, and let's say we had 2 plant and machineries A and B. Then add actual cost of assets acquired. Let's say we did not add any new asset into the block. Then you will subtract monies receivable for assets sold. Let's say you sold plant A and plant B. You sold both for 80 rupees. Okay. So therefore, what's your closing WDV at the end of the year? Closing WDV end of the year is 20. Now your block is empty. Because block is empty, there will be no question of you computing depreciation, guys. Straight away you will come to capital gains calculation. Now in capital gains, how do you calculate? You see the full value consideration. From this you subtract the cost of acquisition. You will get your STCG, guys. Depreciable asset, the capital gains will always be short-term capital gains only. So what's the full value consideration? You sold the asset for how much? What's your selling price? Your selling price is 80. Now what will the cost of acquisition be? Remember, guys, in depreciable asset cases, your cost of acquisition will always be your opening WDV plus additions. So what's your opening WDV plus additions over here? 100. So net you will get a negative 20. This will become your STCL in my example. Is this clear? My first example. So my block was empty. Because my block was empty, I did not even try for depreciation. I straight away came to capital gains, and in capital gains I had a negative number. Okay. Now let's go to my second example. In my second example, the numbers remain the same, okay, but this time let's say I sold only plant A. I did not sell plant B. Are you listening to me? I still have plant B, which means my block is not empty, guys. So because my block is not empty, I will first try for depreciation. Now see, my closing WDV is 20. It's a positive number. Depreciation is possible, guys. And I told you we always split our WDV into 3 parts, right? Number 1, 0 days. Number 2, less than 180 days. And number 3, my balance WDV. So here if you see 0 days and less than 180 days, I told you both of these numbers you will take from your add actual cost of assets acquired. This is 0, guys. So 0 days my WDV is 0. Less than 180 days also my WDV is 0. So my entire WDV will become balance WDV. On this balance WDV, let's say for example 15% depreciation is applicable in my case. So 20 into 15%, 3 will become your depreciation. So 17 rupees will become your opening WDV for the next year. Now here see, guys, my block was not empty. So because block was not empty, I first tried for depreciation. Only if depreciation is not possible, only then I'll go to capital gains. Here depreciation was possible. I did have a positive WDV number. Depreciation was possible. So I calculated depreciation, and therefore there's going to be no capital gains at all in this situation. Okay, guys. Only if depreciation is not possible, only then you will have capital gains. Alright. Now let's change one number. Let's say your money is receivable. Let's say your selling price number is 120. Okay, you sold just plant A. You sold plant A for 120. Your block is not empty. Only one asset you sold for 120. Now less money is receivable for assets sold. You can't put full 120 over here, guys, because if you put full 120, you'll get a negative 20. WDV can't be negative number. So therefore, even though your selling price is 120, you will restrict it to 100 over here. So WDV will become 0. Now you tell me, if WDV is 0, is depreciation even possible? No, right? So if my block is not empty, I will first try for depreciation. I'm trying, but depreciation is not possible over here because WDV has become 0. So if depreciation is not possible, now I will come to capital gains, guys. So capital gains, normal usual calculation. What's my selling price? I sold plant A for 120 rupees. Then you will subtract cost of acquisition. I just now told you for depreciable assets, cost of acquisition will be your opening WDV plus your additions. So opening WDV is 100. 100 plus 0 will be 100. So net 20 rupees. This will become your STCG. Are you perfectly clear now? Yes, guys. So if your block is, now listen, come back to my table. If my block is empty, then in that case, there is no question of depreciation because block itself is empty. So straight away you will have capital gains only. Capital gains can be STCG or it can be STCL. But if your block is not empty, then first you will write depreciation. In case depreciation is not possible, only if depreciation is not possible, only then you will have capital gains. And also don't forget, whenever you're calculating capital gains for depreciable assets, number one, it will always be short-term capital gain only. And number two, don't forget guys, whenever you're calculating capital gains for depreciable asset, your cost of acquisition will be opening WDV plus whatever new additions you're having. Okay guys, so this was about what if you sell away a depreciable asset. So in this one page, a lot of concepts we have learned. First, we learned our entire format to do block computation. Remember, your closing WDV will always be split into 3 parts: 0 days, less than 180 days and balance WDV. Also don't forget the 0 days part and the less than 180 days part. Both of these you will take from your add actual cost of assets acquired. Okay. Then also don't forget that your you have to follow the sequence. Whatever WDV you have, first 0 days, then less than 180 days, then balance. Okay. Then we learned that in case you are having any subsidies, you will subtract the subsidy when you're doing the actual cost calculation. Then we learned in case you're making the payment of the asset, let's say you purchased an asset, you want to enter it into the block, you're making payment of the asset. If the payment is more than 10,000 rupees, then you have to make the payment in specified mode only. Here we don't have 35,000 number, we only have one number, the 10,000 number. Then after this we learned in case you sell away a depreciable asset, if block is empty, then no depreciation, you will straight away have capital gains only. But if block is not empty, you will first try for depreciation. Only if depreciation is not possible, only then you will have capital gains. And if you're computing capital gains for depreciable asset, it will always be short-term capital gains only, and your cost of acquisition will be opening WDV plus additions. Okay guys, multiple times I have revised this for you. Now you have absolutely no excuse left for this part of my discussion. I spent a lot of time. I hope you make it worth it. Now listen, coming to my next discussion, what about GST input credit? Like for example, let's say I purchased plant and machinery for 10 lakh rupees plus 1 lakh GST, total 11 lakh I paid for this plant and machinery. Now the question is how much will enter into the block? Very simple guys. For this 1 lakh, if you're taking GST input credit, then this 10 lakh only will enter into the block. But if you're not taking input credit, then the whole 11 lakh will enter into the block. So if you're taking input credit of 1 lakh, then only this 10 lakh will enter into the block. But if you don't take input credit of this 1 lakh, then the whole 11 lakhs will enter into the block. Then comes my next discussion, which is additional depreciation, which is also called as accelerated depreciation guys. Now you have to fulfill 5 conditions. Only if all the 5 conditions are fulfilled, you will be able to get additional depreciation. Condition number 1, who is the assessee? Assessee should either be a manufacturer guys. Now remember, manufacturing also includes printing and publishing for the purpose of additional depreciation. Then all assessee should be in the business of generating or distributing or transmitting power. So either assessee must be a manufacturer or printing, publishing, books business, or generating, distributing, transmitting power. Condition number 1, who is the assessee? Condition number 2, assessee must be claiming depreciation in WDV basis, which means if assessee is doing depreciation calculation in SLM basis, no option of additional depreciation. Then comes the third condition, the asset has to be plant and machinery, which means for building, furniture and fixtures and intangible assets, no concept of additional depreciation. Additional depreciation is only for plant and machinery. Condition number 4, the asset should not be ineligible plant and machinery. You have 6 ineligible plant and machineries guys. Second-hand plant and machinery, no additional depreciation. Road transport vehicle, no additional depreciation. Ships and aircrafts, no additional depreciation. If you're using the plant and machinery in factory, you will get additional depreciation. But same plant and machinery, if you're using in office or in guest house, then you will not get additional depreciation. Like for example, AC. If I'm using this AC in the factory where manufacturing work is happening, I will get additional depreciation guys. But if the same AC, if I'm using in the corporate office, okay, then for that AC, additional depreciation I will not get. So if the plant and machinery is being used in office or guest house, no additional depreciation. Then if the plant and machinery is something which is already fully debited while computing PGBP, then I will not get additional depreciation. Like for example, let's say I purchase some plant and machinery for scientific research. Now this plant and machinery you will already debit fully to your P&L account guys. So on these kind of plant and machineries which you have already fully debited to the P&L, you cannot claim additional depreciation. Okay. And my fifth condition, my last condition is that assessee must be following the normal regime. Assessee must not be following the default regime. So if all these 5 conditions are fulfilled, only then you will be eligible for additional depreciation. Come on, tell me what are the 5 conditions one by one. Condition number 1, assessee should either be a manufacturer, or he must be in the printing publishing business, or he must be in the business of generating, distributing or transmitting power. Condition number 1. Condition number 2, assessee must be following the WDV basis and not the SLM basis. Condition number 3, the depreciable asset has to be plant and machinery. Condition number 4, it should not be ineligible plant and machinery. 6 ineligible plant and machineries you have. Second-hand plant and machinery, not eligible. Then road transport vehicle, not eligible. Ships and aircrafts, not eligible. Then if the plant and machinery is used in office or guest house, not eligible. And if the plant and machinery is already fully debited in the PGBP, then also that plant and machinery will not be eligible for additional depreciation. And my last condition was that particular assessee must be following the normal regime. He must have opted out of the default regime. So only if all these 5 conditions are fulfilled, assessee will be eligible for additional depreciation. How much, guys? 20%. Now see, will you get this 20% every year? No, guys. See, whenever you purchase a plant and machinery, new plant and machinery you purchased, now for this plant and machinery, you will get additional depreciation only one time. 20% you will get only one time. See, for this plant and machinery, normal depreciation you will get every year. But for this plant and machinery, additional depreciation you will get only once, and that is 20%. But however, remember, in the year of acquisition, if you put the asset to use for less than 180 days, then you will get half. Only 10% additional depreciation you will get. But then in that case, don't worry, assessee, balance 10% you can take in the next year. But in the year of acquisition, if I don't even put the asset to use, then you will get no additional depreciation. So in that case, subsequent year, whenever I put the asset to use, in that year I will get my 20% additional depreciation. Okay, guys. Now listen, one last point with respect to additional depreciation. See, whether I will get additional depreciation or not, it depends upon what regime am I following in the year in which I first put the asset to use. I'll give you one example to help you understand this. Listen to me. See, let's say I purchased one plant and machinery on the 1st of April 2024. Which means I purchased it in previous year 24-25. And in 24-25, let's say I'm following the default regime. Okay, guys. Then I put this, but then in 24-25, I did not put the asset to use. This plant and machinery, I put it to use first time, let's say on the 1st of December 2025. That is in previous year 25-26. And this year I am following the normal regime. So my question to you is, will I get additional depreciation or not? Point number 1, in previous year 24-25, I will not get any additional depreciation, guys, because of 2 reasons. Reason number 1, I did not even put the asset to use, and reason number 2, I am following the default regime. If I follow the default regime, additional depreciation is not available for me. Now in 25-26, will I get additional depreciation or not? See, guys, 25-26, I am following the normal regime. That is the year in which I am first putting the asset to use. That's what I am telling you over here. Will I get additional depreciation or not? It depends upon what regime am I following in the year in which I am first putting the asset to use. I am first putting the asset to use in 25-26. In 25-26, I am following the normal regime, which means I am eligible for additional depreciation in 25-26. Question is, how much additional depreciation will I get? This is subsequent year, guys. 25-26 is subsequent year. So even if I put the asset to use for one day, I will get full 20% additional depreciation. Understanding? You know this very well. 180 days point I check only in the year of acquisition. Subsequent year, 180 days number is irrelevant for me. So this is subsequent year. Subsequent year, I put the asset for use for even one day, I will get full 20% additional depreciation. So even though earlier I was following the default regime, in the year in which I first put the asset to use, I am following the normal regime, which means I am eligible for additional depreciation for that particular asset. Okay, guys. Then comes my next point, sale and repurchase. Before that, additional depreciation, everybody is clear, right? 5 conditions. If all the 5 conditions are fulfilled, 20% additional depreciation you will get. And in case in the year of acquisition, if you put the asset to use for less than 180 days, you will get only 10% additional depreciation. In that case, don't forget to write in the examination, guys, that assessee balance 10% will be enjoyed in the next year. That balance 10% can be enjoyed in the next year. That has to be given in a note in your answer paper. Okay. Now, before I go to the next concept, one small question I'll ask you. Try answering. Let's say my assessee is having 2 vehicles. Okay, both of them are trucks. All right. Now this is assessee's factory, let's say, and this is the showroom. So assessee is using one truck for transportation of goods from the factory to the showroom. For the transportation, the assessee is using one truck. Let's call it as truck 1. On this truck, will you get additional depreciation, guys? No, because it's a road transport vehicle, you will not get additional depreciation. Now assessee is having one more truck. Okay, that truck as the second truck assessee is using inside the factory only. It's a huge factory. Let's say in this corner of the factory, the manufacturing work is happening, but all the raw materials are kept in this corner of the factory. So to transport the raw materials from the godown to the main manufacturing place, so inside the factory for the transportation only, this second truck is being used. It is not being used on the road. It is being used inside the factory only. So for this truck, will you get additional depreciation? The answer is yes. It is not a road transport vehicle, guys. It's a factory transportation vehicle. I am using it for transportation within the factory. I'm not using it for road transportation. I'm using it for transportation within the factory. So on this, I will get additional depreciation. Understanding? This point only I've written over here for you, that if the vehicle is used for transportation within the factory, but it is not used for road transportation, then it will be eligible for additional depreciation. All these are small learnings that we are having from questions, okay? All these points we have seen in questions, just putting them over here for you in your book itself. That's the whole reason why I was telling you that in the day before the examination, when you actually revise through this book, indirectly you will also end up revising all the 400-500 questions which you have worked out with me in class. Whether regular batch, whether workout batch, you will actually end up revising all the questions which we have worked together, because whatever learnings we have in those questions, I've put the learnings in our book itself. Alright, you're clear with this point? So this is it about your entire discussion on additional depreciation, guys. Now we're going to discuss one small simple adjustment, sale and repurchase. So here there are two transactions, guys. I have a depreciable asset, okay? I'm first selling the depreciable asset, then I'm repurchasing that same depreciable asset, okay? Two transactions. Each transaction will have a different tax implication. When I sell the asset, when I sell the depreciable asset, come on guys, when you sell any depreciable asset, what do? Whatever is the selling price, you put it in the block calculation. I'll show you in the block calculation, less money is receivable for asset sold. This is where you put the selling price number, guys. Then you see whether the block is empty, whether the block is not empty. If the block is empty, then no point of depreciation. Straight away you come to capital gains. If the block is not empty, you first try for depreciation. If depreciation is not possible, then normal usual capital gains. So your usual tax implications, whatever you do, whenever you sell a depreciable asset, same thing you will do even over here. Okay guys, then your second transaction, this was the first transaction, you're selling the asset. Then when you repurchase the same asset, see, when you purchase a depreciable asset, what do? Come back to your block computation. Whenever you sell an asset, you put the selling price under money is receivable for asset sold. But when you purchase an asset, you add it into the block, guys. Add actual cost of assets acquired. So when you repurchase the asset, it will re-enter the block. In this step, it will re-enter the block. But the biggest question over here is, at what price will it re-enter the block? That is what we're doing now. It will re-enter the block at either the repurchase price, that is at what price are you repurchasing, or before you had sold the asset, what was a WDV of the asset before sale, whichever is lesser. This is where there's little bit drama. See, when you sell away the depreciable asset, when you sell it off the first transaction, normal usual tax implication only. The drama is only when you repurchase the asset. When you repurchase the asset, it will re-enter the block. Question is, it will re-enter at what price? Either the repurchase price or that particular asset, what was the WDV before sale, whichever is lesser. At that lesser number, it will re-enter the block. Got it, guys? This is sale and repurchase. Now listen to me. Let's say I had an asset. I was using the asset for my personal purposes. Will you give me depreciation? You will not give me depreciation, guys. Then that same asset, when I start using for my business or profession, now you will give me depreciation on the asset. Now, when you give me depreciation on the asset, first of all, it has to enter into the block. No. At what price will it enter into the block? That depends upon what kind of an asset is it. Is it a building or is it any other asset? First of all, situation is clear. My situation is, first when I purchased the asset, I used it for personal purposes. Therefore, you did not give me depreciation. Then later, that same asset, I started using it for my business or profession. So now you will give me depreciation. But you will give me depreciation only when the asset enters into the block. So at what value will it enter into the block? At what value will it enter into the block? That depends upon what is the asset. Is it building or is it any other asset? If it is building, guys, we will see long back when we purchased the building, for what price we purchased it. So long back, our actual cost we will see. Minus deemed depreciation. What is this deemed depreciation? Listen to me, very simple concept, guys. Let's say 2 years, for 2 years, I use this building for my personal purpose. Now in the third year, I'm going to bring this building for my business or profession. Let's say I purchased this building for 1 lakh rupees 2 years back. Now from this 1 lakh rupees, I will subtract deemed depreciation. The word deemed means what? Deemed means it is not real, guys. I'm assuming that there is depreciation. In reality, for these 2 years, I have not claimed depreciation, but I'm going to assume, what if I had claimed depreciation for these 2 years? These 2 years, when I was using it for personal purpose, for these 2 years, years, I will calculate what is the depreciation amount. The depreciation I will subtract. Whatever is the net number I get, that net number will enter into the block. This is deemed depreciation concept or notional depreciation concept. But please remember, this is only for building. For other assets, life is very simple for other assets. For other assets, whatever is the actual cost, no, long back, whatever I had spent to purchase the asset, that actual cost itself will enter into the block. Beware, in the question, in such kind of questions and all, they'll give you the fair market value of the asset, guys. That and all doesn't even matter, not the fair market value. Long back, whatever is the actual cost, that only will enter into the block. Only for building, you will subtract deemed depreciation. See, in reality, those 2 years, when you use the building for personal purposes, in reality, you did not claim depreciation, but we are going to compute notional depreciation. We are going to compute imaginary depreciation. We are going to compute deemed depreciation. The deemed depreciation number for these 2 years we will subtract. Okay, if you want to do it as a practical question, I'll show you. 2 years back we purchased it for 1 lakh rupees, guys. So my year 1's deemed depreciation will be building, right? Building depreciation rate is generally 10%. So 10,000 rupees. So then my WDV will be 90,000. Then year 2 deemed depreciation will be 90,000 into 10%, which is 9,000. So what's your net number now? 81,000. This is what will enter into the block. Now some of you will argue with me. You will say, ma'am, why are you doing 10% depreciation? Shouldn't you do 5% depreciation? Because the last 2 years building was used for personal purposes. Building was used for residence purposes. Residential building, 5% depreciation rate. No. So why are you doing 10%? Do 5%. If you're thinking like that, listen to me. We are calculating deemed depreciation, which means we are assuming what if from the beginning itself the building was used for business or profession. So from the beginning itself, if it was used for business or profession, then 10% only will apply. So this is not real depreciation. That's why I'm telling you again and again, it's not real depreciation. It is imaginary depreciation. You will imagine what if from the beginning this asset was used for business or profession, then how much depreciation I would have enjoyed. That depreciation you will subtract. This net number, this is what will enter into the block. But again and again I'm telling you, don't do all this drama for other assets. This is only and only and only and only for building. Okay, this was your one small concept. Then comes another point. This is an untested area, guys, not even tested till now in the examination. Asset acquired by gift or inheritance. Like for example, let's say I'm carrying on some business or profession. Okay, somebody gave me a gift of plant and machinery, guys. They gave me a gift of plant and machinery. Now that plant and machinery I'm going to use for my business, guys. So now I want to claim depreciation on that plant and machinery. Now same song I will sing, guys. I can claim depreciation on the plant and machinery only if the plant and machinery first of all enters into the block. Now if I want to enter it into the block, at what price will I put it into the block? That's what we're going to discuss now. See, we'll first of all see who is a previous owner. Previous owner is nothing but the person who's giving me the gift. Long back when he purchased the plant and machinery, for what price he purchased? Let's say he purchased it for 1 lakh rupees. 2 years back he purchased it for 1 lakh rupees. Now we'll subtract deemed depreciation. For how many years? See, when did the previous owner purchase the asset? 2 years back. So for those 2 years you subtract deemed depreciation. In simple words, you assume, what if I only had used the plant and machinery from the beginning? So you will subtract 15% deemed depreciation for year 1, 15% deemed depreciation for year 2. Why, guys? 2 years is only example. I am saying 2 years because I am assuming in my example that the previous owner purchased the plant and machinery 2 years back. So for those 2 years I am subtracting deemed depreciation. Okay, then make one small correction. This should be add. So in case in case I myself have incurred any expenses on the asset, like let's say some repair expenses I had incurred, some freight expense I had incurred before I put the machinery to use, all those expenses I will add. Whatever net number I get, this is what will enter into the block. And please remember, this calculation remains the same for all assets. Like in my earlier example, when personal asset is converted into a business or a profession asset, then we learned deemed depreciation concept is only for building, not for other assets, right? But here in this gift inheritance concept, this deemed depreciation concept is for all assets, guys, not just for building. You got it? So you'll see previous owner. For the previous owner, what was the actual cost? Then you will subtract deemed depreciation, assuming I only have used the asset from the beginning for my business or profession. Then in case I have incurred any expenses before I put the asset to use, you will add all those expenses to the actual cost. This net number I get, this is what will enter into the block. Got it, guys? And then comes one final point, a very important sequence, guys. Whenever you're computing PGBP, right, you will always first adjust your current year expenses. Then only you will adjust current year depreciation. The sequence is really important, guys. And also remember one more thing, because of expenses you can have a loss, but because of depreciation, you cannot have a loss. Like for example, let's say my sales revenue was 100 rupees, okay, and I had salary expense of 20 rupees, I had, let's say, raw material expense of 60 rupees, and then let's say I also incurred some printing and stationery expense of 40 rupees. So if you see, now I am having a net number as a loss. My net number now is a loss of 20 rupees, guys. This is fine. This will become my business loss. Business loss you will carry forward for 8 years, right? So because of expenses, I can have a loss. But however, in the same situation, let's say my salary was 20, my raw material was 60, and let's say my depreciation was 100. Okay guys, so first of all, will I adjust my expenses first or depreciation first? We know the sequence, we always adjust our expenses first. So after adjusting the expenses, what is your net number right now? Your net number right now is 20 rupees. This much profit only you're left with. So now depreciation is actually 100 rupees, but can you subtract the full 100? No guys, if you subtract the full 100, then you'll get a negative number of 80. You cannot have a loss because of depreciation. So that is why what we do is, we will subtract depreciation. In this case, only 20 only we will subtract. Okay, my depreciation was 100, but only 20 only I will be able to adjust. So my PGBP will now become 0. Out of 100 depreciation, my profit was able to absorb only 20. The balance 80 remains unabsorbed. I'll call this as unabsorbed depreciation. Okay, unabsorbed depreciation I'll carry forward indefinitely. I'll carry forward for any number of years. I can adjust it against any head of income except salaries, and of course I can't adjust it against casual incomes. Okay, you're getting my point. So 2 to 3 points I made over here. My point number 1, you always adjust current year expenses first, then only you adjust current year depreciation. Then point number 2, because of expenses you can have a loss, but because of depreciation you cannot have a loss. You will adjust only that much depreciation which your profit can absorb. The balance depreciation will become unabsorbed depreciation. So what will you do with that balance 80 unabsorbed depreciation? You can adjust it against any head of income except salaries, and of course you can't adjust any loss or anything against casual incomes. In case you're not able to adjust, you can carry it forward indefinitely. Crystal clear, guys? Now listen one more thing, okay? I am just not in the mood for depreciation this year. So I'm telling income tax department, depreciation I will claim next year, not this year. Can I do that? No guys, always remember, depreciation is a mandatory adjustment, which means I have to claim depreciation. If depreciation is possible, I have to claim depreciation. If I don't, income tax department will assume I have claimed. You're getting my point? We can't just like that postpone depreciation. If depreciation is possible, we have to claim. It is a mandatory adjustment. Okay, so coming back to my sequence, we always first adjust our current year expenses, then we adjust our current year depreciation, then we adjust brought forward business losses, and then only we adjust brought forward unabsorbed depreciation. For these 2 points, of course, you know the reason, guys. Why do we adjust brought forward business loss first? Why not brought forward unabsorbed depreciation? Very simple. Brought forward business loss has a life of only 8 years, and unabsorbed depreciation, on the other hand, can be carried forward indefinitely. So therefore, this I can carry forward forever. I can carry it forward indefinitely. There's no time limit. So of course I want to exhaust the 8 years limit first. I want to exhaust the brought forward business loss first because it has only 8 years limit. Okay guys, so the sequence is clear, right? So we always adjust our current year expenses first, then current year depreciation, then brought forward business loss, and finally brought forward unabsorbed depreciation. And one more point we learned, because of expenses we can have a business loss, but because of depreciation we can't have a business loss. And also we learned that unabsorbed depreciation we will carry forward indefinitely. Okay guys, now moving on to our next discussion about depreciation on SLM basis. So entire concept of depreciation on WDV basis we have covered. We first saw the 3 conditions, then we discussed about hire purchase, installment purchase, we spoke about use, active use, passive use, then we discussed about the block method, we spoke about the rates of depreciation, then we discussed the whole block computation method, we discussed about the 10,000 number, then we discussed what if I sell away a depreciable asset, what happens, we spoke about that as well. Then we discussed about GST input credit, then additional depreciation was a very important discussion, then we spoke about sale and repurchase, then we spoke about gift or inheritance of a depreciable asset, and finally we learned this important sequence. Now we will step into a discussion of depreciation on SLM basis. Generally, all our questions we work out on the basis of WDV, right? But we do have SLM depreciation method also. Now, this is applicable for which assessee? It's applicable only for those assessees who are in the business of generation of power, or they are in the business of generation and distribution of power. In simple words, SLM is applicable only for electricity entities. But even for these electricity entities, is it mandatory to follow SLM? No, it is not mandatory. When they file the first income tax return, right, in that they have to make a decision. Do they want to follow WDV or do they want to follow SLM? If they decide WDV, okay, forever they will follow WDV now. If they decide SLM, then forever they will follow SLM. Okay, but however, in the first income tax return, if they don't make a decision, if they don't make a choice, then by default we will assume SLM basis. Okay, so point number 1, SLM method is applicable for whom? Only for entities who are in the business of generating power or generating and distributing power. Then point number 2 is even for these assessees, is SLM mandatory? No, it is not mandatory. It's only an option for them that if they want to, then they can follow SLM method. So when do they have to make a decision? In the first income tax return. And in the first income tax return, if they don't make a decision, then by default we will assume SLM method. Then this SLM method is only for tangible assets. Here there is no block method, guys. In simple words, in SLM basis, you will do the computation for each asset separately. And however, if you sell away the asset in the same year in which you acquired it, that is, if your previous year of acquisition and the previous year of sale, if they are the same, then in that case, for that asset there will be no depreciation. Now listen, the fourth part, the most important part with respect to SLM, the most important part is what happens when you sell away the asset. See, I've already told you that if you sell away the asset in the year of acquisition itself, then no depreciation. So no depreciation, you will have normal, usual capital gains calculation. But what if the year of acquisition and the year of sale are not the same? That is, what if you are selling the asset in some subsequent year? Then in that case, there are 3 possibilities, guys. Possibility number 1. Let's take some numbers. Let us say I sold the asset for 100 rupees, okay? And the WDV of the asset was 150 rupees. That is, my selling price is less than WDV number. So if the selling price is less than the WDV number, the difference of 50 rupees, that will be called as terminal depreciation, and it will be allowed in your PGBP head. It will be allowed. Allowed means what? You can debit it. So this difference of 50 rupees, you can debit it in the PGBP head. So my selling price is lesser than the WDV. So in accounting terms, you will call it as loss, isn't it, guys? You will call it as loss on sale of asset accounting terms. So that loss only will be called as terminal depreciation, and it will be allowed in PGBP. Then comes the second point. Let us say my selling price was 100 rupees, okay? My WDV was 75 rupees and my actual cost was 120 rupees. So when I purchased the asset, I purchased it for 120 rupees. Now I'm selling it off for 100 rupees and the WDV is 75. So here if you see, accounting point of view, if you see, it becomes a profit on sale of asset, guys. WDV is only 75. I sold for 100. So I have 25 rupees profit on sale of asset. That 25 rupees profit on sale of asset will be called as balancing charge, and this balancing charge will be taxed for you under the PGBP head. Understanding? So point number 1, accounting point of view, if you have a loss, that is your selling price is less and WDV is high. WDV in the books is 150, but you're selling off for just 100 rupees. So 50 rupees loss you're having, that will be called as terminal depreciation and allowed in PGBP head. But if you're selling at a profit, that is your selling price is more than WDV, then in that case your profit, your 100 minus 75, the 25 rupees will be called as balancing charge and it will be taxed under PGBP head. Coming to the last situation now, the most interesting situation, let us take numbers even over here. Let us see the selling price. I'm selling away the depreciable asset for 100 rupees. The WDV is 75 rupees, which means even over here I'm selling at a profit. If you notice, in the first situation, yes, no doubt I'm selling at a loss, but in my second and in my third situation, in both, the selling price is more than WDV. So in both my second and third situation, I am selling at a profit. But the difference is, in the third situation, my selling price is even more than the cost, guys. Let us say long back when I had purchased the asset, I purchased it for 90 rupees and now I'm selling it for 100 rupees. So in my second situation, even over here I had a profit. Third situation, even here I am having a profit. The difference is, in my second situation, the selling price was not more than the cost, guys. Cost was 120. I was selling for 100 rupees. So my selling price was not more than the cost. But in my third situation, the selling price is more than my cost. So if I'm selling at a profit and also my selling price is more than the cost, then the third situation will apply. Now here what you will do, first find the profit. What's the profit, guys? Selling price is 100. WDV is only 75. So I made a profit of 25 rupees. Now this 25 rupees, see, what is the difference between selling price and cost? The selling price is even more than the cost, right? So here selling price is more than the cost by 10 rupees. This will go into the capital gains. And the balance profit, that is a balance 15 rupees, will become balancing charge, which will be taxed in your PGBP head. Understanding? So if it's a loss, that is if selling price is less than WDV, the loss will be called as terminal depreciation and allowed in PGBP. Then if it's a profit, that is selling price is more than WDV, then the profit will be called as balancing charge and it will be taxed under PGBP. But however, if there's a profit and also selling price is more than the actual cost, then in that case, whatever is the difference between selling price and the actual cost, the difference will become your capital gains and the balance profit will become your balancing charge taxed under PGBP head. Okay, so this was your discussion with respect to SLM. Now that we have completed depreciation section 32, both WDV and SLM, let's start revising section 35 scientific research now. Now I've made a nice flow chart for you. Okay, this one chart itself will cover most of your scientific research discussion. Now scientific research can be of two types. It can either be in-house scientific research or it can be contribution to outsiders. Two types first of all. Let's focus on just the in-house scientific research. Just this part alone, let's focus on first. Now in-house scientific research, guys, it has to be related to assessee's business. Like if I'm doing paper business, I can't do scientific research, in-house scientific research about steel business. Not allowed. So the in-house scientific research, point number one, has to be related to assessee's business. Point number two, in-house scientific research, whether I'm following the default regime, whether I'm following the normal regime, no problem, guys. Same provision only. See, until now in our PGBP chapter, because of the default regime, only one thing we have seen, additional depreciation you will not get in the default regime. Apart from that, everything has been the same only, whether default regime, whether normal regime. And there's no other change that we have seen till now. Okay, so in-house scientific research, two things we learned. Number one, it has to be related to assessee's business. Number two, which regime are you following doesn't matter. Now inside in-house scientific research, there are two types, guys. You might incur this in-house scientific research expense either before commencement of business or you can incur it after the commencement of business, either pre-commencement or after commencement. If you have incurred before commencement, can you incur it 20 years before commencement? No. Whatever is the date of commencement, before that in the last 3 years you should have incurred. If you have incurred even before 3 years, I will ignore. I will consider only those expenses which you have incurred during the 3 years before commencement of business. Okay. Now, these pre-commencement expenses can be capital expenses also, REVEX also, revenue expense also. Both are allowed, guys. It can be capital expense also, it can be revenue expense also. But capital expense, see, one minute. These pre-commencement expenses also, we are saying that it is allowed under section 35, right? But when will you allow under section 35? Only when you commence business. So, you are incurring the expense before commencement, you are incurring the expenses during the 3 years before commencement, but these expenses will be allowed under section 35 only after you commence your business. Okay, and these pre-commencement expenses can be of two types, capital expense, revenue expense, both are allowed. Now capital expense, it can be any capital expense, just that it should not be land. And one more thing, guys, let's say I purchased one capital asset, okay, for scientific research. Can I claim section 35 because scientific research, and can I also claim depreciation under section 32? No, guys, you can't get the best of both worlds. You have to choose either section 35 or section 32, only one you will get. You purchased one plant and machinery for scientific research, either you will get section 35 or you will get depreciation. You can't enjoy both, you have to pick any one. Okay, guys, once again I'm reminding you guys, in capital expense, land is not allowed. All other capital expenses you can claim section 35 deduction, but land you can't claim. Okay, when it comes to revenue expense, pre-commencement revenue expense, only two revenue expenses are allowed. One is raw material which you have purchased for the purpose of scientific research, and number two, whatever salary you are paying to research staff. Now you are employer, you are paying salary to your research staff. So when you are paying salary, some of that salary might be perk visits also. So perk visits will not be allowed. Only salary paid to research staff will be allowed. In that salary, how much ever is a perk visit, that will not be allowed. So till here, are you crystal clear, everybody? So we're talking about section 35 scientific research. In that we're talking about in-house scientific research that has to be related to assessee's business. Doesn't matter which regime you're following. In-house scientific research, we're discussing about pre-commencement expenses. You're incurring expenses during 3 years before commencement. These expenses I will allow to you, I will allow for you once you commence your business. These pre-commencement expenses may be capex or they may be revex. In capex, land is ineligible. In revenue expense, only two eligible assets we have. One is raw material and the other is salary which I pay to research staff excluding perk visits. Okay. This is about pre-commencement. Now, what if I'm incurring the expenses after commencement? Same thing, even after that, there'll be two expenses, capex and revex. Capex also will be allowed, revex also will be allowed. Same thing, in capex, land will not be eligible. Same thing for capex, if you're claiming section 35 deduction, for the same capex, you can't claim depreciation also. Pick any one. But in revenue expense, guys, there is no restriction only to revenue expense. Like that, there is no restriction. Whatever revenue expense you have incurred for the purpose of scientific research, everything will be allowed. Okay, only pre-commencement I'm putting restriction only to revenue expense. Like that I'm putting restriction. But if you're incurring revenue expense for scientific research after commencement, it can be any revenue expense. It can also be perquisite for scientific research stuff. Every revenue expense will be allowed. Okay guys, so this is it about our entire revision on in-house scientific research. Now coming to contribution to outsider. Very simple. Here assessee is being amazingly lazy. Assessee is saying, why should I do the hard work? Why should I set up one scientific research department, hire scientific research staff, buy raw material and give for them? Why should I do all that hard work? Let me straight away go to IIT and donate money to them. Let them do the scientific research. I'll straight away go to a laboratory and donate money to them. Let them do the scientific research. This comes under contribution to outsiders. So in contribution to outsiders, assessee is going to some outsider, making a contribution and asking them to do scientific research. But good news is, in contribution to outsiders, the scientific research need not necessarily be related to assessee's business. It may be related to assessee's business, it may not be related to assessee's business, both is allowed. But we also have a bad news. Bad news is that contribution to outsiders will be allowed under section 35 only under the normal regime, which means if assessee is following default regime, no additional depreciation. If assessee is following default regime, in-house scientific research you can still claim, but contribution to outsiders you cannot claim. Okay guys, now these contribution to outsiders, you can contribute to whom? Multiple options we have. You can contribute to approved research association, national laboratory, approved college, approved university, IIT or IIM, Indian scientific research company. Indian scientific research company means what? Number one, you're an Indian company, and number two, in a company there'll be MOA, right? Memorandum of Association. In Memorandum of Association, there will be objects clause, right? In that objects clause, the main object of the company should be scientific research. So Indian scientific research company means, first of all, it should be an Indian company, and secondly, the main object of that company has to be scientific research. So we can contribute to such Indian scientific research companies also. So contribution to outsiders, we can contribute to whom? Approved research associations, approved national laboratories, approved colleges, universities, institutions, IITs, IIMs and Indian scientific research companies. Now we are contributing for what? Either for scientific research or for research in social science or for research in statistical science. Got it guys? So this is my entire discussion on section 35 scientific research. I hope you are crystal clear. So section 35 in-house scientific research, contribution to outsiders, both we have. In-house scientific research is allowed under both the regimes, but contribution to outsiders is allowed only under the normal regime. Now see, in in-house scientific research we have one exclusion, land is excluded, but in contribution to outsiders we don't have any such exclusion. Now what if I contributed money to IIT for scientific research, and what if IIT uses that money to buy land? I don't care guys. Remember, land is exclusion only in in-house scientific research. There is no exclusion in contribution to outsiders. Now even if this outsider is using that money to buy land, it doesn't matter. It will not impact your answer in any form. It's okay. The outsider can use the money to buy land also, not a problem. Land is an exclusion only in in-house scientific research. Okay guys, now listen to me. I purchased one plant and machinery for scientific research. I did not even put it to use. Will you still give me section 35 deduction? Yes guys, remember, put to use is a concept which is in depreciation. Leave it in depreciation. Don't bring it everywhere else. In section 35, I just have to invest my money into scientific research asset. As soon as I invest my money into scientific research asset, I am eligible for section 35 deduction. Now whether I use it, whether I don't use it, put to use is irrelevant. Got it guys? Put to use is only a depreciation concept. Don't drag it everywhere else. Okay guys? Then land, I already told you, in in-house scientific research, land is ineligible. In contribution to outsiders, even if outsider uses that money to buy land, it doesn't matter. That will be irrelevant. I will still get the deduction. Okay guys, then I made one small comparative analysis between in-house scientific research and contribution to outsiders. In in-house scientific research, it has to be related to assessee's business. But contribution to outsiders may or may not be related to assessee's business guys. First differentiation point. Second differentiation point, in-house scientific research doesn't matter which regime I'm following. In both the regimes it is allowed. But contribution to outsiders is allowed only under the normal regime guys. Then in-house scientific research, I can incur the expense pre-commencement also, post-commencement also. If I'm incurring it pre-commencement, I must incur it during 3 years before commencement and I will allow the expense only upon commencement. But in contribution to outsiders, no concept of pre-commencement. It has to be after commencement only. Then in-house scientific research, I'm having CapEx, RevEx, two things I'm having. But in contribution to outsiders, guys, we are either contributing for scientific research or for research in social science or for research in statistical science. Got it everybody? Till here clear. Now comes the last concept in scientific research. What if I purchased an asset for in-house scientific research? Let's say I purchased some plant and machinery. Why did I purchase? For the purpose of in-house scientific research. So therefore, you will give me section 35 deduction guys. Now there are two possibilities. What if I start using this plant and machinery for some other purpose? Then what will happen? Then second possibility, what if I sell away this plant and machinery? Then what will happen? That is what we will be seeing over here. Now coming to sale of scientific research asset, there are two possibilities over here. Either I put it into some other use and then I sell the asset, or I directly sell the asset. If I directly sell the asset, this is more common in the examination. In that case, you will see what is the section 35 deduction that you had enjoyed earlier when you purchased the asset and what is the selling price. Out of these, whichever is your lesser number, this will become your PGBP income. This will be taxed your PGBP. Simple. So whatever your selling price or section 35 deduction, whichever is lesser will be your PGBP. Then one more tax implication you will have. Normal usual capital gains computation you will be having over here. Usual capital gains computation, capital asset transferred, period of holding, full value consideration, usual computation. Only thing is in this computation, you can't have a loss. So by chance you have a loss, you will simply ignore the loss. Generally capital gains head you can have a loss guys. But in scientific research asset, when you sell away a scientific research asset, when you sell that away, in capital gains computation you can't have a loss. If you have a loss, you will ignore the loss. Okay. But however, what if I put it into some other use and then I sell the asset? Then in that case, when you put it into some other use, it will enter into the block guys. But it will enter into the block at zero value. Now it's a part of the block. So later whenever you sell away the asset, you will treat it just like any other depreciable asset. Just like how whenever you sell away a depreciable asset, you check whether the block is empty, not empty, usual thinking. Okay. So two big concepts we've completed guys, section 32 depreciation and section 35 scientific research. Now comes section 35 AD which talks about specified businesses. Like if you're carrying on a specified business, like for example cold chain facility or warehousing facility for storing agricultural produce or warehousing facility for storing sugar or producing fertilizers in India, or a hotel 2-star or above hotel, hospital which has minimum 100 beds, housing project. So any of these specified businesses if you're carrying on, then you get a huge benefit, section 3580. So I always say in our income tax syllabus there are 3 huge benefits for assessees. One is section 3580 which we're learning now. Then we have section 10 AA for SEZ units, and then we have chapter 6A part C where we have 80 JJAA, 80 QQB, 80 RRB. These are the 3 big huge benefits which we have in our income tax syllabus. So talking about 35AD now, you must be carrying on a specified business. Then you will be eligible for this deduction. Now what happens in this deduction is, for this business you will be incurring expenses guys. Some of those expenses will be capital expenses, some of those expenses will be revenue expenses. Revenue expenses you can anyways debit to the P&L. The beauty of 35AD, the speciality of 35AD, the benefit of 35AD is that because of 35AD, for the specified business, whatever capital expense you have incurred, even that also you can claim deduction under 35AD. Just like how revenue expense you can debit in your P&L, no, under 35AD, for specified businesses, whatever capital expense you have incurred, even that you can debit in your P&L, even that will be allowed in your PGBP computation. Understood? That's why I've mentioned over here, RevEx is anyways allowed. RevEx is anyways debited to the P&L. CapEx you can also debit to the P&L under 35AD. Only for specified businesses provided audit is getting done. Okay guys, now even over here expenses can be incurred pre-commencement. Even in scientific research we had pre-commencement expense, but there we had 3 years time limit. Here no time limit guys. 3 years, 4 years, 5 years, 10 years, 20 years, any time before commencement you could have incurred the expense. Only one small condition, and that is those expenses should be capitalized in the books of accounts. Whether revenue expense, whether capital expense, whatever expenses you have incurred before the commencement of business, only one small condition, you should have capitalized that expense in the books of accounts upon commencement. If you do that, then once you commence your business, even pre-commencement expenses also you can claim as a deduction under 35AD. Okay, then in section 35 scientific research, one ineligible expense we had land, guys. In 35AD, three ineligible expenses we have: land, goodwill, financial instruments. Open your eyes and see, I have not written intangible assets over here. I have written only goodwill. So other intangible assets are eligible, guys. Only one intangible asset is ineligible over here, goodwill. Come on, easy. Goodwill ineligible for depreciation also. Goodwill ineligible for 35AD also. Getting it, guys? So ineligible expenses, three ineligible expenses we have: land, goodwill and financial instruments. Then even over here, guys, you spent money, you purchased asset for the specified business. Let's say you purchase some plant and machinery for your specified business. I am doing cold storage business, guys. Cold storage is specified business. For that cold storage business, I purchased one refrigerator, guys. Now that refrigerator, I have to make payment. Now more than 10,000 if I'm making payment, I have to make the payment in specified mode only. More than 10,000 if I make the payment in non-specified mode, like for example 12,000, if I pay off in non-specified mode, then that particular expense will become ineligible for my 35AD deduction. Understanding? And of course, if you're claiming deduction under 35AD, then for the same asset you can't claim depreciation also. So 35AD or depreciation, select any one. Same point we had under section 35 scientific research also. So my first few points are clear, guys. Can I give you a revision of the revision? Will you listen to me? So under 35AD, assessee is carrying on a specified business. So for that specified business, assessee will be incurring expenses: revenue expense and capital expense. Revenue expense anyways is allowed. Allowed means you can debit it to the P&L. The benefit of 35AD is that for the specified business, whatever capital expense you are incurring, even that you can debit, even that is going to be allowed. Okay, but of course for that capital expense, if you're claiming 35AD, then for the same capital expense you can't claim depreciation also. You can't do both. You can claim only one, either depreciation or 35AD. You can't claim both. Okay, then three ineligible expenses we have: land, goodwill and financial instruments. Three ineligible expenses we have. Then we are incurring expense under 35AD, right? We're incurring capital expenses. Now those capital expenses, when you're making payment, if the payment is more than 10,000, it has to be in specified mode only. If payment is in non-specified mode, that payment will become ineligible for 35AD. Okay, then here audit is mandatory, only then you can enjoy 35AD. And also remember, pre-commencement expenses are allowed even over here, just like section 35, but there's no time limit of 3 years. So any time before commencement you could have incurred, only one condition, and that is you should have capitalized those expenses in the books of accounts upon commencement. If you do that, then pre-commencement expense also will be allowed for you under section 35 AD. Okay, guys, now listen, let's move on to our next discussion under 35 AD. Before I start this discussion, I want you to have one knowledge point. The knowledge point is that, let's say I'm having a hotel. Okay, this hotel is a 3-star hotel, which means it is 2-star or more than 2-star, guys, which means this hotel is a specified business, guys. Do you agree it's a specified business? But 35AD is not an original Income Tax Act section, which means in 1961, when the Income Tax Act was brought in, that time 35AD was not there. 35AD was inserted into the section much later, somewhere in 2010-2011. Okay, so this hotel was an old hotel. It's an already existing hotel, which means this hotel was existing even before the section came in, guys. So therefore, for this hotel, I will not get 35AD deduction, because 35AD, come on guys, understand the whole logic behind 35AD is government is saying, I want more cold chain facilities, I want more warehousing facilities, I want more hotels, I want more hospitals. So they are encouraging new businesses. So if you're already having one hotel, why should I give you any extra benefit? Benefit I will give you only if you now construct a new hotel, a new hospital, then I will give you benefit. You are already having a hotel, why should I give you a benefit? So are you noticing this hotel, because it is 2-star or above, it is a specified business, but because it's an old hotel, because it was existing even before this section came in, this hotel will not get 35AD benefit. So first of all, are you having one good morning moment over here that there's a possibility that it's a specified business but still not claiming 35AD? First of all, this possibility is there. Now listen to me. In case I'm having a specified business, and in that specified business I'm claiming 35 AD. In that business, if I'm suffering a loss. In simple words, I'm having a specified business where I'm claiming 35 AD, and in that business I'm having a loss. Now this loss you can adjust against what? It is a business loss. But there's something special about this business loss. It's a specified business loss. Something even more special, in that specified business I'm claiming 35 AD and I'm suffering a loss. Now this loss, guys, can be adjusted against income from any specified business. The key word over here is any. It can be adjusted against income from any specified business. Any specified business means whether that specified business is claiming 35 AD, whether that specified business is not claiming 35 AD, doesn't matter. Now you will not ask me, right, ma'am, how is it possible that it is specified business but not claiming 35 AD? How is it possible? You will not ask me, right, because you know it over here already. There is a possibility it's a specified business but old business, hence not eligible for 35 AD. That possibility is there. So in case I'm having a specified business where I'm claiming 35 AD, and in that business if I'm suffering a loss, that loss I can adjust against income from any specified business. Why am I stressing so much on this word any? To tell you, to feed inside your memory that specified business may or may not be claiming 35 AD, doesn't matter. So this specified business loss I can adjust against the income of this hotel also. It is a specified business, but okay, it is not eligible for 35 AD, but it is a specified business. So whatever specified business 35 AD loss I'm having, I can adjust it against this hotel also in my example. Alright, guys, but of course if that business is not claiming 35 AD, it's a specified business but it is not claiming 35 AD, here no special treatment, guys. This loss I will treat like normal business loss. Normal business loss you can adjust against any business income. The special treatment is only if it is a specified business, condition 1, you're claiming 35 AD, condition 2, and in that business if you're suffering a loss, that loss I can adjust only against income from any specified business, whether claiming 35 AD or not. And one more thing, guys, what if I'm not able to adjust? Will you let me carry forward? Yes, you will let me carry forward. How many years? Normally, business loss can be carried forward for 8 years only, no. But this particular specified business loss where you're claiming 35 AD, this business loss you can carry forward indefinitely, guys. You can carry it forward indefinitely. Any year, if you're having any income from specified business, any specified business, you can adjust that loss against that income. Got it, guys? So this was our discussion about loss from 35 AD business. And one more thing, tell me if this is possible or not. Let's say my net profit before 35 AD is 100 rupees, okay? And let's say my 35 AD deduction is 150 rupees. So can I have a loss because of 35 AD? Yes, guys, it is allowed. It is possible. I can have a loss because of 35 AD. There is no unabsorbed concept and all in 35 AD. I can have a loss because of 35 AD. Okay, guys. So until here, my entire discussion is clear. What deduction, how much deduction, what about the loss from the specified business, everything we have discussed. Now I've brought one small comparative table, okay, comparing 35 scientific research and 35 AD. See, all these differentiation tables and all, they will not ask you in the examination, of course. Then why is my checkmate book filled with these tables? Because see, guys, if we don't do this differentiation now during our preparation, no, then in the examination, we will start getting confused between sections. Have you noticed? In those 3 hours, you start realizing that your brain is suddenly working too much. You start wondering, why was your brain not working so much earlier during your preparation? Have you felt like that? During those 3 hours, brain will start thinking about some weird scenarios and will start confusing you. That is why what we are doing is we're trying to eliminate the confusion now itself during preparation. I know for a fact in the examination between these two sections, nice khichdi can be cooked by your brain. So we will try to differentiate now itself so that there is no scope for confusion. Listen to me, guys. Section 35 scientific research. Section 35 AD specified business. In section 35 also pre-commencement expense is allowed. In 35 AD also pre-commencement expense is allowed. But in section 35 the pre-commencement expense has to be incurred during 3 years before commencement. But in 35 AD specified business there is no such 3 years limit. Instead, 35 AD simply says that you have to capitalize the expense in the books of accounts upon commencement. This capitalization point is not there in section 35. It is only in 35 AD. So you're understanding, in section 35 also, in 35 AD also, in both we are covering pre-commencement expenses. In section 35, it has to be during 3 years before commencement and there is no requirement of capitalization and all. In 35 AD, there is no limit of 3 years, but there is a condition of capitalizing the expenses in the books of accounts. Okay, guys. Then in section 35, Audit and all is not mandatory, but in 35 AD audit is mandatory. Then in section 35 only one ineligible asset we have, which is land, but in 35 AD three ineligible assets we have: land, goodwill and financial instrument. Then comes my last point. In section 35 you have in-house scientific research and contribution to outsiders, guys. In-house scientific research is allowed under both the regimes, but contribution to outsiders is allowed only under the normal regime. 35 AD is allowed only in the normal regime. So if your assessee is following default regime, no additional depreciation. Contribution to outsiders for scientific research not allowed. 35 AD not allowed. So listen to me, very small point, listen to me. Let's say my assessee is following default regime. Okay, so 35 AD you will not give me, guys. So like for example, let's say I purchase some plant and machinery for my specified business. Let's say I had a hotel, I had a 3-star hotel, specified business, eligible for 35 AD. I purchased some plant and machinery for this hotel. You will not give me 35 AD deduction for this plant and machinery because I'm following default regime. Okay, fine. Don't give me 35 AD. In that case, on this plant and machinery, give me normal depreciation then at least. Give me section 32 depreciation at least. Understanding? This is allowed. So you have to remember this. You should always have complete understanding. You should not only know that under default regime 35 AD is not eligible, you should also know that instead of 35 AD, on the 35 AD asset, you can claim depreciation instead under the default regime. Okay guys, so this was your discussion about 35 AD and section 35. See, listen to me. This capitalization point and all, nicely I have fed it inside your memory. Please go and show it off in the examination now. No point being humble in those 3 hours. In those 3 hours, go and show off as much knowledge as you have. This capitalization point and all, small tiny points, guys. You find these kind of points in rank holder answer papers. So these kind of points have to be there in your answer paper. That is when you know your answer paper is complete, and now there's no scope left for the examiner to deduct marks. Okay guys, this was about 35 AD and section 35. You understood, right? The most important point over here is this pre-commencement expense point. This is where confusion will happen. In section 35, pre-commencement is during 3 years before commencement. In 35 AD, there is no limit of 3 years. In section 35, there is no requirement of capitalization and all, but in 35 AD, you have to capitalize in the books of accounts. What? The pre-commencement expense. Okay guys. Then listen, a lot of times students get confused between 35 AD and unabsorbed depreciation. I'll tell you why they get confused. I'll first create the confusion in case you're not confused. See, I am having one specified business. It's eligible for 35 AD. In that business, I suffered a loss. That loss you will make me adjust against income from any specified business, whether claiming 35 AD or not. But I'm not having any such other business, guys. So therefore, you will make me carry it forward, and you will make me carry it forward indefinitely. Similarly, unabsorbed depreciation also you will make me carry it forward indefinitely. So because both specified business loss and unabsorbed depreciation, because both can be carried forward indefinitely, students have this thing in their mind that, oh, same to same. No guys, they are not same to same. Only thing is both can be carried forward indefinitely, but there are differences between the two, and that's what I'm talking to you about right now. Difference number 1, if you have a loss from a specified business where you're claiming 35 AD, that loss you can adjust against what? You can adjust against income from any specified business, whether claiming 35 AD or not. But if you have unabsorbed depreciation, that can be adjusted against what? That can be adjusted against any income except salary and casual incomes, guys. So are you noticing my very first difference? Then my second difference, this is connected to the return of income chapter, but I'm very sure you will be knowing this point already. See, unabsorbed depreciation you can carry forward even if you file ITR late. Generally, you must have learned if you file ITR late, you can't carry forward losses. But unabsorbed depreciation, even if you file ITR late, you can still carry forward unabsorbed depreciation, guys. But 35 AD loss, if you file a ITR late, you cannot carry it forward. It cannot be carried forward. So there are two differences. That's why I'm telling you, yes, no doubt, 35 AD specified business loss and unabsorbed depreciation, yes, no doubt, both can be carried forward indefinitely. Yes, as a common point, but there are also two differences, so be aware. Okay. Then comes my next point, and this you will enjoy, okay. See, listen. For one particular business, can I claim 10AA and 35 AD? 10AA SEZ and 3580. Can I claim for the same business both the benefits? No guys. Remember, 3580 is a problem maker. 3580 is a problem maker. So for the same business you can't claim 10AA also, 3580 also you can't claim. But similarly for the same business, can I claim 80JJAA? You know about 80JJAA? The section where if you're having new employees, additional employees, 30% of their salary you can claim as a deduction for 3 years. Chapter 60 we will see this guys. So for the same business you can't claim 80JJAA and 3580, even that is not allowed. So for the, see, if I'm having two businesses, then one business I can claim 80JJAA, one business I can claim 3580, that is allowed. I am asking you a situation where for the same business I want both. That is not allowed. Either I can claim 10AA or 3580. I can't claim both. Either I can claim 80JJAA or 3580. I can't claim both. Okay. But however, for the same business, can I claim 10AA and 80JJAA? The answer is yes. Why is the answer yes? The answer is yes because always remember, 3580 is a problem maker. 10AA and 80JJAA are not the problem makers. So for the same business, I can claim these two, not a problem allowed. In your CA final, you might learn something little different in this particular point because there are some judicial decisions as well regarding this. But at the intermediate level, judicial decisions are not a part of our syllabus. Therefore, this is what the conclusion will be by reading the bare act. So for the same business, can I claim 10AA and 3580? No. For the same business, can I claim 80JJAA and 3580? No. But for the same business, can I claim 10AA and 80JJAA? The answer is yes. Because in this third situation, the problem maker 3580 is not there. Only other two sections are there. These two sections we can claim together for the same business. Alright everybody's clear, right? Only one more point is there. Before I come to that point, look at this extra GAN point. You have to tell me whether these are specified businesses or not. Warehousing for storing sugar is a specified business. Warehousing for storing agricultural produce is also a specified business. Agricultural produce is nothing but food grains. So warehousing for storing food grains, it comes under agricultural produce. So even this is specified business. So warehousing for storing sugar, warehousing for storing agricultural produce, warehousing for storing food grains, all of this will come under specified business. But however, warehousing for storing edible oil is not a specified business. Be careful. Lot of times this has confused students in the exam. So you be aware. Okay. Warehousing is specified business provided it is for storing sugar or agricultural produce. Why am I putting food grains also in this list? Because food grains is nothing but agricultural produce. But edible oil is not specified business. Okay guys. So in our 3580 discussion, we first spoke about the preliminary points. Then we discussed about pre-commencement expenses. Then we discussed what if I'm suffering a loss in a business where I'm claiming 3580. Then we discussed the differences between 3580 and 35, specified business and scientific research. Then we spoke about 3580 loss and unabsorbed depreciation. Then we discussed about how 3580 is a problem maker, and then one small extra point I told you over here. Now only one last concept left in 3580. What if I purchased an asset for 3580 specified business, claimed 3580 deduction, and what if I start using that same asset for some other purpose now? Or what if I start selling off that asset, then what happens? So this is an important point. They have not tested this in the examination at all. So we will ensure that we know this really well, so that if they ask this in the examination, we are ready. See, very simple point, okay. Generally, I've seen students get terribly confused in this entire thing. So I've made it very simple for you. 3 simple situations, guys. Each of the 3 situations, we'll see what is the tax treatment. So what is my situation? My situation is, there's a 3580 asset, which means an asset which I'm using for my specified business. So when I purchase the asset, I got 3580 deduction. Now I'm selling away the asset. Now what will happen? See, be careful. I'm not talking about sale of scientific research asset. I'm talking about sale of 3580 asset. Okay. Now see, before I enter into the 3 situations, let me give you some preliminary points. Point number 1. For if I'm claiming 3580 deduction, then for the same asset, will you let me enjoy depreciation under section 32 also? No. You can enjoy any one. You can't have both for the same asset. Then comes my second point. Once you claim 3580 deduction for an asset, you have to continue to use that asset for specified business for how many years, guys? You have to continue to use that asset for specified business for 8 years. So basically, during these 8 years, you can't use the asset for some other purpose. Okay. These are my 2 points. Now listen to me, my first situation. In my first situation, what happened is the second point got violated by my SSE. That is, during the 8 years itself, my SSE started using that 3580 asset for some other purpose, which means there's a violation, guys. So because it's a violation, there will be consequence. So number 1, there will be a consequence over here because within 8 years itself, you're starting to use for other purpose. And number 2, because you're using it for other purposes, now you should get depreciation also. So what is the consequence, guys? Long back when you purchased the asset, you would have enjoyed 3580 deduction. From the 3580 deduction, I will subtract deemed depreciation. Now, why am I calling it deemed depreciation? Tell me, all these years, did you give me depreciation on the asset? No, you said that if I'm claiming 3580, I can't get depreciation. But I will subtract deemed depreciation, which means I will imagine what if I had claimed depreciation. Notional depreciation I will subtract. So from 3580 deduction, I will imagine that I had claimed depreciation all these years. So notional depreciation, imaginary depreciation, deemed depreciation I will subtract. I will find the net number. This net number will be taxed in my PGBP head. This will become the consequence. Understanding everybody? So point number 1, during 8 years itself, if I start using my 3580 asset for some other purpose, there will be a consequence. Consequence is that from the 3580 deduction, I will subtract deemed depreciation. The net number will become taxed under PGBP head. Okay. Now second point, because I'm using it for other purposes, now I want depreciation also. So which means the asset has to enter into the block. So point number 1, at what value will it enter into the block? This number that we found, no, just now, this 3580 deduction minus deemed depreciation, this number only, same number only, will enter into the block also, and once it enters into the block, you can start claiming depreciation. Now listen guys, now where is this asset? It is in the block. Now later, if you now sell the asset, it's a part of the block now. After this, if you sell away the asset, then it becomes a usual sale of depreciable asset. Generally, when you sell the depreciable asset, what do? You check whether the block is empty, block is not empty. If the block is empty, then no depreciation. You will straight away have capital gains. If the block is not empty, you will first try for depreciation. If depreciation is not possible, then only capital gains. So usual depreciable asset. Same thing only you will do even over here. Understanding? So this was my first situation guys. So first situation, listen carefully, I'm repeating it multiple times because I know many of you are listening to this for the very first time. So whenever you sell away a 3580 asset, 3 situations are possible. Situation number 1, during 8 years itself, you started using it for some other purpose. So there is a violation. Because it's a violation, you will first have a consequence. The consequence will be 3580 deduction minus deemed depreciation. The net number will be taxed for you under the PGBP head. Then number 2, because you're using it for other purpose, you will ask for depreciation, which means the asset has to enter into the block. That same number which you taxed in PGBP head, that same number will enter into the block. On that number, you will claim depreciation. Okay. Now later when you sell the asset, what will happen? The asset is now in the block. So you will treat it just like any other depreciable asset. Okay. Then comes my second situation. Come on everybody. In my second situation, I am using the asset for some other purpose only after 8 years guys. So now tell me, is there any violation? Now I did not do any violation guys. In the first situation, I used the asset for other purpose during 8 years itself. So I committed a violation. So therefore you put consequence on me. But over here in my second situation, I am using it for other purpose after 8 years only. Which means tell me, am I doing any violation? No guys. So will you put any consequence on me? No consequence on me. Instead, because I'm using it for other purpose, you will just give me depreciation guys. So if I'm asking for depreciation, it means asset has to enter into the block. But here at what value will it enter into the block? At 0 value, it will enter into the block. Okay. Then later, whenever you sell away the asset, what will happen? Now it's a part of the block. So when you sell any asset which is a part of the block, usual depreciable asset sale, same thing only you will do even over here. You will check whether the block is empty, block is not empty. If the block is empty, you will have capital gains. If the block is not empty, you will try for depreciation. If depreciation is not possible, then you will have capital gains. Understanding? Here, you are using it for other purpose after 8 years. So there is no violation. Because there is no violation, there is no consequence. I will not tax anything under PGBP. There is no violation. Just that straight away I will give you depreciation. To give depreciation, first asset has to enter into the block. It will enter into the block at 0 value. Now when you sell it, I will treat it just like any other depreciable asset. Okay, perfect. Now comes my situation 3. In situation 3, I did not use the asset for any other purpose guys. Only if I use for any other purpose, only then you will think of giving me depreciation and all. No, I did not use it for any other purpose. I directly sold it. Now this point is irrespective of the 8 years, which means there is no rule that you should not sell within 8 years. There is no rule like that. The only rule is that during 8 years, you should not use for any other purpose. You should continue to use for specified business only for 8 years. That's the rule. But there is no rule that you should not sell within 8 years. So whenever you sell the asset, only thing is you sold it directly. You did not use it for any other purpose. You directly sold the asset. Whether you sold it within 8 years, whether you sold it after 8 years doesn't matter. But you directly sold the asset. So when you directly sell away the asset, whatever is the selling price, that will be taxed for you under the PGBP head. That's all, guys. So 3 situations. In my first 2 situations, you're using the asset for some other purpose and then you're selling. In the third situation, you're directly selling. When you use the asset for some other purpose, I will check. Did you use it within 8 years or are you using it for other purpose after 8 years? If you're using it within 8 years, then violation. So consequence also will be there. Depreciation will also be there. But if you're using for other purpose after 8 years, then no consequence, only depreciation. But however, if you don't use the asset for any other purpose and if you directly sell it, then in that case, the selling price will simply get taxed under PGBP. Story over. Alright everybody, so this was about your discussion with respect to sale of 35AD asset. So I'll give you one final revision. So there are 2 possibilities, guys. Possibility number 1, you used the 35AD asset for other purpose and then you are selling it. So in this case, you will check that did you use for other purpose within 8 years or did you use for other purpose after 8 years. If you're using for other purpose within 8 years, then there's a violation. So because there's a violation, there will be consequence and also you can claim depreciation. So the consequence will be 35AD deduction minus whatever depreciation, deemed depreciation, net number will be taxed for you in PGBP head. Then for depreciation, some number has to enter into the block, same number will enter into the block. Then if you're going to use it for other purpose after 8 years, then there is no consequence, there's no violation, no consequence. Straight away depreciation. For depreciation, the asset has to enter into the block, but it will enter into the block at nil value, okay? Then what if you don't use the asset for other purpose? Instead, what if you directly sell away the asset? Here doesn't matter whether you're selling within 8 years, whether you're selling after 8 years, doesn't matter. If you directly sell away the asset, the selling price will simply be taxed for you in the PGBP head. Story over. Alright, now no confusion. Moving on to my next discussion about imported plant and machinery, something very interesting coming up. Listen to me carefully, it might be an eye-opener for many of you. See, this concept of imported plant and machinery is relevant for us in 2 places, additional depreciation and 35AD. Let me talk about additional depreciation first. In additional depreciation, we know that only for plant and machinery we will get additional depreciation. We also know that we have some ineligible plant and machinery. Like for example, if I have second-hand plant and machinery, it is ineligible for additional depreciation. For second-hand plant and machinery, I will not get additional depreciation. Now, this second-hand plant and machinery can be Indian second-hand plant and machinery or it can be imported second-hand plant and machinery, it doesn't matter. Any second-hand plant and machinery, no additional depreciation. Are you listening to me? Whether Indian second-hand, whether imported second-hand is second-hand and for second-hand plant and machinery, no additional depreciation. Which means, do you agree with me that additional depreciation does not differentiate between Indian second-hand and imported second-hand? It doesn't differentiate. Okay guys, first point, simple point. Then comes section 35AD. In section 35AD, guys, there's a point which I haven't spoken to you about till now. That point says that second-hand plant and machinery divided by total plant and machinery into 100. If you do this calculation, this has to be less than or equal to 20. In simple words, second-hand plant and machinery should not be more than 20% of total plant and machinery. It should be within 20% of total plant and machinery. Okay. Now, what will happen if it is more than 20? If this is more than 20, then in that case, my assessee will be ineligible for 35AD. That is, guys, for that particular business, we can't claim 35AD. Okay. Now, see a very important point. The whole climax comes over here. For the purpose of 35AD, when I say second-hand plant and machinery, I am talking only about Indian second-hand plant and machinery. If the plant and machinery happens to be second-hand, and if it is imported second-hand, which means it has never been used in India, if it is imported second-hand, for the purpose of 35AD, it will be treated as if it is new plant and machinery. Okay guys, understanding? So for additional depreciation, if you see Indian second-hand, imported second-hand, we don't differentiate. Second-hand is second-hand and for second-hand, no additional depreciation. But for 35AD, we differentiate. For 35AD, Indian second-hand, we consider as second-hand. But imported second-hand, which has never been used in India, we don't even consider it as second-hand. Okay guys, this one small point, remember. Then comes my next discussion about tax on non-monetary perquisite. This also I'll explain to you over here, okay. Listen to me carefully. Let's take one small example. Let's say employer, employee, 2 people in the story. Employer, for example, has given RFA to the employee. Now, do you agree, first of all, for the employee, this RFA is going to become a perquisite, guys. It's going to become a non-monetary perquisite, guys. The reason why I'm calling it as non-monetary perquisite is because it is in kind. Okay. So, the employer has given some non-monetary perquisite to the employee. Now, for the employee, this is a taxable perquisite. So, for the employee, it's a benefit. For the employee, this RFA will be taxable under the salaries head. But whatever is a tax obligation, whatever is a tax liability on this RFA, whose obligation is it? Employee's obligation. But now what happens is this tax on this RFA, let us say it is paid by the employer. Now this is the whole subject matter of our discussion right now, and that is tax on non-monetary perquisite, which is actually the employee's obligation. What if it is paid by employer? Okay, see, RFA is not the subject matter over here. The subject matter is tax on the RFA, which is paid by the employer. Now if you see, this also becomes a benefit for the employee. I'm not sure if you're able to see this, but according to me, the employee is getting two benefits, guys. The first benefit that the employee is getting is the RFA, the non-monetary perquisite. And the second benefit that the employee is getting is a tax on non-monetary perquisite, which actually employee was supposed to pay, but has been paid by employer. So my employee is getting two benefits. My whole discussion is about this tax on non-monetary perquisite paid by employer. First of all, do you agree for the employee it's a benefit? For the employee, even though it is a benefit, still it will be an exempt benefit. It will not be taxable for the employee. I am not saying RFA is exempt. I am saying the second benefit which my employee is getting, tax on non-monetary perquisite paid by employer, that will be an exempt benefit for the employee. Okay. Now talking from the employer's point of view, for the employer, the tax that the employer has paid for the employee, for the employer it's an expense, and because it is for the employee, for the employer it's a business expense. So therefore you will come to the PGBP head, but under the PGBP head, for the employer this expense will be disallowed. Got it, guys? That's all. Simple story over. So my whole concept over here is not about RFA. My concept right now is tax on the RFA, tax on non-monetary perquisite, which was actually supposed to be paid by the employee, but it has been paid by the employer. So it is employee's obligation met by the employer. No doubt it's a benefit for the employee, but for the employee under the salaries head, it will be an exempt benefit. No doubt it is an expense for the employer, that to connect it to his business or profession, but still for the employer that expense will be disallowed under PGBP. Okay, guys. Then moving on to my next discussion, I'm talking about three sections, or I should say three clauses under the 40A series, and that is 40A1, 40A1A and 40A3. So our first focus will be on 40A1 and 40A1A, on just these two. If you understand 40A1 properly, then 40A1A will become very easy, guys. Both the sections are very simple. In both the sections, we have a song, 3, 2, 1. So basically 3 conditions, 2 responsibilities and 1 violation. So we'll see it. You'll understand, nothing to worry. Let's focus on 40A1 first. I'll first put 3 conditions on you. Condition number 1, assessee should have incurred some expense relating to his business or profession, but that expense should not be salary. Condition number 2, now if you're incurring expense, you have to make payment. So either you're making payment outside India, or the other party to whom you have to make payment of the expense, that party happens to be a non-resident. So condition number 1, assessee has incurred an expense relating to his business or profession, but it should not be salary. Condition number 2, either payment is outside India or the other party is a non-resident. Condition number 3, to that transaction, TDS is applicable. So if these 3 conditions are fulfilled, I will put 2 responsibilities on you. Responsibility number 1, you have to deduct tax in the previous year. Responsibility number 2, after deducting tax, you have to remit the tax to the government within 139(1) date. Okay. So 3 conditions. If all the 3 conditions are fulfilled, I will put 2 responsibilities on you. Now out of the 2 responsibilities, even 1 responsibility if you don't fulfill, that is, if there's even 1 violation, then that's all. Welcome to 40A1 disallowance. If any 1 violation is there, like for example, you did not deduct the tax, or let's say you deducted the tax, but you did not remit the tax, even 1 violation if there is, then in that case 100% of the expense will be disallowed. But don't worry, assessee, this is not a forever disallowance. This is a reversible disallowance, which means in the future, whenever you rectify the default, that is, in the future, whenever you deduct and remit the tax, in that subsequent year, once again, I will allow the expense for you. So it's a reversible disallowance. It is not a permanent disallowance. Okay, guys. So 40A1, 3 parts in my song. First 3 conditions, then 2 responsibilities, and then 1 violation. Okay. Now with this knowledge, now come to 40A1A, guys. Even in 40A1A, same thing. 3 conditions, 2 responsibilities, 1 violation. What are the 3 conditions? Condition number 1, assessee has incurred an expense relating to his business or profession. Here that expense can also be salary expense, guys. No problem. So here itself you have your first difference between 40A1 and 40A1A. See, between 40A1 and 40A1A, there are only 3 differences. First difference, 40A1 does not apply to salary, but 40A1A also applies to salary. Okay. So condition number 1, assessee should have incurred some expense relating to business or profession, which can also be salary expense. Then comes condition 2. In 40A1, we had learned that assessee is making payment outside India, or assessee is making payment to non-resident. In 40A1A, that second condition will be exact opposite, guys. Assessee is making payment in India. Here it was outside India, so here I'll write in India, opposite. Here we had the word or, so here I'll write opposite. And here the other party was non-resident in 40A1, so in 40A1A I'll write opposite, I'll say resident. Are you getting my point? Yes. So in my second condition, the assessee is making a payment in India and the other party happens to be a resident. And condition number 3 is the same. TDS is applicable. So similar 3 conditions, guys. Condition number 1, assessee is incurring some expense relating to business or profession. Condition number 2, the other party is resident and payment is in India. And condition number 3, TDS is applicable. If all the 3 conditions are fulfilled, I'll put the same 2 responsibilities on you. Deduct tax in the previous year and remit tax within 139 date. Same thing, out of the 2 responsibilities, if there is minimum 1 violation, if you do even 1 violation, then welcome to consequence. What is the consequence? There will be disallowance. But how much disallowance? In 40A1, 100% expense we disallowed, but in 40A1A, only 30% we will disallow. Even this will be a reversible disallowance, which means don't worry assessee, for now I am going to disallow, but later whenever you rectify the default, that is later, once you deduct and remit the tax, in the subsequent year we will allow this 30% again for you. Are you understanding, guys? Yes. So totally how many differences do you see between 40A1 and 40A1A? Totally 3 differences, guys. Difference number 1, 40A1 is not applicable to salary, but 40A1 is also applicable to salary. Second difference, in 40A1 the payment is outside India or the other party is a non-resident. In 40A1A payment is in India and the other party is a resident. And the third difference, in 40A1 full 100% of the expense is disallowed, but in 40A1A only 30% of the expense is disallowed. Okay, guys, and in both 40A1 and 40A1A, don't forget your sequence, don't forget your steps, 3 conditions, 2 responsibilities, 1 violation. Okay, guys, can I give you another revision of the revision, please? It will take us 2 minutes, but I think it will give you a big difference on your preparation. Listen to me. So in 40A1, first I put 3 conditions on you. Condition number 1, assessee should have incurred an expense, but this expense should not be salary. Then condition number 2, the payment must be made outside India or the other party has to be a non-resident. And condition number 3, TDS is applicable on the transaction. If all the 3 conditions are fulfilled, then in that case you will put 2 responsibilities on me. Responsibility number 1, you will ask me to deduct tax in the previous year, and responsibility number 2, you will ask me to remit the tax to the government within 139 date. Out of the 2 responsibilities, if there is any 1 violation, then in that case you will disallow. How much you will disallow? Full 100% of the expense you will disallow under 40A1, but answer is not complete unless you say that this disallowance will be a reversible disallowance, which means in the future, in whichever year you deduct and remit the tax, whenever you rectify the default, in that year once again it will be allowed for you. Okay, now same thing, if I have to make it as 40A1A, what and all will change? 3 places it will change. Number 1, I will not exclude salary. 40A1A will also apply to salary. Number 2, payment has to be made in India and the other party has to be a resident. Second change. Third change, if there's even 1 violation, then 100% disallowance will not be there. Only 30% disallowance will be there. So 3 changes in 40A1A. Thorough, guys? Yes. Now listen. Whether 40A1, whether 40A1A, there's an escape route. See, I'll explain the whole escape route to you over here with the help of an example, okay? Let's say there are 2 people in the story, blue and green, okay? Now, blue has incurred rent expense of, let's say, rupees 60,000 to green, okay? So, for blue, this is an expense, guys. Same thing you agree, right? For green, it will be income. Right. For this expense, blue will become the payer of the expense and green will become the payee of the expense. I am discussing this entire example to you from the point of view of section 40A1A, not 40A1A. Okay. So 3, 2, 1, you will sing your whole song. So on Mr. Blue, you will put 3 conditions. Condition number 1, he has incurred an expense relating to his business or profession. Condition number 2, the other party is resident and payment is in India. Let's say it's fulfilled. And let's say TDS is applicable. So all my 3 conditions are fulfilled, which means 40A1A will apply. So you will put 2 responsibilities on Mr. Blue. Responsibility number 1, you will tell him to deduct tax. You'll ask him to deduct tax when, guys? In the previous year. Then responsibility number 2, you will ask him to remit tax when? Within section 139 date. Are you following, guys? Now let us and out of the 2, if he does even 1 violation, let's say he did not deduct tax in the previous year, so he has committed 1 violation. Therefore 30% of the expense you will disallow for him when? You will disallow for him in the current year, that is previous year 25-26. You will disallow for him. Nothing new I've told you till here. Whatever you already know only I've explained to you, just that I've made 1 example, 1 story, that's all. Okay, now listen, guys, who is suffering from this entire violation? Blue is suffering, the payer is suffering. Now there's an escape route. As per the escape route, even though Mr. Blue has not deducted tax in the previous year. Just keep following this red line that I'm drawing, okay? Even though Mr. Blue has not deducted tax in the previous year, but the other person, that is the payee, if this payee has properly filed his ITR within the applicable 139(1) date. Let's say for Mr. Blue, the 139(1) date which is applicable is 31st July 2026, and let's say by then he has filed his ITR, and let's say this is his due date, and let's say he has filed ITR on 30th July 2026, which means he has filed ITR within 139(1) date, guys. Now in this ITR, this 60,000 is going to be income for Green. So in this ITR, he has considered that 60,000 rupees as his income, and on this income he has paid tax to the government. Who? Mr. Green. Are you noticing, even though Mr. Blue, the payer, has not deducted tax and has not remitted the tax within 139(1) date, even though government did not get the tax from Blue on this transaction, still the other party, Green, has properly paid tax on this transaction. End of the day, government got the money, guys. So when this happens, even though Mr. Blue has done a violation, if the payee properly files his ITR like this, considers this transaction as his income, also pays tax on this transaction, then in that case, Mr. Blue will be deemed to be as if he is an assessee, not in default. We will assume it. I am using the word deemed, guys, because in reality he has committed a default, but I will assume as if he is not in default. But come on, guys, the most important point, when will you say he is not in default? You will say he is not in default. You will say that he is not in default only when the payee does all this. That is only when the payee files his ITR, which in our example is 30th July 2026, guys, which is nothing but previous year 26-27. So for Mr. Blue, in 25-26 you will first disallow. Then in 26-27, once Green files the ITR and does and pays tax and all that, so in 26-27 you will treat as if Blue is not an assessee in default. You will treat as if he has rectified the default. So in 26-27 you will reverse his disallowance for him. You will allow again that 30% which you had disallowed earlier, you will allow now. Are you understanding, guys? So for Mr. Blue, there will be two things. First, you will disallow the expense, 30% expense, first you will disallow. Then once Mr. Green, the payee, files his ITR and all, on the date on which he files ITR, on that date you will treat as if Blue is not in default anymore, as if he has rectified the default, you will assume. So that is obviously going to be the next year only, because you always file your ITR in the next year only. So in 26-27 year, it will be as if you have rectified the default, and you know very well 40A1 disallowance and all is reversible disallowance. So it's as if you have rectified the default in 26-27. So in 26-27 for Mr. Blue, you will reverse the disallowance. You will again allow that 30% number. So two things you will do. You will first disallow the expense in 25-26. Then later in 26-27, it will be allowed again for Mr. Blue. Getting my point, guys? This only is mentioned over here. Look at this. If assessee Blue has not deducted tax at source, but other party, in our example, who's the other party? Green. Other party, Green, that is a payee, has furnished his ITR properly on time. He has also considered that amount while computing his income. He has also paid tax on this income, and we also have a CA certificate furnished to this effect. If all these conditions are fulfilled, then in that case, my assessee, that is Mr. Blue, will not be deemed to be assessee in default, which means you will assume as if he is not in default when on the date on which the other party, the payee, files the ITR. So on the date on which the payee files his ITR, it will be treated as if assessee has rectified the default. So therefore on that date you will now reverse the disallowance. So there will be two things. First, in my current year 25-26, you will disallow the expense for Mr. Blue. 30% you will disallow in 40A1A, 100% you will disallow in 40A1. Then next year, that is in 26-27, once a payee files ITR, you will treat as if your assessee has rectified the default, and hence you will reverse the disallowance. Thorough, guys. Same escape route is applicable in 40A1 and in 40A1A. The same escape route with a little more extra points you will see once again in tedious chapter. That should not be too much of a worry for you at that time. So till then you should ensure you remember. Crystal clear with the whole thing, right? The main point is, even though Blue has not deducted tax, okay, Green has paid tax to the government. So end of the day, government got the money. So therefore, whenever Green files his ITR on that date, on 30th July 26, it will be as if Blue has rectified the default. So if Blue has rectified the default, you will reverse the disallowance. So first you will disallow in 25-26, then next year in 26-27, you will reverse the disallowance. Got it, guys? That's all. Okay. Okay, so this was your discussion on 40A1 and 40A1A. 3, 2, 1. 3 conditions, 2 responsibilities, 1 violation. Then don't forget the escape route. Okay, then comes 40A3, guys. This is a simple point. See, if I have incurred salary expense, okay, and if the other party happens to be a non-resident, or if I'm making the payment outside India, and let's say TDS is applicable, in this situation, can you apply 40A1A first of all? You can't apply 40A1A, guys, because in 40A1A we have to make the payment to a resident and payment has to be in India. This is non-resident or outside India. So 40A1A will first of all not apply. Well, 40A1 apply, guys. 40A1 generally applies when you make payment to non-resident and all, but 40A1 specifically excludes salary, right? So therefore 40A1 also will not apply. So in this situation we apply 40A subsection 3. Basically, if it is salary for which 40A1 is not applying, that salary will come to 40A3. So if I'm incurring salary and if the other person is non-resident or I'm making payment outside India and TDS is applicable, but however if the assessee neither deducts a tax nor remits a tax, then same thing, guys, 100% of the expense will be disallowed. Not 30%. 30% is only in 40A1A. In 40A1 also, in 40A3 also, in both of these sections, full 100% disallowance. Okay. So if it is salary and if you're making payment to a non-resident or outside India, 40A1 will not apply. So if 40A1 doesn't apply for salary, then you will come to 40A3. In 40A3, same thing, 100% disallowance. Okay. Then comes, so this was our entire discussion on TDS, guys, 40A1, 40A1A and 40A3. Now coming to our next discussion, section 40 clause B, another extremely important section, guys. It's going to be all about partnership firms and LLPs. Okay. First, let me build some background for you. Listen to me carefully. Let's say partnership firm or LLP. By the way, the same section 40B will apply for both, for partnership firm also, for LLP also. Okay. So partnership firm, LLP on one side and partner on the other side. Firm will always give to the partner totally 3 things, guys. Number 1, share of profit. Okay, about this we don't even have to discuss anything. We know very well that for the partner the share of profit will always be fully exempt. Okay, then the firm will give interest to the partner, interest on capital, interest on loan, and then firm will also give salary to the partners. Now our whole focus is going to be on these 2 things, interest and salary. Both of them are expense for the firm, both of them are income for the partner. So always remember, guys, whether interest, whether salary, you will apply section 40B. If 40B is applicable, 40B is fully from the point of view of the firm, guys. So you will always think from the firm's point of view, then only you will come to the partner's point of view. Crystal clear, guys? Come on, let's focus on each of these one by one. Let's focus on just the interest part first. Okay, so what is my situation now? My situation is the partnership firm or the LLP is giving interest to its partners. Now these partners, they can either be active partner or sleeping partner, it doesn't matter, we will not even differentiate. Okay, so when the firm is giving interest to the partners, from the firm's point of view, if you think it's an expense, guys, it's an expense relating to their business or profession, so therefore this expense will be allowed for the partnership firm, but maximum how much will be allowed for the partnership firm? Maximum 12% only will be allowed. Like for example, if the firm is giving 16% interest to the partners, only 12% will be allowed for the firm, the balance 4% will be disallowed for the firm. Okay, this is from the firm's point of view. Now we will come to the partner's point of view. Partner, whether active partner, whether sleeping partner, same provision only. From the partner's point of view, if you see, this interest income is going to be an income, and if you know, right, interest income generally goes into the IFOS head, but interest income which a partner gets from his firm, this will come under the PGBP head only, guys, and under PGBP head it will be taxable. But now a question will arise that how much will be taxable for the partner? Here one dialogue I will say. What dialogue? I will say that whatever interest is allowed for the firm, that interest only will be taxable for partner. Are you understanding? So how much ever is allowed for the firm, that only will be taxable for the partner. For the firm, 12% only you allowed, guys. So for the partner also 12% only will be taxed. Are you noticing? Partner is getting 16% interest, but only 12% you will tax for the partner. The balance 4% will be exempt for the partner. Simple, guys, very easy. So my main point over here is whatever is allowed for the firm will be taxable for the partner. That's why remember I told you, you will always first do computation from the firm's point of view. Then only you can say whatever is allowed for the firm will be taxable for the partner. Right, guys? That's why first always you will think from the firm's point of view. And I hope you've noticed, guys, did I make any differentiation between active partner and sleeping partner? No, whether active partner, whether sleeping partner, there was no special treatment. So no special treatment for sleeping partner. Okay, guys. So this was our entire discussion about interest to partners. Now coming to salary to partners. Again, tell me, from whose point of view will you think first? From the firm's point of view. You will see how much is allowed for the firm. Then you will say whatever is allowed for the firm will be taxable for the partner. Okay. So coming back to my chart over here. I'll draw one diagram for you. This time the partnership firm or the LLP is giving salary to the partner. Now see guys, here the partner has to be active partner only. In interest we did not differentiate between active partner and sleeping partner, but for salary we will differentiate. Here the partner has to be active partner only. Okay guys, now listen to me carefully. Again same thing, we'll always think from the firm's point of view first. From the firm's point of view, salary is an expense guys. This expense is relating to business or profession. So therefore this expense will be allowed for the firm. But how much will be allowed for the firm? It depends upon a maximum limit. What is the maximum limit? We'll see in a little while. Okay. Now comes the partner's point of view. For the partner, if you see, it's an income. And this salary income will go into which head? Not salaries head, guys. Because there's no employer-employee relationship between the firm and the partner. There's a business agent relationship. There's no employer-employee relationship. Therefore, it will not go into the salaries head. It will come under the PGBP head only. Under the PGBP head, it will be taxable. But how much will be taxable? Same thing, guys. Whatever is allowed for the firm will be taxable for the partner. So even over here you will always first do the calculation from the firm's point of view. You will see how much is allowed for the firm, and then you will say whatever is allowed for the firm will be taxable for the partner. You're getting it guys? So when it comes to a salary, now the only major thing that we have to learn is this maximum limit. Okay guys, but please notice, see I'll show you even over here. Okay, please notice for the firm the entire discussion will apply only if the firm is paying salary to the active partner. Right guys, only then, only for the active partner this entire chart will apply. What if the firm is paying salary to the sleeping partner? See, if the firm is paying salary to the sleeping partner, you will not even check anything else. If the firm is paying salary to the sleeping partner, you will straight away disallow it fully guys. Nothing else matters, no maximum limit, no if, no but, no condition, nothing. If the firm is paying salary to sleeping partner, you will fully disallow it for the firm. That's all, story over. So my entire discussion for salary will apply only if the partner happens to be an active partner. So if the firm is paying salary to active partner, then for the firm it will be allowed, but how much? Subject to one maximum limit which we will be learning. Okay. From partner's point of view, if you see, for active partner it's an income, salary is an income. Whatever is allowed for the firm will be taxable for the partner. But what about sleeping partner guys? Same thing you will say whatever is allowed for the firm will be taxable for the partner. But if the firm is paying salary to sleeping partner, how much is allowed for the firm? Nothing is allowed for the firm. It is fully disallowed. Nothing is allowed for the firm. So therefore for the partner, nothing will be taxable. It will not be taxable. Are you understanding? Yes, see, if partnership firm is paying salary to sleeping partner, then for the firm, the salary will be fully disallowed, guys. So how much will be allowed? Nothing will be allowed. So for the partner, how much will be taxable? Whatever is allowed for the firm will be taxable for the partner. For the firm, if nothing is allowed, for the partner also, nothing will be taxable. Getting my point? So if you see in the question, the partner is a sleeping partner, interest will not change, but salary will change. And salary, straight away shortcut you will have, no calculations, nothing you have to do. As soon as you see that firm is paying salary to sleeping partner, for the firm, nothing will be allowed. For the partner, nothing will be taxable. Okay guys, so our whole focus now is what if the firm pays salary to active partner. Okay guys, for the firm that salary will be allowed but subject to one maximum limit. Now what is that maximum limit? That maximum, for that maximum limit, we first have to compute something called as book profit. What is book profit? Wait, we'll come to it a little later. First let's talk about the maximum limit. Okay, I'll discuss it with you over here. You'll have to see how much is a book profit. Sometimes the book profit happens to be a negative number. That is if it happens to be a loss. In that case, the maximum salary which will be allowed for the firm will be 3 lakhs for all the partners put together. Maximum salary that will be allowed for the firm will be 3 lakhs. Okay. But if the book profit happens to be a positive number, that is it's a profit number. Okay. Like for example, let's say it happens to be 14 lakhs. Okay. So in that case, what you will do is you will split this book profit number into two parts. The first 6 lakhs and then the balance. Balance will be how much? 14 lakhs minus 6 lakhs, balance will be 8 lakhs. On this 6 lakhs, 90% of the 6 lakh number, which is 5,40,000 or 3 lakhs, whichever is higher, which is higher, 5,40,000. Okay. On the balance 8 lakhs, straight away 60% you will calculate, which over here will be 4,80,000. So if my book profit happens to be a positive number, which in my example is 14 lakhs, then the maximum working partner salary which will be allowed for this firm will be 5,40,000 plus 4,80,000, which will be 10,20,000. Are you understanding, everybody? Yes, this is a maximum working partner salary that will be allowed for the firm. So how much salary will be allowed for the firm maximum? If the firm is paying salary to sleeping partner, then nothing will be allowed. If the firm is paying salary to the active partner, then you will see how much is a book profit. If the book profit happens to be a loss, if it's a negative number, then maximum allowable salary will be 3 lakh only for the firm. All the partners put together, maximum only 3 lakh will be allowed for the firm. But if it's a positive number, if it's a profit, then in that case, on the first 6 lakhs, 90% of the book profit or 3 lakh rupees, whichever is higher, whatever is the balance book profit on that 60%. Okay, so with this you will get your maximum allowable working partner salary. Like in my example, this 10 lakh 20 is a maximum limit. What if the actual salary which the firm is paying to the partners is only 9 lakhs, guys? Then in that case 9 lakh is within the limit, so 9 lakh will be fully allowed. But what if the actual salary which the firm is paying to the partners put together is 11 lakhs? Then in that case my actual salary is more than the maximum limit, so therefore for the firm only 10 lakh 20,000 only will be allowed for the firm. Getting it? This is a maximum limit. Alright, now listen, let's talk from partner's point of view. This entire discussion was from the firm's point of view, guys. Let's talk from the partner's point of view. Let's take some more numbers, okay? Listen to me. Let's say for this firm, the maximum allowable working partner salary is 10 lakh 20,000, but the actual salary which the firm is paying to the partners, let's say the firm is having 3 partners. Now, out of the 3 partners, to 2 of them, the firm is paying, let's say, 5 lakh rupees per partner, so total 10 lakhs. And to the third partner, to the last one, the firm is paying, let's say, 6 lakh rupees. So the total salary which the firm is actually paying to the partners is 16 lakh rupees, which is more than the maximum limit. Okay. So from the firm's point of view, if you see how much will be allowed for the firm, 10 lakh 20 only will be allowed for the firm. Okay. Now I will change my question. My question will be how much will be taxable for the partners. So partner 1, partner 2, partner 3. If you look at the actual salary, partner 1 is getting 5 lakh rupees, partner 2 is getting 5 lakh rupees, and partner 3 is getting 6 lakh rupees. So for the partner, how much will be taxable? How much ever is allowed for the firm? For the firm, 10 lakh 20 is taxable. This is what will be, for the firm, 10 lakh 20 is allowed. So this 10 lakh 20 is what will be allowed for all the partners put together. The question now is, how will you split this 10 lakh 20 between the 3 partners? Equal ratio. 1:1:1 ratio. Profit sharing ratio. Capital contribution ratio, nothing, no. You will split this 10 lakh 20 between the 3 partners in the same ratio in which they got salary, guys. So that is 5:5:6. In this ratio, you will split this 10 lakh 20 between all the 3 partners. Are you understanding? Put it into your head, register it in your memory. You will not split this 10 lakh 20 between the 3 partners in the capital contribution ratio, no. Profit sharing ratio, no. Equal ratio, no. You will split in the same ratio in which they got salary, which over here is 5:5:6. So 10 lakh 20,000 into 5/16, 3,18,750 will be taxable for partner 1, 3,18,750 will be taxable for partner 2, and 10,20,000 into 6/16, that is 10,20,000 into 6/16, which is 3,82,500. This is what will be taxable for partner 3. Are you understanding? Yes, so you will split this amount amongst the 3 partners in the same ratio in which they are getting salary. Crystal clear, guys? Yes, so this was our entire discussion about salary. Now, only thing we have to understand is what is book profit. Before we go to that, one quick revision of the revision, let's do, guys. So a firm gives to partners 3 things: share of profit, interest, and salary. Share of profit is always exempt for the partner, nothing more to discuss. When it comes to interest, for the firm, maximum 12% interest only will be allowed, balance will be disallowed. Whatever is allowed for the firm will be taxable for the partner. Doesn't matter whether the partner is active partner or sleeping partner. For interest, it doesn't matter, okay? Then we learned about salary. For salary, if you see, if the firm is paying salary to sleeping partner, for the firm it will be fully disallowed. For the sleeping partner, nothing will be taxable. But if the firm is paying salary to the active partner, for the firm the salary will be allowed subject to a maximum limit. The maximum limit depends upon what is the book profit of the firm. If the book profit happens to be a negative number, then maximum 3 lakh will be allowed for the firm. If the book profit happens to be a positive number, then on the first 6 lakhs, 90% of the book profit number or 3 lakhs, whichever is higher, is what will be allowed maximum. And if on the remaining book profit, 60% of the excess, okay? So with this you will get the maximum limit. Then you will see in reality what is the actual salary which the firm is paying to the partners. If the actual salary is more than the maximum limit, then you will restrict it. Okay, so how much ever is allowed for the firm, that much only will be taxable for the partners. In what ratio? In the same ratio in which they got salary, not profit sharing ratio, in the same ratio in which they got salary. Okay guys, now comes our last discussion in 40B, and that is how do you calculate this book profit. What is this book profit? This book profit is nothing but normal usual PGBP guys. See, to calculate PGBP you have to follow chapter 4D provisions. Whatever you're learning in your PGBP chapter, this is nothing but chapter 4D guys. Like your Income Tax Act is divided into chapters. Chapter 4D is that chapter of your Income Tax Act which talks about all the PGBP provisions. So you will do the normal PGBP computation as per chapter 4D. Whatever you're learning, section 35, your depreciation, your 35AD, your 40A1, 40A1A, your usual PGBP adjustments. You will apply all your PGBP adjustments and normal usual PGBP you will compute. Just that you should not debit salary to partners. If you have already debited salary to partners, you will reverse it, you will add it back. Understanding? So book profit is nothing but normal PGBP just before subtracting salary to partners. Alright guys, all other PGBP adjustments you should adjust. Interest to partners, you should adjust. Section 35 scientific research, 35 AD deduction, depreciation, all of these you should adjust. Even unabsorbed depreciation is a PGBP chapter adjustment guys. Even this you should adjust. All PGBP adjustments you should adjust except salary to partners, which means salary to partners you should not debit. If you have already debited, you will have to reverse a debit. How will you reverse a debit? By adding it back. That is your book profit number. Okay, to compute book profit, will you adjust business losses also? No, because adjusting business losses is a set off and carry forward chapter adjustment, not PGBP chapter adjustment. Are you understanding? All PGBP adjustments you will do. Chapter 6A will you adjust? No, not chapter 6A adjustments. Only PGBP adjustments you're supposed to adjust. You're getting my point guys. So book profit is nothing but normal PGBP. What's the difference between book profit and PGBP? Only one difference. Book profit, see I'll show you this, okay, you'll definitely understand. Book profit minus salary to partners, you'll get your PGBP. Now are you understanding? So book profit is nothing but PGBP, normal PGBP, just that you should not adjust salary. It is before adjusting salary. Now you understood, right? So when you're doing book profit calculation, all PGBP chapter adjustments you will consider except salary to partners. Okay? The biggest and the most important observation for you is even unabsorbed depreciation is a PGBP chapter adjustment. It's not a set off and carry forward chapter adjustment. It is a PGBP chapter adjustment. So even this you will consider when you're computing book profit. Got it guys? So this was a very important section, section 40 clause B. I hope you're nice and thorough guys. Each point over here I've spoken to you about from the partner's point of view also, from the firm's point of view also, from 360 degree I think I've given you the view. Now listen, there's another point over here. It's an untested area, but be careful. If the salary or interest is inconsistent with the partnership deed, or if it is not authorized by the partnership deed, then the salary or the interest will not even be allowed. See, you're getting my point. At the end of the day, the interest or the salary which the firm is giving to the partner has to be as per the partnership deed. If it is inconsistent with the partnership deed, or if the partnership deed does not even authorize salary or interest, still if the firm is giving salary or interest to the partners, 12%, book profit, 6 lakhs, 90%, all these calculations will go into the dustbin. Nothing you will do. You will straight away disallow the whole salary. You will disallow the whole interest for the firm. You're getting my point? So the salary or the interest has to be consistent with the partnership deed. It has to be authorized by the partnership deed. Only then the whole of section 40B will apply. If the interest or salary is not authorized by the partnership deed, then it will not even be allowed. Nothing will be allowed in that case. Will not be allowed. Okay, this was section 40 clause B. Now comes my 40A subsection 2. Another very important section, but a small, simple, sweet little section only. Here there are 3 conditions guys. So basically I'll tell you what has happened over here. Okay, assessee is incurring one expense. Like for example, assessee is paying salary expense. It can be any expense. He is paying it to his brother guys. Now his brother is only a BCom graduate. So in the if this brother goes to any other organization, maximum he will get only, let's say, 20,000 per month as salary guys. But assessee is paying to his brother 30,000 rupees per month salary, which means don't you think assessee is paying extra salary? And extra salary assessee doesn't mind paying because brother, he's paying to his brother. So money is staying within the family only. So all this we don't want. So whenever the assessee is incurring excess or unreasonable expense and the other party is a relative, then we will disallow the excess or the unreasonable expense. expense. So in our example, the excess is 10,000 rupees per month. No, this will get disallowed under 40A subsection 2. Okay, so for this only I'm giving you these conditions now. Condition number 1, assessee has incurred an expense. In our example, salary expense. Condition number 2, the expense is excess or unreasonable. Yes, you will look at the market rate and you will see how much my assessee is incurring. Market rate is 20,000 per month. My assessee is incurring 30,000 per month. So 10 rupees per month excess assessee is incurring. So the second condition is the expense has to be excess or unreasonable. And the third condition is that the other party has to be relative. Relative means what over here? This diagram. Plus spouse with arrows, which means you will draw a plus. You will write spouse. So this is plus spouse with arrows. So which means if I am the assessee, then my brother, my sister, my parents, grandparents, great-grandparents and so on, my children, grandchildren, great-grandchildren and so on, and my spouse. So plus spouse with arrows. Okay, here a lot of times in the examination they say brother-in-law. See, brother-in-law will be spouse's brother. Okay, now spouse's brother is not covered. So if the other party is not a relative, then 40A subsection 2 will not apply. 40A subsection 2 will apply only if you're incurring an expense. It has to be excess or unreasonable, and the other party has to be a relative. Only then 40A subsection 2 will apply. If 40A subsection 2 applies, you will not disallow the whole expense, guys. No, only the excess. In our example, the excess of 10,000 rupees per month, that alone you will disallow. Okay guys, then comes 40A subsection 3 and 40A subsection 3. Little bit about these sections I've already told you. Let's talk about 40A subsection 3 first. In 40A subsection 3, assessee is incurring an expense in the previous year. Now assessee is making payment of the expense. If payment is more than 10,000 to a single person in a single day against a single invoice, assessee, you should make the payment in specified mode only. If you make the payment in non-specified mode, then that expense will be fully disallowed. Like for example, let's say my assessee is paying rent. Okay, he's paying 11,000 rupees rent, and this rent, so therefore first of all assessee incurred an expense, guys. It is relating to his business or profession, and he's making payment of this expense. In one single day he's making payment of this expense. Amount is more than 10,000. You will trouble the assessee. No, you will say make the payment in specified mode only. But no guys, he made the payment in cash. He made the payment in non-specified mode. Now tell me, will you, first of all, you know assessee has done some violation. You know there will be some disallowance. My question to you is, if assessee makes a payment of more than 10,000 in non-specified mode, will you disallow 11,000 fully, or will you disallow only the excess of 1,000? Fully disallowed. So whole 11,000 you will disallow, not just the excess, guys. Okay, simple, right? So in 40A subsection 3, assessee is incurring an expense. It is more than 10,000 rupees. Assessee is making payment of more than 10,000 rupees. If assessee is making payment of more than 10,000 rupees, the payment should be in specified mode only. You know the specified modes, guys: account payee check, account payee bank draft, ECS, and electronic payment. If assessee makes a payment in non-specified mode, full expense will be disallowed. Okay, then what is 40A3A? 40A3A is a close cousin of 40A subsection 3. 40A3A says assessee has incurred expense in some earlier year. This is the biggest difference, guys. In 40A subsection 3, assessee is incurring expense in the previous year. Assessee is also making payment also in the same previous year. But in 40A3A, assessee incurred expense in some preceding previous year, and assessee is making payment now in the previous year. So there are two different years involved. That is when 40A subsection 3A comes into the picture. So assessee incurred expense long back. Now in the current year, assessee is making payment. If this payment is more than 10,000 rupees to one single person in one single day against one single invoice, assessee, please make the payment in specified mode only. If you make the payment in non-specified mode, then I will not disallow the expense. Instead, I will assume it to be your income. It will be deemed income. Are you understanding, everybody? See, listen to me, okay? If I incurred expense in the previous year, and if I'm also making payment in the same previous year, okay, and if this payment is more than 10,000 rupees in one single day to one single person in against one single invoice, then you will apply which section? First of all, you will apply 40A3 or 40A3A, guys. One single year only is involved, so you will apply 40A3. Now 40A3 says, listen, payment is more than 10,000, so make the payment in specified mode. But no, I made the payment in non-specified mode. Then what will you do, guys? You will disallow the entire expense. You will disallow it fully. Okay, but what if I incurred the expense in some preceding previous year, but I'm making payment of that expense now in the current year? Payment happens to be more than 10,000 rupees to one single person against one single invoice in one single day. Again, you will tell me to make the payment in specified mode, but no, I disobeyed you. I made the payment in non-specified mode. Now which section will you apply? 48.3 or 48.3a, guys? Two different years are involved. So here you will apply 48.3a. In 48.3a, when there is a violation, we don't disallow. We don't use the word disallow. Instead, that amount which you made payment, right? Like for example, 11,000 I made payment in non-specified mode. This 11,000 will become deemed income. It will become deemed income. Actually, it's an expense, but you will assume it to be income. It will be deemed to be income and it will be taxable for you under the PGBP head. Okay, so in 40A subsection 3 and 40A subsection 3A, if you see, there are two main things. In 40A subsection 3, in 40A 3, one single previous year is involved. I incurred expense in the current year. I am also making payment in the same current year. In 40A3, two different years are involved. Okay. Then in 40A3, I use the word disallow. In 40A3, I don't use the word disallow. I say deemed to be income. Taxed as deemed income. Okay, guys. Then listen. Generally, the limit is 10,000 rupees. But however, if I have to make payment to, if I have to make payment of transportation expense, or let's say freight expense, then the limit will become 35,000. Then if I'm making payment of retirement benefit, for that the limit will become 50,000. Both 48.3 and 48.3a. Okay. See, remember in section 35 AD also we say that if the payment is more than 10,000, payment has to be in specified mode. Even in our actual cost discussion also we said that if the payment is more than 10,000, payment has to be in specified mode. So in 35 AD and in actual cost, you have only one number, 10,000 number. You don't have the 35,000 number here. You don't have the 50,000 number here. I hope you remember this point. I had spoken about this point to you. I had invested a lot of time on this particular point in our actual cost discussion. You're able to recall, right? But however, in section 40A subsection 3 and in 40A subsection 3A, in these two sections, if you see, we have three numbers, guys. General limit is 10,000 rupees, but if you're making payment of transportation expense and all, the limit changes to 35,000 rupees. And if you're making payment of retirement benefits to your employees, the limit changes to 50,000 rupees. Okay, guys, then we have rule 6DD, which talks about some 4-5 situations where these sections 48.3 and 48.3a and all are not applicable. Number one, when you are making payment to bank, LIC, RBI, government, like for example, let's say I borrowed a loan from the bank, so I have to pay interest to the bank. Now that interest I am paying to the bank, so I'm making a payment to the bank. So even if it is more than 10,000, guys, I can pay in whatever mode I want. I can pay in non-specified mode also, no problem. There will be no disallowance. Understanding? So whenever you make payment to bank, LIC, RBI or government, you can make the payment in whatever mode you want. Then when you make payment to a cultivator or to a grower, like for example, let's say you're making payment to a farmer, you want to purchase agricultural products from him, so you're making payment to a farmer. Or let's say you're making payment to a person because you want to buy some animal husbandry products like meat, animal meat, hide, skin and all. Or let's say you're making payment to a person who's involved in dairy farming, milkman, poultry farming, fishing or horticulture. Then to these persons you can make the payment in whatever mode you want, doesn't matter. In simple words, if you're making payment to a farmer, pay in whatever mode you want. If you're making payment to a milkman, pay in whatever mode you want. If you're making payment to a fisherman, pay in whatever mode you want. Understanding, guys? Then comes your third point. Let's say you're making payment to a person. Why? Because you want to purchase from that person some products. What products? Those products which were manufactured without power in cottage industry. You remember, you must have learned about cottage industry in school, guys. You must have, like for example, in villages and all, you must have seen this particular situation where women are sitting outside the house and they are weaving carpets, or they are making those bamboo baskets and all that comes under cottage industry. Okay, handicrafts, your carpet weaving, then making bamboo products and all. So you're making payment because you want to purchase a product which was manufactured in this cottage industry without using electricity, without power. So these kind of payments you can make in whatever mode you want. Then you're making payment to a person who lives in a village where there is no bank branch itself. So to that person you can't make the payment through bank account and all. So to that person you can make the payment in whatever mode you want. Then comes my final point. Let's say you're making payment today, and today the banks are closed, banks are on strike, and today urgently you have to make payment, guys. Now you can make the payment in whatever mode you want. Okay, so generally 48.3 and 48.3 are applicable, but we have some situations where 48.3, 48.3a are not applicable. And where are these situations mentioned, guys? In rule 6DD. Number one, when you have to make payment to bank, LIC, RBI ICAI or government. Then number 2, when you have to make payment to a farmer or to a milkman, to a fisherman and all. Number 3, you're making payment because you want to purchase some products which were produced in cottage industry without using electricity. Then number 4, you're making payment to a person who lives in a village where there is no bank only. And number 5, today banks are closed because of a holiday or because of a strike, and urgently you have to make payment. So in these kind of cases, make payment in whatever mode you want. 48.3, 48.3 disallowance and all will not even come into the picture. Simple, guys? Yes, nice and confident till here, I'm hoping. Yes, guys. So what are the things we've discussed till now? We first spoke about depreciation, then we discussed section 35 scientific research, then we spoke about 35 AD or specified businesses. Then after 35 AD, what did we learn? We spoke about that tax on non-monetary perquisites, remember? Then we discussed about 40A1, 40A1A, 40A3. Then the whole partnership firm discussion, we had the interest and the salary concept, and then we learned about 40A subsection 2, 40A subsection 3 and 40A subsection 3. Now listen, guys, with all this knowledge that you have gained, this is going to be your motivation to nicely grasp this next concept. This next concept is a very interesting concept. I'm combining two concepts over here, discontinued business and section 41. First, understand what is section 41. Section 41 talks about something called as deemed income, guys. In section, I'll give you some examples, okay? Let's say I had incurred bad debts. So when I incurred bad debts, you allowed it for me. It was a loss, you allowed it for me. Now when I recovered the bad debts, you will tax the bad debts recovered for me. So basically, if I'm incurring an expense, you're allowing the expense for me. If I'm incurring a loss, you're allowing the loss from me for me. Now from the same source, when I earn some income later, you will tax the income for me. Now this is what is taxed under section 41, guys. I incurred bad debts. Those bad debts was allowed for me earlier. Now from the same debtor, I'm recovering the money, bad debts recovered. It will be taxable for me under section 41. Similarly, let's say there was a theft of cash in my office. So it's a loss for me, guys. My cash got stolen. It's a business loss for me. So therefore you allowed the loss for me in PGBP computation. But luckily I had theft insurance, guys. So insurance company gave me insurance compensation. So when I get insurance compensation, this should be taxable for me. You're getting my point? From the same source, when I suffered loss, theft of cash, when I suffered this loss, you allowed for me. Now relating to the same theft, I'm having some insurance compensation. I'm having some income. So you have to tax the income for me under section 41. One small numerical example can be taken, guys. Let's take one example for bad debts recovered. Okay, let's say I had a debtor, from the debtor 1 lakh I was supposed to receive. Okay, so I wrote off 40,000 rupees as bad debts, and this 40,000 rupees bad debts was allowed for me in the PGBP computation, which means it was debited in PGBP computation. So which means balance 60,000, this much is still recoverable from the debtor, guys. Only 40,000 I have written off, balance 60,000 I'm still having hope that he will pay. Now you know what the debtor did, guys. Debtor gave me 65,000 in full and final settlement, which means debtor is saying beyond this even 1 rupee extra I will not give. Now see, will this entire thing become bad debt recovered? No. Out of 65,000, 60,000 I was anyway supposed to recover from him. So recovering 60,000 is no big deal. This is how much I was anyway supposed to recover from him. Over and above 60, how much extra I recovered from him, guys? Extra 5,000 I recovered from him. No, this will become your bad debts recovered, which will be taxed for you under the PGBP head. Okay, so when I incurred the bad debts, you allowed it for me. From the same source, when I recovered this extra 5,000, you will tax it for me under section 41. This is what section 41 says. Now, there's one more part relating to discontinued business, okay? Section 41 plus discontinued business, which let's understand over here. Let's say I was having a paper business, okay? I discontinued the paper business, which means I shut down this paper business. Let's say long back in previous 2008-9, I shut down this paper business. But before shutting down this business in 2008-9, in the last year, I had incurred some business loss of, let's say, 1 lakh rupees. Now this business loss, I can adjust against my other business incomes, guys. Basically, even though I've discontinued the business, you will treat the loss like normal usual business loss. Normal business loss, you can adjust against any business income, right? So you will, let's say I'm having some other business, steel business, let's say. So this loss from discontinued business, I can adjust against other business incomes also, no problem. So, as usual, guys, basically this loss will have life of 8 years. In these 8 years, I can adjust it against any business income. Okay, so life is simple over here. Now what happens is, let's say but then after 8 years, what will happen? After 8 years, this loss of 1 lakhs will lapse. Okay, now what happened is, let's say in previous year 25-26, which is your current year, from the same paper business which is discontinued, you're having having some bad debt recovered. Okay, earlier when you were having this business, you had incurred some bad debts which was allowed for you in PGBP. Now you're recovering bad debts 5,000 rupees, you're having bad debts recovered. This will be taxed for you under section 41 under deemed income, guys. Even though business is discontinued, from discontinued business also, if you're getting any income later, it will be taxed for you under section 41. It will be deemed income. Okay, so are you noticing, even though 8 years have lapsed, you're still taxing this income? So don't you think it is unfair? The loss lapsed after 8 years, but from the same source, if you're having income later, you are taxing the income. So to tax the income, you're not putting 8 years time limit, but for loss, you're putting 8 years time limit. It is unfair. That is why in section 41, we have section 41 clause 4, which very clearly says that in case you still have some loss of this discontinued business, even if it is lapsed loss, doesn't matter. Whether we are within 8 years, whether we are after 8 years, doesn't matter. This discontinued business, you are having some income now, which is taxed under section 41. Same discontinued business, some loss is still pending, some loss is still remaining unadjusted. Whether within 8 years, whether after 8 years, doesn't matter. This loss can be adjusted against this income. Understanding, guys? So this is a very unique point, that even though 8 years have lapsed, still this dead loss, this lapsed loss will become alive again. Okay, so but when does this happen? Be very careful, guys. This section 41 income that you're having now has to be from the same paper business. You're getting my point? You discontinued a paper business. In that business, you're having some loss which is still remaining unadjusted. From that same business, you're having section 41 income later. Against that income, you can adjust this loss. Whether within 8 years, whether after 8 years, doesn't matter, but it has to be same business. The loss and the income both have to be from the same business. Okay, got it? So this was your discontinued business point. Multiple questions we've already done on this and all in class itself. 41 subsection 4 is an untested area, guys, so be careful. Okay, then comes my next section, section 43B, another crucial section. In 43B, there are two parts. In the first part, I'm talking about 6 expenses. What are the 6 expenses? Tax, duty, cess or fee, employer's contribution to PF, gratuity fund and all, leave salary, bonus or commission to employees, interest to bank, PFI, NBFC, State Finance Corporation and State Industrial Investment Corporation, then any sum payable to Indian Railways for use of railway assets. So we're talking about these 6 expenses. As I say, these 6 expenses, you have to make the payment within 139.8. If you make the payment after 139.8, for now this expense will be disallowed, but don't worry, as I say, this is a reversible disallowance. So later, whenever you make the payment, in the year of payment, we will once again allow the expense for you. Understanding? So in 43B, I'm first focusing on my first part. In the first part, I'm having 6 expenses. These 6 expenses, you have to make the payment when you have to make the payment within 139.8. If you make the payment within 139.8, great. If you make the payment after 139.8, then for now, I will disallow the expense for you. Later, whenever you make the payment, in that year I will allow for you. So 43B first part is very simple. Now comes our second part. In the second part, and by the way, in the first part, we have this interest point now. About this, I have a special point for you. See, let's say my assessee has to pay interest to bank, okay. But assessee is not paying this interest, guys. Assessee is having outstanding interest. So what the bank is doing is, the bank is converting this unpaid interest into loan. So unpaid interest converted into loan, will it be considered as payment? No, guys, conversion of unpaid interest into loan will not be considered as payment. Assessee actually has to make the payment of interest. Only then we will say that yes, payment has been done. Okay, so remember, conversion of unpaid interest into loan is not considered as payment. I hope you're able to connect with this point very easily, because on the same point you have an illustration also in your ICAI study material. Okay, so I hope you were able to connect with this conversion point easily. So this is it about the first part of section 43B. Then comes the second part. In the second part, assessee has to make payment to a person which is either a micro entity or a small entity. Assessee, I'm not saying assessee is a micro entity or a small entity. No, assessee has to make payment to a person that payee happens to be a micro entity or a small entity. Now micro entity means what? Micro entity means your plant and machinery is within 2.5 crore and your turnover is within 10 crore. Small entity means what? Your plant and machinery is within 25 crores and your turnover is within 100 crores. Okay, so I'm making payment to a person who's a micro entity or a small entity. Now this payment I have to make within section 15 time limit. Not section 15 of Income Tax Act. No, section 15 of MSMED Act. Section 15 of Micro Small Medium Enterprises Development Act 2006. So if assessee has to make any payment to micro or a small entity, assessee please make the payment within section 15 time limit. Same thing, if you make the payment within section 15 time limit, great. it will be allowed for you. But if you don't make the payment within section 15 time limit, then for now we will disallow the expense for you. But same thing, don't worry, it's a reversible disallowance. Later, whenever you make the payment in the year of payment, once again we will allow it for you. Okay, so the main crux remains the same, but the time limits are different. In the first part where we had 6 expenses, these expenses you have to make the payment within 139 1 date. But now for these micro and small enterprise point, I don't care about the 139 1 date, guys. If assessee has to make payment to a micro entity or a small entity, that payment has to be done within section 15 time limit. What is section 15 time limit? We'll come to it. Wait, section 15 time limit of which act? Of MSMED Act. Whether first part, whether second part. If you make the payment within the respective time limit, it will be allowed for you. If you make the payment after the respective time limit, for now we will disallow it for you. Later, whenever you make the payment, in that year we will once again allow it for you. Crystal clear with this entire discussion, everybody? Now the only thing that we're left with is, what is this section 15 time limit? Listen to me, I've put it over here for you. The section 15 time limit depends upon between the assessee and the payee. Is there a written agreement or is there no written agreement? If there is a written agreement between the parties, then whatever is the time limit as per the written agreement, or 45 days, whichever is earlier, will be the section 15 time limit. If there is no written agreement between the parties, then 15 days will be the section 15 time limit. Easy, guys, very simple. The main point you have to remember is, in the first 6 expenses, the time limit is 139 1 date. In the micro small entity point, the time limit is section 15 time limit. Okay, now see, what if assessee has to make payment to a person, and what if this person is a medium entity? Not micro, not small, medium entity, then 43B and all will not apply. 43B will apply only if assessee has to make payment to a person which is a micro entity or a small entity. Okay, and also don't forget, this entire section is a reversible disallowance, which means if you don't make the payment within the time limit, for now we will disallow. But later, whenever you make the payment, in that year we will allow it for you. Got it, guys? This is section 43B. Then look at this one small point, merger expenses and demerger expenses, whatever you have incurred for merger or demerger, this will be allowed across 5 years. Perfect clarity. Yes, so before I take a pause, tell me, I'll ask you some questions. Try answering those questions. My question number 1, what are your reversible disallowances which you have seen, guys? Section 40A1 TDS, remember 40A1, 40A1A, and now you have seen 43B. Only 3 reversible disallowances you have in your syllabus. These are those 3. Okay, then we have also covered the golden rules of PGBP. See, when they talk about the mode of payment, that you made the payment in cash, in specified mode, when they talk about the mode of payment, you will think about section 48.3, 48.3. When they talk about the date of payment, assessee made the payment within 139 1 date, after 139 1 date, you will think about section 43B. If they talk about TDS was deducted, TDS was not deducted and all, then you will think about 40A1 and 40A1A. This golden rule will just help you in your total income computation, guys. It will help you recall the section quickly, okay? If they talk about the mode of payment, 40A subsection 3, 40A subsection 3A. If they talk about the date of payment, 43B. If they talk about tax deducted, not deducted and all, then 40A1 and 40A1A. Crystal clear, guys? I hope you are nice and thorough till here. Moving on to our next discussion now, guys, talking about section 43CA. Now this is a very important section, the reason being something exactly similar with just one change you will have in your capital gains chapter, section 50C. So if you learn it now, section 43CA, if you learn this now under PGBP, you're covering 2 sections, one section under PGBP and one section under capital gains. So therefore listen a little extra carefully. Now section 43CA applies only for those assessees who are into real estate business. So for those assessees, their stock in trade will be land, building or both, guys. So condition number 1 is that assessee has to be in real estate business, that is assessee stock in trade has to be land, building or both. The second condition is that when this assessee is selling this land, building and all, the stamp duty value has to be more than 110% of selling price. 2 simple conditions. Condition number 1, the assessee should be into real estate business, therefore the stock in trade has to be land or building or both. And condition number 2, when the assessee is selling this land or building, the stamp duty value has to be more than 110% of selling price. If both these conditions are fulfilled, welcome to section 43CA. If 43CA is applicable, whatever is the actual selling price, guys, we will ignore it. Instead, the STV number will be deemed to be the selling price number. We'll assume the STV to be the selling price number. Getting it, guys? But however, we will take STV on which date? See, there's a mnemonic which I've always taught you, SAR. Remember, STV will either be STV on the date of agreement or it will be STV on the date of registration. So for STV, there are two possibilities. They can give us two STV numbers in the examination, STV on the date of agreement and STV on the date of registration. Now, out of these two, we always prefer STV on the date of agreement. Only if STV on date of agreement is not possible, only then we take STV on the date of registration. Okay, but when can you take STV on the date of agreement? Only if some consideration buyer has paid to the seller on or before the date of agreement in specified mode. Basically, guys, some advance money the buyer should have paid to the seller on or before the date of agreement in specified mode. If the buyer has done like that, then we will take STV on the date of agreement. If the buyer has not given advance money like this, then we will take STV on the date of registration. Simple, guys. Yes, this is section 43 CA. So if I have to give you the second revision of this section, under section 43 CA, first of all, it is applicable to whom, guys? Only to those assessees who are into real estate business. How many conditions have to be fulfilled? Two conditions. What is condition number 1? The stock in trade of the assessee has to be land or building or both. And condition number 2, when the assessee is selling this land or building, the STV has to be more than 110% of selling price. If both these conditions are fulfilled, then whatever is the actual selling price number you will ignore. Instead, the STV number will be deemed to be your selling price number. Okay, guys. Then we learned STV you will take on which date? We learned that for STV we have two options. Either we can take STV on the date of agreement or we can take STV on the date of registration. Don't forget SAR. STV will either be on the date of agreement or on the date of registration. Now, you always prefer to take STV on the date of agreement only, but you can do that only if some consideration buyer has paid to the seller on or before the date of agreement in what mode? In specified mode. I'm not saying full consideration, I'm saying some consideration. Some consideration buyer should have paid to the seller on or before the date of agreement in specified mode. Then I will take STV on the date of agreement. Okay, guys. Then after this is one more point. Okay, sometimes what happens, no, they'll give you fair market value also in the question. Basically, sometimes assessee is arguing that why are you taking STV number? Assessee is arguing take fair market value number instead. So if they give you the fair market value in the question, okay, then you will compare this FMV with the STV number, and out of these two numbers you will pick whichever is a lesser number. That lesser number only will become your deemed selling price number. Okay, getting my point? Actually, in 43 CA, STV only is a deemed selling price, but if they give you FMV number also, then you will compare FMV with STV. Whichever is lesser, that lesser number will become your deemed selling price. Okay, like for example, if STV is lesser, okay, then you will continue with STV only. If FMV is lesser, then you will take FMV. But here, you will compare this FMV with the selling price and you will take whichever is higher. Okay, so in case I give you the FMV number also in the question, then you will compare FMV with the STV number and you will pick whichever is lesser. If STV is lesser, you will continue with STV. If FMV is lesser, then you will take FMV, but FMV or selling price, actual selling price, whichever is higher. You will understand this part. This part, don't worry, okay, right now. You'll understand much better with the help of this example. Look at this. So in my first situation, selling price is 100 and STV is 80. You will not straight away apply 43 CA. Check your conditions. Condition number 1, the stock in trade of the assessee has to be land, building or both. Let's assume this condition is fulfilled, guys. Condition number 2, STV has to be more than 110% of selling price. In this situation, if you see, STV is 80 rupees, selling price is 100 rupees. Here is STV more than 110% of selling price? No, guys, STV is only 80. It is even less than selling price. So this second condition itself is not fulfilled. 43 CA will not apply. So therefore, you will stick to your actual selling price. You will stick to your real number 100 only. 43 CA will not apply. Okay. Now moving on to my second situation. Over here, the selling price is 90, the STV is 120. So condition number 1, stock in trade should be land, building or both. Let's say this condition is fulfilled. Condition number 2, my STV, what's our STV number over here? 120. This should be more than 110% of selling price. Selling price is 90. So 110% of 90 will be 99. So tell me now, is 120 more than 99? Yes, guys, second condition is fulfilled. Therefore, welcome to 43 CA. Once you enter into 43 CA, I will ignore the actual selling price number. Instead, the STV will become my deemed selling price number. But here they have given me FMV also. So when they give me STV and FMV, when they give me both, then you will pick whichever is a lesser number over here. So STV or FMV, clearly which is lesser, guys? STV only is lesser. 120 or 150, which is lesser? 120 only is lesser. So we will stick to 120 only over here. Understanding. This was my second situation. Now let's move on to a third situation. Now in a third situation, one second, the selling price is 90, STV is 120. First of all, stock in trade should be land, building, or both. Let's assume that condition is fulfilled. Condition number 2, your stamp duty value is 120, your selling price number is 90, so 110% of 90 you will do, which is 99 rupees. Yes guys, 120 is more than 99. Both my conditions are fulfilled. First of all, welcome to 43 CA. Now once you enter into 43 CA, the STV number will become deemed selling price number. But wait, they have given me FMV number also. So when they give me FMV number, we'll take STV number or FMV, whichever is lesser. Tell me 120 or 110, which is lesser over here. Over here, your FMV number is lesser. So whenever FMV is lesser, that time you will take FMV or selling price, whichever is higher. So tell me now, FMV or selling price, which is higher? Clearly my FMV number 110 only is higher. Getting my point? If STV is lesser, you will stick to SDV. If FMV is lesser, then FMV or selling price, whichever is higher. Easy guys. Yes. Now come to my fourth situation. In my fourth situation, again what happens is your selling price is same 90, STV is same 120. So STV is 120. This 120 should be more than 110% of 90, which is going to be 99. Yes, 120 is more than 99. Both my conditions are fulfilled. First of all, welcome to 43 CA. Once you enter into 43 CA, same drama guys. What drama? Whatever is a stamp duty value, this STV number will become deemed selling price number. But wait, they have given me the FMV number. So because they have given me the FMV number, I will take STV or FMV, whichever is lesser. So STV 120, FMV 50, which is lesser. FMV is lesser. So but then whenever FMV is lesser, you will take the FMV number or your real selling price, whichever is higher. So 90 or 50, which is higher guys? 90 only is higher. So we will stick to our actual selling price only. You got the point, right? So this is your entire section 43 CA guys. I hope you've grasped it very well, because same thing as it is covered in section 50 C also, which we will see once again in our capital gains chapter. Okay, so this was section 43 CA. Alright, now comes a 44 series. In 44 series we have 5 sections guys. We have section 44 AA, which talks about who has to maintain what kind of books of accounts. Then we have 44 AB, which talks about tax audit, and then we have 44 AD, 44 ADA, and 44 AE. These 3 sections talk about presumptive taxation. Okay, so these 5 sections we will take up one by one now. Let's talk about section 44 AA first. 44 AA talks about who has to maintain what types of books of accounts. So here there are totally 3 parts in my section. Okay, we'll see it part by part. In my first part, I'm talking about specified professional. So if you're a specified professional, you will have to maintain such books of accounts which will help the AO to compute a total income. So if you're a specified professional, we are not telling you what books of accounts you have to maintain. We are not giving you a list. We are just telling you maintain bare minimum books of accounts, so that with those books of accounts, AO is able to compute a total income. That's all guys. Okay, now question arises that who are these specified professionals? We have one list guys. Anybody who is carrying on the legal profession, that is lawyer, doctor, engineer, architect, profession of accountancy, technical consultancy, interior decorator, then your authorized representative, then film artists like actors, cameraman, director, music director, art director, editor, singer, lyricist, story writer, screenplay writer, dialogue writer, dress designer, company secretaries, IT professionals, all these will come under specified professionals. Please notice, okay, in film artists, we have music director, we don't have music producer. Be careful about that little thing. Alright, so if you're a specified professional, then we're not giving you a list and all. Just maintain bare minimum books of account so that AO can compute a total income. Okay guys, this was my first part. Alright, then coming to my second part. In my second part, again we're talking about specified professionals. Okay, but this time we're talking about those specified professionals whose gross receipts are more than 1,50,000. First of all, what is this gross receipt? Like if I'm carrying on a business, I will have turnover. If I'm carrying on a profession, it will be called as gross receipt. Like for example guys, doctor will be collecting fees from the patients guys. Now this fees, I can't call it turnover guys. So therefore doctor professional, for professional and all, this revenue, I call this revenue as gross receipt instead. Okay, so in my second part, what happens is, you're a condition number 1, you're a specified professional. Condition number 2, I will look at 3 preceding previous years. Like in our examination, our previous year is 25-26, guys. So the 3 preceding previous years will be 24-25, 23-24 and 22-23, right? In each of the preceding previous years, the gross receipt of this assessee should be more than 1,50,000. In each year, it should be more than 1,50,000. If it is like this, so which means condition number 1, assessee should be a specified professional, and condition number 2, in each of the 3 preceding previous years, gross receipt is more than 1,50,000. If the situation exists, then in that case, assessee, you have to maintain this list of books of accounts. See, nothing to get confused, okay? Listen to me. If you happen to be a specified professional, okay, and in 3 preceding previous years, in each year, if your gross receipt is more than 1,50,000, then in that case, you have to maintain this list of specified books of accounts, okay? But however, in the 3 preceding previous years, gross receipt more than 1,50,000, if this condition is not fulfilled, then you will fall under part 1. Now, if you fall under part 1, we are not telling you any list and all, we are just telling you maintain bare minimum books of accounts with which AO can compute a total income. Easy, guys. Okay, so in the second part, if your 3 preceding previous years gross receipt is more than 1,50,000, then whatever is mentioned in this list, these books of accounts you have to maintain. Now, what is mentioned in the list? Cash book, journal. But journal, remember, you have to maintain only if you're following mercantile basis of accounting. Only then you have to maintain journal, otherwise journal is not required. Then ledger. Then carbon copies of bills if it is more than 25 rupees. Then original bills, daily case register, inventory register. So you have to maintain all this if you fall under the second part. When will you come under the second part? In the second part, you will come under if you're a specified professional and 3 preceding previous years gross receipt is more than 1,50,000. Getting it, guys? So now listen to me. If you're a specified professional, you will either come under bucket 1 or you will come under bucket 2. If you come under bucket 1, you have to maintain bare minimum books of accounts. If you come under bucket 2, you have to maintain this list of books of accounts. Okay, guys? Now comes a question, what if I am not carrying on a specified profession? What if I'm carrying on a non-specified profession? Or what if I'm carrying on a business? Then in that case, what kind of books of accounts I should maintain? For that, we have part 3. So in part 3, we are covering these two people, that is either non-specified professionals or they're carrying on business. So we have two situations over here. In my first situation, assessee is individual or HUF. Assessee is carrying on either a business or a non-specified professional. Then income is more than 2,50,000 or the turnover gross receipt is more than 25 lakh rupees in any one out of 3 preceding previous years. Okay. So if you're either carrying on a non-specified professional or if you're carrying on a business, and if you're an individual or HUF, then you have to maintain books of accounts if your income is more than 2,50,000 or your turnover gross receipt, as the case may be, is more than 25 lakh rupees in any one out of 3 preceding previous years. Okay, but however, what if you're not an individual or HUF? If you're person other than individual or HUF and either you're carrying on a business or a non-specified profession, same thing, then in that case, if your income is more than 1,20,000 or if your turnover gross receipt is more than 10 lakh in any one out of 3 preceding previous years, you have to maintain books of accounts. What books of accounts? Here also there is no list, guys. Maintain bare minimum books of accounts which will help the AO to compute a total income. That's all. Okay, so simple, guys. If your assessee happens to be a specified professional, either he will fit under part 1 or he will fit under part 2. If he's a specified professional and all the 3 preceding previous years his gross receipt is more than 1,50,000, then he will fit under part 2. If you fit under part 2, you will have to maintain list books of accounts. If your gross receipt is not more than 1,50,000 even in one of the 3 preceding previous years, then you will come under part 1. In part 1, bare minimum books of accounts you have to maintain. Then comes my part 3. In part 3, we are having 2 buckets. In the whole of part 3, we are covering those assessees who are either carrying on a business or they are carrying on a non-specified profession. Either carrying on a business or carrying on a non-specified profession, because if it is specified profession, already covered in part 1 and 2, guys. So if all other assessees only will come under part 3. If they are individual or HUF, then the limits are 250 and 25 lakhs. If it is not individual or HUF, then the limits are 120 and 10 lakhs. That's all, guys. Okay, so if you fit under part 3, you have to maintain those minimum books of accounts which will help the AO to compute total income. Alright, now listen, how long do you have to preserve the books of accounts for? Like for example, in Companies Act, preservation is for 8 financial years. So here in Income Tax Act, you have to preserve the books of accounts for how many years? Here you have to preserve for minimum 6 years from the end of the assessment year. Be careful, from the end of the assessment year. Like for example, if I'm talking about previous year 25-26, assessment year 26-27, then what is the end of the assessment year? 31st March 2027. From this date for 6 years, that is till 31st March 2033, till this date I'll have to maintain the books of accounts. understanding for at least 6 years from the end of the assessment year. Now comes the next question, the place, that is where do you have to keep the books of accounts. This I will explain to you over here. How many years do you have to keep the books of accounts? For 6 years. Now where do you have to keep? It depends guys, there are 3 options. You generally have to keep at the place where your business or profession is being carried on, okay? But what if I have multiple places? Like for example, what if I have multiple branches? Then there are so many places where my business is being carried on. If you are having multiple branches, then there are 2 possibilities guys. If you are maintaining separate books for each branch, then you will keep the books of accounts at that particular branch itself, okay? But if you are not maintaining separate books for each branch, then in that case, whatever is the principal place of business, at the principal place you will keep the books of accounts. Easy guys. So where will you keep the books of accounts? At whatever place you're carrying on your business or profession. But if you're having multiple such places, like for example, if you're having multiple branches, then we will see for each branch, are you maintaining books separately? If yes, then we will keep the books at each branch itself. But if you're not maintaining separate books for each branch, then we will keep all the books at the principal place itself, okay? And if you violate this section, 25,000 punishment is going to be imposed on you. So this is your section 44AA, which talks about who has to maintain what types of books of accounts. So remember the 3 parts. In my first 2 parts, I'm talking about specified professionals. In my first part, specified professional maintain bare minimum books of accounts. In my second part, specified professionals, if your gross receipt is more than 1,50,000 in each of the 3 preceding previous years, then you have to maintain this list of books of accounts. Then in my third part, if you are not a specified professional or if you're carrying on a business, then in that case, if your income turnover is more than these limits, you will have to maintain bare minimum books of accounts. Simple guys. This was your first section in the 44 series, 44AA, a very theoretical section. Now comes my second section in the 44 series, a very important section, but a very simple section, section 44AB, which talks about who has to get tax audit done. Okay guys. First, let's try to understand this nice flowchart which I've made for you over here. This flowchart will make life easy for you when it comes to 44AB. So we're talking about tax audit, okay? Now, who has to get tax audit done? It depends on whether you're carrying on a business or are you carrying on a profession. Let's talk about business first. If you're carrying on a business, I have 4 situations and I will always follow my sequence. Sequence means what? I will go step by step, which means only if situation 1 is not applicable, only then I'll come to situation 2. Only if situation 2 is not applicable, then only I'll come to situation 3. So like this, I will follow the sequence, okay? So in my first situation, 44AD is applicable to the assessee, but assessee is not applying 44AD and total income is more than basic exemption limit. What is 44AD? We will see a little later. So 44AD is applicable, but assessee is not following 44AD and total income is more than basic exemption limit. If these conditions are fulfilled, you will fall under the first situation. Then assessee, you have to get tax audit done. Okay guys. Then comes the second situation. This time 44AE is applicable for the assessee and assessee is however not following 44AE. Similar guys, 44AD was applicable but assessee was not following 44AD. 44AE is applicable but assessee is not following 44AE. But are you noticing here total income has to be more than basic exemption limit, but in my second situation I don't have any such criteria. So if 44AE is applicable and assessee is not applying 44AE, then in that case 44AB tax audit will be applicable. This is my second situation. Okay, first 2 situations clear. Then comes my third situation. In my third situation I have one box. If this box is fulfilled, then I have entered into the third situation. Once I enter into the third situation, I will get my answer from here. So if the cash receipt is within 5% of total receipt and cash payment is within 5% of total payment. See, cash receipt has to be within 5% of total receipt and cash payment has to be within 5% of total payment. If both these conditions are fulfilled, I have entered into the third situation. Once I enter into the third situation, I will get my answer from this box. If turnover is within 10 crore, then no tax audit is required. If turnover is more than 10 crore, then tax audit will be applicable for me. Getting my point guys? So cash receipt has to be within 5% of total receipt. Mind you, over here turnover is not mentioned. Total receipt is mentioned. Total receipt means I'm covering turnover also, I'm covering capital receipt also, I'm covering revenue receipt also, I'm covering all receipts, okay? So if cash receipts are within 5% of total receipts and cash payments are within 5% of total payments, then in that case I will look at this box. If turnover is within 10 crore, tax audit will not apply. If turnover is more than 10 crore, tax audit will apply. This is my third situation, okay? Then comes my fourth situation where situation 1, 2, 3, none of these are applicable. If none of these situations are applicable, then in that case, if turnover is more than 1 crore, then 44AB tax audit will apply. Simple guys. So these are your 4 situations under business. So if you fit under any of these 4 situations, then tax audit will apply for you. But please ensure you go in the same sequence. Got it, everybody? Yes, and then comes our professional assessees. Here, very simple. 44 ADA is applicable. Same thing. 44 ADA is applicable, but assessee is not applying 44 ADA, and total income is more than basic exemption limit. If these conditions are fulfilled, assessee, you will have to get tax audit done. Also, if situation 1 is not applicable, but gross receipt is more than 50 lakhs, then assessee, you have to get 44 AB tax audit done. Audit, everybody. So this is about who has to get tax audit done. Now come on guys, let me give you a quick revision of the revision. So we're talking about section 44AB, which talks about tax audit. So first we spoke about business assessees. In business assessees we have 4 situations. In the first situation, 44AD is applicable for the assessee, but still the assessee is not applying 44AD and total income is more than basic exemption limit. Then in my second situation, section 44AE is applicable for the assessee, but however assessee is not applying 44AE. Here I don't care about total income. Then in my third situation, the cash receipt of the assessee is within 5% of the total receipt. The cash payment of the assessee is within 5% of the total payment. If both these conditions are fulfilled, you have entered into the third situation. Once you enter into the third situation, you will simply look at the turnover. If the turnover happens to be within 10 crore, then in that case no tax audit will apply for you. If turnover happens to be more than 10 crore, then in that case tax audit will apply for you. Okay. Then comes a fourth situation where situation 1 is not applicable, 2 is not applicable, 3 is not applicable. If none of these situations is applicable, then you will see the turnover. If turnover is more than 1 crore, then tax audit will apply for you. Very simple guys. Yes. Then what if my assessee is carrying on a profession? In that case, only 2 situations I have. In the first situation, 44ADA is applicable for the assessee, but still assessee is saying I don't want to apply 44ADA and total income is more than basic exemption limit. If the situation arises, then assessee, you will have to get tax audit done. Then second situation, if situation 1 is not applicable, but the gross receipt of this assessee is more than 50 lakhs, then also assessee, you will have to get tax audit done. Simple guys. So this chart will make it very easy for you. Now if tax audit is applicable for me, by what date I have to get tax audit done? Listen to me carefully now. There are 2 things, okay? One is your 139(1) due date and the other is your tax audit due date. There are 2 things. Now if you are if you're an audit assessee, then in that case 139(1) date is 31st October. You know it very well. If you're an audit assessee, we had spoken about this in the initial part of PGBP itself. If you're an audit assessee, your 139(1) date will be 31st October. Now, for the audit assessee, what is the due date to submit the tax audit report? Tax audit report has to be submitted within 1 month before the 139(1) date. So, if your 139(1) date is 31st October 2026, this minus 1 month will be what? 30th September 2026 guys. So by 30th September 2026, you will have to submit a tax audit report. You're understanding, right? So there will be 2 time limits for you. One time limit will be for you to submit the tax audit report. Another time limit will be for you to submit your income tax return. So there are 2 time limits. Your tax audit report time limit will be 1 month before your ITR date. Okay? ITR date will be 31st October. Simple guys. Now what if you don't get tax audit done? What if tax audit is applicable for you but you don't get tax audit done? Then what's your penalty? Penalty will be 0.5% of your turnover or 1,50,000 rupees, whichever is lesser. Now listen to me. In Companies Act, you have so many punishments, so many penalties. And there you can even give an excuse that, how will I learn so much? You can give the excuse. But in income tax syllabus, guys, only 2 punishments you have. One is in 44AA, your 25,000 punishment we saw. And now in 44AB, you are having this punishment. So only 2 punishments you have. You have no excuse. Please ensure you learn both the punishments. 44AA, if you don't maintain the books of accounts properly, then 25,000 is your punishment. And here in 44AB, if you don't get the tax audit done, then 0.5% of the turnover or 1,50,000, whichever is lesser. Okay guys, now moving on to our presumptive taxation sections. We have 3 sections for presumptive taxation guys. We have 44AD, then we have 44ADA, and then we have 44AE. Very, very important. Let's see this properly and nicely. Sit up straight and listen carefully with no tension. Very easy sections guys. 44AD talks about presumptive taxation for business assessees. Okay. So here we have 4 conditions. Let me talk about these conditions with you over here. Which section are we talking about? We're talking about 44AD. Okay. 4 conditions. Condition number 1, assessee should be a resident, individual or HUF or partnership firm. See, generally same provisions which apply to partnership firm also apply to LLP, but not in presumptive taxation guys. Presumptive taxation is applicable to partnership firm, but it is not applicable to LLP. It is not applicable to company and all. It is applicable only to individual HUF and partnership firm. Then second condition, this assessee must be carrying on a business, but this business should not be agency business. It should also not be the business of plying, hiring, leasing, goods carriages. Okay. Then comes the third condition, this assessee must not be claiming 10AA tax holiday for SEZ unit. Also, this assessee should not be claiming Chapter 6A. In Chapter 6A, you have Part C sections, 80JJAA, QQB, RRB, all that you should not be claiming. And then comes the fourth condition, the turnover has to be within the limit. So turnover has to be less than or equal to the limit. If all these four conditions are fulfilled, 44AD will apply. Assessee has to be resident individual or HUF or partnership firm, but not LLP, not company. Assessee must be carrying on a business. Assessee must not be claiming 10AA or Chapter 6A Part C, and turnover has to be within the limit. If all these conditions are fulfilled, then 44AD will apply. Now, what is this limit, guys? The limit depends upon what is the cash receipt of the assessee. If the cash receipt happens to be within 5% of the turnover of the assessee, then this limit will be 3 crore. But if the cash receipt happens to be more than 5% of the turnover of the assessee, then the limit will be 2 crore. So the turnover has to be within the limit. The limit will either be 3 crore or it will be 2 crore. It depends upon what is the cash receipt of the assessee. Crystal clear till here, everybody properly understanding. Now listen, one more point, okay. I wanted to notice this. In 44AB, here also we spoke about cash receipt, but here we said cash receipt has to be within 5% of the total receipt. We are not talking about just turnover here, we are saying total receipt, which means turnover, capital receipt, revenue receipt, everything we will consider over here. But in 44AD, we are saying cash receipt has to be within 5% of turnover. We are not saying total receipt, so only turnover we will take over here. Okay guys, so remember this small differentiation point. So in 44AD, 4 conditions, if all these 4 conditions are fulfilled, 44AD will apply. Now if 44AD applies, how will you compute PGBP, guys? You will see how much is the turnover of your assessee. That turnover, we will see how much of the turnover has been realized by the assessee in specified mode on or before 139(1) date. Okay, whatever is this turnover into 6% will be a PGBP. Alright, then you will see what is a balanced turnover. Whatever is a balanced turnover, that into 8% will be your PGBP. Simple, guys. Okay, no allowances, no disallowances, nothing. All the other PGBP adjustments are deemed to be adjusted. Whatever is your turnover, out of the turnover, how much has been realized in specified mode within 139(1) date, that turnover into 6% will be your PGBP. Balanced turnover into 8% will be your PGBP. Okay, now see, 44AD, everybody is clear, right? Assessee has to be resident individual, HUF or partnership firm. Assessee should not be a LLP or a company. Then assessee should be carrying on a business. It should not be agency business. It should not be plying, hiring, leasing, goods carriages business. Then assessee should not have claimed 10AA. He should not have claimed Chapter 6A Part C, and turnover should be within the limit. Either it will be 3 crore or it will be 2 crore. If all the conditions are fulfilled, then 44AD will apply. If 44AD applies, whatever is your turnover, we will see how much of the turnover you have received in specified mode within 139(1) date. That turnover into 6% will be a PGBP. Whatever is a balanced turnover, that into 8% will be your PGBP. Okay, now see, if 44AD is applicable for you, okay, if all the 4 conditions are fulfilled, if you're following 44AD, then 3 benefits you will get, guys. You don't have to maintain books of accounts. If 44AD is applicable for you, if you're following 44AD, you don't even have to maintain books of accounts. Then you don't have to get the books of accounts audited also. Advance tax you still have to pay, but the entire advance tax you can pay in the last installment straight away. Generally, you have 4 installments of advance tax, right? But if presumptive taxation is applicable for you, you still have to pay advance tax. You still have to pay full 100% advance tax, but straight away you have to pay in the last installment only. So if you're following 44AD presumptive taxation, then 3 benefits will be applicable for you. You don't have to maintain books of accounts. You don't have to get the books of accounts audited. Also, 100% advance tax you have to pay in the last installment only. Okay, but however, what if 44AD is applicable for me, but I'm not applying 44AD? See guys, presumptive taxation sections are mandatory sections, which means if these 4 conditions are fulfilled, I have to follow 44AD. It is a mandatory section. Okay, but if all the 4 conditions are fulfilled, but still if I don't follow 44AD, then what will happen? Basically, what if the PGBP I am declaring is less than that 6% number, less than the 8% number, then what will happen? In that case, guys, there will be consequences. There will be 4 consequences. Consequence number 1, I will have to maintain books of accounts if my total income is more than basic exemption limit. Consequence number 2, I will have to get the books of accounts audited if total income is more than basic exemption limit. Then condition number 3, I will have to pay advance tax in all 4 installments. I'll have to pay advance tax. And consequence number 4 is 44AD subsection 4, which I will discuss with you separately. Okay, so if 44AD is applicable for you, but still if you don't follow 44AD, that is, if the PGBP that you're declaring is less than 6% or less than 8% number, then in that case, 4 consequences. You will have to maintain books of accounts. You will have to get the books of accounts audited. Advance tax, usual 4 installments you'll have to pay, and 44AD subsection 4 will also apply for you. Now, before I come to 44AD subsection 4, let's do one solid revision of the whole of 44AD. I'm so particular about 44AD, guys, because if you understand 44AD, the remaining two presumptive taxation sections become really simple. Okay, so that is why listen carefully. So in 44AD, first of all, I put 4 conditions on you guys. So my condition number 1 was that assessee has to be a resident, individual, or a HUF or a partnership firm, but should not be company, should not be LLP. Then condition number 2, assessee must be carrying on a business, but this business should not be agency business. Also, it should not be plying, hiring, or leasing goods carriages. Then the third condition, assessee must not be claiming 1088 tax holiday. Also, assessee must not be claiming Chapter 6A, Part C, assessee must not be claiming. Then comes the fourth condition, the turnover has to be within the limit. What is the limit? The limit is either 2 crore or the limit is 3 crore. It depends. The 3 crore limit will apply if the cash receipt is within 5% of your turnover. If a 2 crore limit will apply if the cash receipt is more than 5% of your turnover, then the 2 crore limit will apply. Okay guys, now if all the 4 conditions are fulfilled, then in that case 44AD will apply. If 44AD applies, how do you compute PGBP? You will see the turnover. Out of the turnover, how much of the turnover has been realized? Realized in which mode, guys? In specified mode. Realized in specified mode when, guys? Within 139 date. So whatever is the turnover which is realized in specified mode within 139 date, this turnover into 6% will be a PGBP. Then whatever is your balance turnover, that balance turnover into 8% will be a PGBP. Okay. This is how you will arrive at the PGBP number under 44AD. No allowances, no disallowances, nothing. The whole PGBP chapter is deemed to be adjusted already. Okay. Now, if 44AD is applicable for you, what are the benefits that you will get? If you follow 44AD, then you don't have to maintain books of accounts. 44AA, dustbin. Then you don't have to get the tax audit done. So 44AB, dustbin. Then advance tax you still have to pay, but the entire advance tax you have to pay in the last installment only. Okay. But however, what are the consequences? Consequences means if 44AD is applicable for you, but you are not declaring your PGBP as per the 6%, 8% number, the PGBP which you are declaring is less than the 6% number, less than the 8% number. If you don't comply with 44AD, then what are the consequences? 4 consequences you will have. Consequence number 1, you will have to maintain books of accounts under 44AA. Consequence number 2, you will have to get the tax audit done under 44AB, but both of these will apply only if total income is more than basic exemption limit. Then the third consequence, advance tax in the usual 4 installments you have to pay, and then comes your fourth consequence, which is 44AD subsection 4. Can we talk about 44AD subsection 4 now? As of now, are you having confidence that the whole of 44AD you have understood? Only the consequence part is left, guys. Yes, so listen to me carefully. What is this 44AD subsection 4? Very simple. Okay, let's say in previous year 23-24, for the first time I followed 44AD. The law says once you apply 44AD, now next 5 years you have to follow 44AD. Next 5 years means what? 24-25, 25-26, 26-27, 27-28 and 28-29. So once you follow 44AD, the next 5 years also you have to follow 44AD only. But out of these next 5 years, let's say in 25-26, I did not follow 44AD. Conditions are fulfilled, but I still did not follow 44AD. If that happens, guys, then next 5 years, which means 26-27, 27-28, 28-29, then 29-30 and 30-31. These 5 years, you will become ineligible for 44AD. So these 5 years, even if you want to follow 44AD, you can't follow 44AD. Getting my point, guys? So once, listen, very simple. Once you follow 44AD, then next 5 years over here, in these next 5 years, you have to follow 44AD. Now, my assessee, in one of these 5 years, that is, in 25-26, assessee did not follow 44AD. So if you don't follow 44AD in any of these 5 years, then in that case, for the next 5 years now, next 5 years, these 5 years, even if you want to follow 44AD, you will become ineligible for 44AD. So if you don't follow 44AD, then for the next 5 years, you become ineligible. That is what is mentioned in 44AD subsection 4. Got it, guys? So with this, we are done with our first presumptive taxation section, which is 44AD. Okay, now come to 44ADA. Once you understand 44AD, the remaining 2 presumptive taxation sections are cakewalk only. So 44ADA applies for professional assessees. So 3 conditions we have over here. Assessee has to be a resident, individual, or a partnership firm. No HUF, no company, no LLP and all. Then assessee should be carrying on a specified profession, not any profession, specified profession, and gross receipt should be within the limit. What is the limit over here? two limits we have, 75 lakh limit and 50 lakh limit. 75 lakh limit will apply if the cash receipt is within 5% of the gross receipt, and 50 lakh limit will apply if cash receipt is more than 5% of the gross receipt. So if all the three conditions are fulfilled, 44 ADA will apply. If 44 ADA applies, then whatever is a gross receipt into 50% will become your PGBP. Here also same thing guys, if 44 ADA is applicable for you, three benefits you will get. You don't have to maintain books of accounts under 44 AA. You don't have to get the books of accounts audited under 44 AB. You still have to pay advance tax, but entire advance tax you have to pay in the last installment only. You're understanding? It's very similar to 44AD now. Then if 44AD is applicable for you, but if you're still not following 44AD, then consequences guys. Consequence number one, you have to maintain books of accounts. You have to get the books of accounts audited, and advance tax, usual 4 installments you have to pay. That 44AD subsection 4, that 5 years point is not there in 44AD. Okay guys, so come on, let's do a nice revision once again, the whole of 44 ADA. So 44 ADA, here we had only three conditions. Condition number one, assessee has to be a resident, individual or partnership firm. Even HUF I'm not covering over here, even LLP I'm not covering over here. Then second condition, assessee must be carrying on a specified profession. And condition number three, the gross receipt of the assessee has to be within the limit. Now what is the limit? The limit will either be 75 lakhs or the limit will be 50 lakhs. 75 lakhs limit will apply if the cash receipt is within 5% of the gross receipt. The 50 lakh limit will apply if the cash receipt is more than 5% of the gross receipt, then 50 lakh limit will apply. If all the three conditions are fulfilled, then 44 ADA will apply guys. If 44 ADA applies, whatever is your gross receipt, that gross receipt into 50% will become your PGBP. Okay. Then if you follow 44 ADA, how many benefits will you get? Same three benefits guys. You don't have to maintain books of accounts, so 44 AA dustbin. You don't have to get tax audit done, so 44 AB dustbin. Advance tax you still have to pay, full advance tax you have to pay, but straight away in the last installment only you have to pay. Okay guys, so three benefits you're having. Then what are the consequences? Consequences means 44 ADA is a presumptive taxation section. It's a mandatory section, but what if you still don't follow 44 ADA? What if you do still, what if the PGBP you declare is less than the 50% number? Then what will happen? Three consequences guys. Consequence number one, you will have to maintain books of accounts. Consequence number two, you will have to get tax audit done. But both of these will apply only if total income is more than basic exemption limit. And the third consequence guys, advance tax, usual 4 installments you will have to pay. 44 AD subsection 4 consequence, that is only in 44 AD. That consequence you don't have in 44 ADA. Understanding guys? So this was your second presumptive taxation section, which is 44 AD. So two presumptive taxations you have understood, 44 AD and 44 ADA. Now come to my last presumptive taxation section, which is 44 AE. Now 44 AE, this will apply to those assessees who are in the business of plying, hiring, leasing goods carriages. So you can be any assessee. You can be an individual, company, firm, LLP, you can be any assessee over here. Just that you should be carrying on the business of plying, hiring, leasing goods carriages, and also you should not be owning more than 10 goods carriages. The total number of trucks that you own during the year should be within 10. At any point of time guys, the number of trucks that you own should not exceed 10. Like for example, in the beginning of the year I had 10 trucks. Then I sold 1 truck. So now I'm having only 9 trucks. Then I purchased 1 truck. So again I'm having 10 trucks only. So if you see at any point of time, it did not exceed 10. This is how it should be. Okay. So condition number one, assessee can be any assessee. Condition number two, assessee must be in the business of plying, hiring, leasing goods carriages. And condition number three, assessee should not own more than 10 goods carriages during the year. If all these three conditions are fulfilled, then 44A will apply. Now, if 44A is applicable, how will you compute PGBP guys? For that, we have this provision over here. We will see what are the heavy vehicles. Heavy vehicles means they can carry more than 12,000 kg. These vehicles, 1,000 rupees per ton per vehicle per month will become your PGBP. Then whatever are the other vehicles means they can carry less than or equal to 12,000 kg. These vehicles, 7,500 rupees per vehicle per month will become your PGBP. Okay. Now listen, there's something very unique. Okay. In 44 AD, we have 6%, 8%. Story ends over here. In 44 ADA, we have 50%. Story ends over here. But in 44 AE, guys, the story does not end over here. The story does not end over here if the assessee is a partnership firm or LLP. See, it'll help you understand, okay. If assessee happens to be a partnership firm or LLP, then you will do that 1,000 rupees per ton for heavy vehicles. You will do that 7,500 rupees per per month for other vehicles. Then you will get one number. Now from this number you will subtract section 40B, interest to partners and salary to partners, and whatever final number you get, this will be your final PGBP. Okay, this 40B point you don't have in 44AD and 44ADA guys, you have this only in 44AE. Got it everybody? So interest, if it is interest, maximum 12% you will allow. If it is salary, then it depends on the book profit, right guys? So all that, so all this will apply. This 40B allowance, you will subtract this number not for partners, only for partnership firm or LLP. So if assessee is a partnership firm or LLP, after this 1000 rupees, 7500 rupees, whatever you get, from this you will get 40B allowance. Got it everybody? And see one more thing, okay, what if I purchased the heavy vehicle but I did not even put it to use? Will you still do this 1000 rupees per ton calculation for that vehicle? Yes guys, see that's what I told you even earlier, remember. Put to use is a depreciation concept. You leave it over there. Don't bring it everywhere else. So I just care about how many vehicles my assessee owns. How many ever vehicles he owns, for those vehicles I will do this calculation. Whether that vehicle is under repair, whether that vehicle is not even put to use till now, all that doesn't even matter for me. Okay, I just care about how many vehicles you own. How many ever vehicles you own, for those vehicles I will do this calculation. And if you're a partnership firm or LLP, then I will remember to subtract section 40B, interest and salary also. Okay everybody, and then same thing, if 44A is applicable for you, then you don't have to maintain books of accounts. 44AA will not apply for you. You don't have to get the books of accounts audited. 44AB will not apply for you. But advance tax you still have to pay. See, in 44AD and 44ADA, we had the third benefit, which is advance tax only last installment you have to pay. But that benefit you don't have in 44AE. So in 44AE, advance tax you have to pay in usual 4 installments you have to pay. Advance tax benefit is not there in 44AE. Okay. Then what if 44AE is applicable for you but assessee is not following 44AE? Then in that case, what is the consequence? First 2 consequence only you will have. You will have to maintain the books of accounts under 44AA. You will have to get the books of accounts audited under 44AB. Got it guys? So this is your entire discussion on 44AE. Can we do one quick revision of just 44A? Yes, 44AD and 44ADA, nicely you've understood. We've done multiple revisions as well. Let's focus on 44AE now. So in 44AE, 3 conditions. Condition number 1, assessee can be any assessee. Individual, firm, LLP, company can be any assessee. Second condition, this assessee should be in the business of plying, hiring, leasing goods carriages. And condition number 3, this assessee should own not more than 10 goods carriages at any point of time in the year. Okay. If all these conditions are fulfilled, then 44AE will apply. If 44AE is applicable, you will see what are our heavy vehicles. Heavy vehicles means they can carry more than 12,000 kg. For these vehicles, 1000 rupees per ton per vehicle per month will become your taxable number guys. Whatever are your other vehicles means they can carry less than or equal to 12,000 kgs. For them, 7,500 rupees per vehicle per month will be the taxable number. Remember, month over here also covers part thereof. Okay. So whatever number you get over here, you will not stop over here. If the assessee happens to be a partnership firm, or LLP, then you will also subtract section 40B, interest and salary to partners. Whatever is the final number, this is going to become your taxable PGBP number. Okay. Then if you follow 44AE, then 2 benefits you will get. Benefit number 1, you don't have to maintain books of accounts. So 44AA dustbin. Then you don't have to get the books of accounts audited. So 44EB tax audit also will not apply for you. Then if 44AE is applicable for you, but the PGBP which you are declaring is less than these numbers, that is if you don't follow 44AE, then what are your consequences? 2 consequences guys. You will have to maintain books of accounts and you will have to get the books of accounts audited. Here where the total income is less than basic exemption limit, more than basic exemption limit and all, I don't care. You have to maintain books of accounts and you have to get the books of accounts audited. Okay, this is it about our entire discussion on all the 3 presumptive taxation sections, guys. You got it right. And in all the 3 presumptive taxation sections, guys, all the PGBP adjustments are deemed to be already adjusted. See, even unabsorbed depreciation is a PGBP adjustment. So all of this will be deemed to be adjusted. You will not adjust them anymore. You will assume all PGBP adjustments are already deemed to be adjusted if presumptive taxation is applicable for you. Alright, so with this guys, we're done with all our 44 series sections. We learned about 44AA, maintaining books of accounts. Then we spoke about 44AB, which talks about tax audit. Then the 3 presumptive taxation sections, 44AD for business assessees, 44ADA for professional assessees, and 44AE for assessees who are in the business of plying, hiring and leasing goods carriages. Okay, now listen carefully. Okay, 3 sections I'm talking about: 44AB, your tax audit section, then 44AD, presumptive taxation for business, and 44ADA, presumptive taxation for professions. In all the 3 sections, guys, we talk about cash receipts, cash payments and all somewhere or the other. Like in 44AB, we say cash receipt has to be within 5% of the total receipts. In 44AD, we say cash receipt has to be within 5% of the turnover. In 44ADA, we say cash receipt has to be within 5% of the gross receipts. So in all the 3 sections, we're talking about cash transactions. In all the 3 sections, when I'm talking about cash transactions will not only include cash, it will also include check transactions. Understanding? So in all these 3 sections, cash transactions will not only include cash, it will also include check, but that check should not be account payee check, which means cash, yes, you will consider it as cash transaction. Bearer check, it's a check, it's not an account payee check, it's a check, but even this will be considered as cash transaction. In all places? No. Only in these 3 sections. So in these 3 sections, when I talk about cash transactions, we are also going to include check transactions by default. Any check which is not account payee check. Okay. Then what about your cross check? Even that's a check, but even this will be considered as cash transaction. What about account payee check? Account payee check? No. Okay, so cash transactions for the purpose of these 3 sections will not only be cash transactions, also it will include check transactions, but the check should not be account payee check. Got it? This was one small point. Now listen, talking about STT and CTT. STT is your securities transaction tax. CTT is commodities transaction tax. Now whatever STT and CTT you pay, like for example, whenever you buy and sell securities in the stock exchange, you pay STT. Whenever you buy and sell commodities in the commodities exchange, you pay CTT. Now if these are relating to your business or profession, that is, they are relating to your stock in trade, then under PGBP, these expenses will be allowed. But if these expenses are relating to a capital asset, which means in the capital gains head, these expenses will not be allowed. Okay, so STT and CTT, if they are relating to a stock in trade, then it will be allowed as an expense in PGBP. But if it is relating to capital asset, then first of all, no PGBP. Instead, you will go to capital gains head. In capital gains head, however, STT and CTT is never allowed. Okay. Then comes VRS, your voluntary retirement scheme. So here, whatever compensation you are paying under voluntary retirement scheme, it will be allowed for you on payment basis across 5 years. This point I hope you remember, guys. In the first part of my marathon, under the salaries discussion, there itself I have spoken to you about this point. So whatever VRS I am paying to my employees, whatever VRS compensation I am paying to my employees, it's an expense for me. It will be allowed for me in PGBP computation, but it will be allowed on payment basis and it will be allowed across 5 years. Okay. Then comes my next discussion, guys. Expenses for promoting family planning amongst employees. This expense will be allowed only for the company assessee and it will not be allowed for other assessees. So if assessee is incurring expense in promoting family planning amongst employees, it will be allowed for the assessee. Only the assessee is a company assessee. Now this expense can be a capital expense or it can be a revenue expense. Revenue expense will be fully allowed. Capital expense will be allowed across 5 years. Now, whether because of REVX, whether because of CAPEX, because of these expenses and all, you cannot have a loss. In simple words, these expenses you will adjust only as much as your profit can absorb. Balance will become unabsorbed. Same like depreciation, guys. Like for example, your net profit before adjusting these expenses is, let's say, 100 rupees. And these expenses put together are 120 rupees for you, let's say. So you can't subtract full 120. No, you can't have a loss because of this number. So you will subtract only 100. So your PGBP will become 0. Now what about the balance 20 rupees? The balance 20 rupees will become unabsorbed. You will treat it just like unabsorbed depreciation, which means you will carry it forward indefinitely and you can adjust it against any income except salaries. Simple point, guys. So point number 1, this expense will be allowed only for company assessee. If it is any other assessee, it will be fully disallowed. Then point number 2, for company assessee, 2 kinds of expenses will be allowed, REVX and CAPEX. REVX will be fully allowed. CAPEX will be allowed across 5 years. Okay. Now see one small chart I've made for you over here, that because of these, can we have a loss or not? 35AD, your specified businesses. Because of 35AD deduction, yes, I can have a loss. Then because of depreciation, I can't have a loss, guys. Here I have the unabsorbed concept. Then in scientific research, because of revenue expense, I can have a loss. But because of capital expense, then look at this chart, okay? It's a very interesting chart. I have 5 points for you. You have to tell me in these 5 situations, can I have a loss or will there be unabsorbed concept? Okay. 35AD, specified business. Because of 3580 deduction, can I have a negative number? Can I have a loss? Yes guys, I can have a loss. Then depreciation, because of depreciation can we have a loss? No. So depreciation, here we have the unabsorbed concept, which means because of depreciation you can't have a loss. If your net profit is not sufficient, then that much depreciation only you will adjust as much as profit you have. Balance depreciation becomes unabsorbed depreciation. Okay. Then in scientific research, section 35, you have two types of scientific research guys, in-house scientific research and contribution to outsiders. Because of contribution to outsiders, you can have a loss, not a problem. Because of revenue expense relating to scientific research, here also you can have a loss, not a problem. But because of capital expense relating to scientific research, you cannot have a loss. So here you have the unabsorbed concept. Basically, whatever capital expense your profit is not able to absorb, that will become your unabsorbed capex on scientific research, which you will treat same like unabsorbed depreciation. Okay. Similarly, expenses for promoting family planning amongst employees. If assessee happens to be a company assessee, RevEx and capex will be allowed guys. RevEx will be fully allowed, capex will be allowed across 5 years. But because of RevEx also, because of capex also, because of both, you cannot have a loss. In simple words, the unabsorbed concept will apply over here. This RevEx and this capex you will adjust only as much as profit you have. You will adjust only as much as your profit can absorb. Balance will become unabsorbed. Now, if it is unabsorbed, so you're having unabsorbed in how many places now? 3 places. Unabsorbed depreciation, unabsorbed capex relating to scientific research, and unabsorbed family planning expense. So whenever you have the unabsorbed concept, same treatment guys. What is the treatment? You will carry it forward indefinitely. You can adjust it against any income, just that you cannot adjust against salaries. Okay, so in 3 places you have unabsorbed concept, depreciation, then capex relating to scientific research, and family planning expense, both RevEx and capex. Okay, then coming to health insurance premium, if I am going to pay health insurance premium for my employees, okay, I am the employer, I am paying health insurance premium for my employees. For me, it's an expense guys. It's an expense relating to business or profession guys. So this expense will be allowed for me under the PGBP head, but it will be allowed only if I'm making payment in non-cash mode. So if I am paying health insurance premium for my employees, okay, if the assessee is the employer, then for the employer it's an expense, it's a business expense, it will be allowed in PGBP provided payment is in non-cash mode. Okay, then bad debts recovered, I have already spoken to you about this in section 41 itself. Then we have some exempt subsidies guys. If I'm getting subsidy from tea board for growing and manufacturing tea in India, that subsidy will be fully exempt. Then if the subsidy is relating to rubber, coffee, cardamom or any other notified commodity, even that will be fully exempt. So subsidy relating to tea, rubber, coffee, cardamom or any notified commodity will be exempt provided your business is growing and manufacturing in India. Okay. Next, coming to a CSR expenditure. So if assessee is incurring any expenditure on corporate social responsibility on CSR, then under income tax, the CSR expenditure will be fully disallowed. But if the same CSR expenditure, if you're able to fit it under some other section, like for example, if you make a contribution to outsiders for scientific research, okay, this is covered under section 35 under Income Tax Act, and this is also covered under CSR as per Companies Act guys. So like this, you have some common points which are covered under other sections under Income Tax Act. So if I'm going to incur CSR expenditure which is in the form of contribution to outsider for scientific research, then in that case under section 35 it will be allowed. So what I'm trying to say is, even though it is a CSR expenditure, because I'm able to fit it under section 35, under section 35 it will be allowed. Okay, but however, if I have CSR expenditure which I'm not able to fit in any other section like that, then CSR expenditure will be fully disallowed. If the same CSR expenditure can be fit under some other section, then under that section you will allow it. Okay, let's take up a new section now, section 35D, which talks about preliminary expenses. Slowly, without any tension, point by point we will take up and we will understand. Okay, simple 4 to 5 points only. Point number 1. What is the expense over here? When are you incurring the expense? So point number 1 is a timing, that when are you incurring the expense? Either you're incurring the expense before commencing the business, or you're incurring the expense after commencing the business. If you're incurring the expense after commencing the business, then either it is for expanding your existing unit or to set up a new unit. Okay, simple. So when are you incurring the expense? Either before commencement or after commencement. If it is after commencement, either it is for expansion of your existing unit or for setting up a new unit altogether. Point number 1. Point number 2, who are you? Who is the assessee over here? Either assessee is an Indian company or any other resident. Basically, only residents can enjoy this deduction, non-residents can't. Then comes point number 3. If you want deduction under section 35D, for you audit is mandatory. The same point we have in section 35AD also, specified businesses. There also we learned that if you want to enjoy 35AD deduction, then audit is mandatory. Same point even over here we have. Then comes my fourth point, that what are these expenses? Give me some examples of these preliminary expenses. Like for example, you're incurring an expense with respect to feasibility report or project report, or conducting a market survey, or engineering services relating to assessee's business. Let me give you some examples. Let us say you want to come up with a new product. Now see, you will start manufacturing this new product only if there is enough demand in the market. So in this case, you will do a market survey. You will try to find how much supply is already there in the market, how much demand is there in the market. Is there a shortfall? Is it a case where there is high demand but less supply? Only then you will go ahead and you will start manufacturing the project. That is market survey. So before you can start manufacturing the goods, you will do a market survey. For that, whatever expense you incur, it will become preliminary expense. Okay. Similarly, if you happen to be a company, then in that case, to incorporate the company, we will have to incur incorporation expenses, guys, registration expenses. Then we'll also have to pay the lawyer to help in drafting the MOA, AOA, to help in drafting agreements and all. Or if you're making a public issue, then public issue expenses for shares and debentures, underwriting commission, all of these also will come under preliminary expenses. Now these preliminary expenses, will they be allowed in PGBP computation? Yes, but there is a maximum limit. The maximum limit depends upon who is your assessee. It depends upon, is your assessee a company or any other person. If your assessee is a company, then the maximum deduction will be 5% of cost of project or 5% of capital employed, whichever is higher. Any other assessee, similarly simply 5% of the cost of project. This is your maximum limit. So what is cost of project now? Cost of project is nothing but your assets, your fixed assets, land, building, plant and machinery, furniture and fixtures of that business all put together will become your cost of project. Capital employed will be issued share capital plus debentures plus long-term borrowings. Please notice, issued share capital, not paid up share capital, okay? Issued share capital plus debentures plus long-term borrowings, and all these numbers you will take as on 31st March of the year in which you are commencing the business. And point number 6, so whatever is your section 35D deduction, that deduction will be allowed across 5 years, starting from the year of commencement of business. For 5 years it will be allowed. In simple words, listen to me. Let us say you incurred all these expenses. Totally it was 1 lakh rupees. Alright. Now this expense, this is your actual expense. So first of all, you will compare this expense with the limit, guys. What will be the limit? If it's a company, 5% of the cost of project or 5% of capital employed, whichever is higher. If any other person, 5% of cost of project. So you did all this calculation and let us say your 5% number, your maximum limit happens to be 80,000 rupees. So now out of these two, tell me, what's your final amount now? How much deduction will you allow? Whichever is lesser, guys, 80,000 is what you will allow. Now this 80,000 will be allowed across 5 years. So 80,000 divided by 5, you will get 16,000 rupees. 16,000 rupees is what you will allow under section 35D across 5 years. Alright, that's all. Simple. Then comes the next discussion about advertisement expense. Okay, I'll explain it to you over here. Now the tax treatment of advertisement expense depends upon where is the advertisement. In my general situation, advertisement expense is going to be allowed. For all assessees, advertisement expense will be allowed. But however, if the same advertisement happens to be in a newspaper or in a magazine or in a souvenir or any other publication belonging to a political party, then under the PGBP chapter, it is always disallowed, guys. So generally, advertisement in the PGBP chapter, it is allowed. But if the same advertisement happens to be in a political party's publication, under the PGBP chapter, it will be disallowed. Okay. But the same political party advertisement, if the assessee happens to be a company, okay, then in chapter 6 you have 80 GGB. Under 80 GGB it will be allowed. I'll help you understand what is this 80 GGB. So this first 2 points were with respect to my PGBP chapter. Now listen, I'm talking to you about my chapter 6A. So in our chapter 6A we have 2 sections, okay. We have 80 GGB and we have 80 GGC. Now 80 GGB is applicable for companies, 80 GGC is applicable for other assessees except AJP and except local authority. Okay, now these sections are covering two things. Number one, if I make any donation to a political party or if I make any donation to electoral trust. Now this will be covered in both 80GGB also, it will be covered in 80GGC also. But 80GGC ends over here, guys. In 80GGC only 2 points we have and it ends over here. But in 80GGB we have one more point. This advertisement in a newspaper, magazine, souvenir, anything belonging to a political party, this will be allowed under 80GGB. Only thing is whether 80GGB, whether 80GGC, the payment has to be made in non-cash mode. Okay guys, so which means now what's my conclusion? If assessee is making an advertisement in a political party's publication, in PGBP it will be disallowed. In chapter 6A, for companies alone, it will be allowed under 80GGB. Okay, so now if I have to make my final summary, okay, it all depends upon where is the advertisement and who is the assessee. So if it's an advertisement expense, general advertisement expense, okay, whether company, whether other assessees, what will your answer be? What will your answer be, guys? Your answer will be that it will be allowed under the PGBP head. Your general answer for advertisement expense is that it will be allowed under PGBP head. But if the same advertisement happens to be in a newspaper or in a magazine belonging to a political party, then whether company, whether any other assessee, under PGBP head, it will not be allowed, guys. But however, this advertisement in newspaper or magazine of political party, for companies alone, it will be allowed later under which section? Under 80GGB. In chapter 6A, it will be allowed. But do you have something like this chapter 6A point for other assessee also? No, you don't have. Now you got it? Yes. So this is it about my discussion with respect to advertisement, guys. Then comes speculative business. What do you mean by speculative business? Speculative business means there is no delivery of goods. You're just trying to enjoy the fluctuation in price. Like for example, I'm buying the goods, I'm selling the goods, I'm not even taking the delivery of goods. I'm just enjoying the fluctuation in price. Like for example, intraday share trading. Intraday share trading will come under speculative business because in intraday, I'm buying the shares in the morning, I'm selling them in the evening. So here I did not even take the delivery of the shares. So speculative business means what are your hints? No delivery of the goods. I am just enjoying fluctuation in price. Intraday share trading, all this will come under speculative business. But please know, derivative business is not speculative business. Share trading is not speculative business. Futures and options is also not speculative business. If that share trading is intraday share trading, which means within the day itself you're buying and selling, that will become speculative business. But otherwise, share trading, derivative, future and options is not speculative business. Okay. Then comes the next discussion, guys, relating to donations. No doubt donations are generally covered by section 80G, but however there are two donations: National Fund for Rural Development and National Urban Poverty Eradication Fund. If assessee is making a donation to any of these two funds, and if assessee is carrying on a business or a profession, then under the PGBP head these donations will be allowed. So generally donations go to 80G, but these two donations, if assessee is having PGBP head, will come under PGBP itself, it will be allowed. But 80GGA also covers these donations. This I'll keep it pending for now. 80GGA we will straight away cover in our chapter 6A. Alright, so donations generally 80G, but these two donations will be allowed under PGBP. Okay, then comes the next discussion, guys, about PF. Let me explain it to you over here. So when it comes to PF, we have employer's contribution also, we have employees contribution also, and right now we're talking about PGBP chapter. In PGBP chapter, who is your assessee? Your assessee is the employer. Okay, so if the employer is making his contribution to PF, for the employer it's an expense, and for the employer, this I hope you remember, guys, we had covered under 43B. So employer's contribution is an expense for the employer. It will be allowed under PGBP head, but 43B will apply, which means payment has to be made within 139 date. Only if payment is made within 139 date, only then this employer's contribution will be allowed under the PGBP head. Okay. Now what about employee's contribution? So sometimes what happens is the employee gives his contribution to the employer and the employer remits it to the PF authorities. Employer will anyways be going to the PF authorities to remit his contribution. So employee is giving his contribution is also to the employer, saying you will anyways be going to the PF authorities, submit my contribution also to the PF authorities. This is what generally happens practically, guys. Practically, if you see, when the employer gives salary to the employee, from the salary itself, employer deducts the employee's contribution to PF. So it's as if the employee has paid the contribution to the employer and now employer is going to remit it to the PF authorities. So there are two transactions. The first transaction, when the employer receives it from the employee, it will be deemed to be income. It will be taxed for the employer under the PGBP head. It will become deemed income. Okay. Then second transaction is employer is remitting it to the PF authorities. When the employer remits it to the PF authorities, if the remittance is within the PF due date, mind you, not 139 date, PF due date. If the employer is remitting the contribution to the PF authorities within the PF due date, then only it will be allowed for the employer under the PGBP head. Okay, so when it comes to employer's contribution, 43B will apply, guys, which means we have to make the payment within 139 date. But when it comes to employee's contribution, there will be two things. First, the entire employee's contribution will be deemed to be income under PGBP. Then whatever amount is remitted to the PF authorities within PF due date, that alone will be allowed in the PGBP chapter. Okay, so two things remember. Then comes my next point, bonus. See, bonus is going to be a business expense and therefore this bonus expense will be allowed under PGBP. But however, if the bonus happens to be a percentage of profits, then bonus will be disallowed. So bonus is generally allowed, but if the same bonus is a percentage of profit, then it's going to be disallowed. Then comes stock valuation. Sometimes stock is overvalued or undervalued. Like for example, guys, let's make one trading account. Let's say my opening stock is 100. My purchases is 120, my sales is 150 and my closing stock is 100. Okay. So therefore, your gross profit will become 30 rupees, guys. 30 rupees is your gross profit. Okay. But let's say later I tell you that the actual opening stock number in reality is 90 rupees only. But how much have we recorded? We have recorded 100 rupees. So first of all, tell me, have we overvalued the opening stock or have we undervalued the opening stock, guys? Here my real opening stock is 90, but I have written 100. So I have overvalued my opening stock and I have overvalued it by how much? What is the difference? I have overvalued it by 10 rupees. So now if I rectify, what will happen? If I write my correct opening stock number of 90 rupees, then my gross profit will become 40 rupees, guys. Which means, are you noticing, gross profit rupees 30 plus the difference of 10 rupees 40, that is what is happening over here. So when opening stock is overvalued, what should you do? You should add the difference. Whatever is the differential amount, you should add it when in your PGBP computation. So now I always make one small table for you to help you remember. See, opening stock, closing stock, either it will be overvalued or it will be undervalued. So opening stock in my example was overvalued. So what did we do? We added the difference. If you remember add, everything else will fall in place. So if opening stock overvalued, if you're going to add, then opening stock undervalued, what will you do? You will subtract. If opening stock overvalued, you're going to add, then closing stock overvalued, what will you do? Full ulta pulta, guys. You will subtract. If closing stock overvalued, you're subtracting, then closing stock undervalued, what will you do? You will add. Okay, so that is what I've put for you even over here, that whenever the stock is undervalued or overvalued, you will find the difference, and the difference is what you will add or subtract. Okay, just remember add. Just remember opening stock overvalued add. If you remember that, everything else will fall in place automatically. Okay, then comes the next discussion, guys, about gratuity. Now, if this gratuity is contribution to an unapproved gratuity fund, it will never be allowed. But if it is contribution to approved gratuity fund, I hope you remember, guys, employer's contribution to approved gratuity fund, it is covered in 43B. So because it is covered in 43B, payment has to be done within 139 date. Only then it will be allowed. So this is simple. Unapproved gratuity fund not allowed. Approved gratuity fund allowed, but subject to 43B. Then comes my next point, provision for gratuity. Provisions and reserves by default are disallowed. But if the question gives you more information, if the question says employee has retired, so assessee has to make payment of gratuity, and this provision for gratuity is towards that. In simple words, this provision for gratuity is towards gratuity which is actually payable. Employee has retired, assessee actually has to pay gratuity, and this provision is relating to that, then it will be allowed. Or if the question says this provision is relating to approved gratuity fund, then subject to 43B, it will be allowed. So by default, provisions are not allowed. But if this provision is relating to gratuity actually payable, it will be allowed. Or if this provision is relating to approved gratuity fund, then of course subject to 43B it will be allowed. Then what if there is no provision and all? What if employee has retired and assessee is directly making payment of gratuity to the employee? Then of course it will be allowed, because there it becomes a direct expense. Okay, so approved gratuity fund will be allowed subject to 43B. Provisions generally disallowed, but if this provision is relating to gratuity actually payable, or if it is relating to approved gratuity fund, then it will be allowed. Then if employee has retired and employer is actually paying gratuity directly to the employee, then of course it will be allowed. Okay, then comes share of income from AOP. See, if I get a share of income from HUF, it will be fully exempt. If I get share of profit from partnership firm or LLP, even that will be fully exempt, guys. Similarly, what if I'm a member of an AOP and what if I get a share of income from AOP? Now that share of income, guys, will sometimes be exempt, it will sometimes be taxable. Whether the share of income for me, for the member, is exempt or taxable depends upon at what rate AOP is paying tax. If AOP is paying tax at maximum marginal rate, then for the member, the share of income will be exempt. But if AOP is paying tax at the normal slab rate, then for the member, the share of income will be taxable. So share of income from HUF always exempt. Share of profit from firm always exempt. But however, share of income from AOP for the member will sometimes be exempt, it will sometimes be taxable. It depends upon at what rate the AOP is paying tax. Okay. Then comes your key man insurance policy. There will be two transactions over here. Year on year, we will pay premium and then later we will get maturity proceeds. So whatever premium we are paying on key man insurance policy, business expense allowed under PGBP, whatever maturity proceeds we get relating to KMIP, it will be taxed under the PGBP head. So relating to KMIP, two adjustments. First we pay premium, later we get maturity proceeds. Both will come under PGBP head. The premium will be a business expense which will be allowed under PGBP. The maturity proceeds will be a business income which will be taxed under PGBP. Okay guys. Then comes our next discussion, a last concept. Under the default regime under 115 BAC, what will change? I do this discussion for you at the end of each head of income, guys. In salaries also towards the end I had told you that what are the changes. In IFHP also towards the end I told you changes only in self-occupied property. Now in PGBP head, if assessee follows 115 BAC, there are only 4 changes. Number 1, you will not get additional depreciation. Number 2, in section 35, in-house scientific research you can still enjoy, but contribution to outsiders you cannot enjoy. Then 3580 for specified business you will not get. So if you're not getting 3580, then on those assets you can claim depreciation instead. Right guys? So these 3 points you know very well. At the respective sections when I was discussing in the chapter, that time itself I spoke to you about these 3 points. But there's one more point, guys. In your unabsorbed depreciation, let's say you're having unabsorbed depreciation brought forward from earlier years. Now inside this unabsorbed depreciation brought forward, you will have unabsorbed normal depreciation and you will have unabsorbed additional depreciation, guys. Unabsorbed normal depreciation, life as usual. But if you have unabsorbed additional depreciation, then 2 things. Number 1, you have to reverse it. How will you reverse it? You will reverse it by adding it back to the block. And number 2, you have to ignore it, which means you cannot carry it forward, you cannot set it off and all, you will simply ignore it. Okay, so in case you are having unabsorbed depreciation brought forward, inside that, if there is normal depreciation, life as usual. But inside that, if you have unabsorbed additional depreciation brought forward, then you have to reverse it by adding it to the block, and then you will ignore it. Ignore it means you will not carry it forward, you will not set it off and all, you will simply ignore it. Okay guys, so in PGBP chapter, because of 115 BAC, 3 changes: no additional depreciation, contribution to outsiders, scientific research, you will not get a deduction, 3580 you will not get a deduction, and finally unabsorbed additional depreciation, you have to reverse it by adding it back to the block, and also you will ignore it, which means you will not set it off against incomes and all, you will simply ignore it. Okay. Then, so with this our chapter is over, but just a few more reminders and few extra points. See, the first few over here, I'll explain it to you here. See, listen to me. Point number 1. If you pay any interest under Income Tax Act, it is considered as a penalty. Like 234A, B, C interest, it is considered as a penalty and therefore it's going to be disallowed in your PGBP computation, guys. But if the same interest is relating to GST Act, in GST Act, interest is considered to be compensatory interest and hence this interest will be allowed under PGBP. So interest relating to Income Tax Act will be disallowed, but if the same interest is relating to GST Act, it will be allowed. Point number 1. Then comes the second point. Under section 234F of Income Tax Act, if you file a return late, you will have to pay fees. It is like a penalty and penalties are always disallowed. So any penalty, any fine, any fees and all will be always disallowed, okay, provided the fees is in the nature of penalty, and 234F fees is in the nature of penalty, therefore we are disallowing. Then point number 3, assessee has paid income tax, then assessee has paid surcharge, assessee has paid cess. All of these will come under personal tax, guys. It will be personal expense and hence it will be disallowed, okay. But however, let us say the income tax department has sent one notice to the assessee, okay, asking the assessee to pay more tax. Assessee got scared. Assessee went to a chartered accountant and told the chartered accountant, please handle this notice for me. So chartered accountant only is going to the income tax department and representing the assessee. So for this, assessee will pay fees to the chartered accountant, guys. So this is called as a statutory income tax proceeding. Basically, some income tax case is going on. Relating to that, assessee is paying the lawyer or assessee is paying chartered accountant these professional fees. This is going to be allowed, guys. This is going to be allowed in PGBP computation. Understanding? So coming back to my table now, number 1, interest under income tax act, I just told you it is like a penalty, it will be disallowed. Then fees under 234F, if you file your return late, even this is like penalty, it will be disallowed. But the same interest under GST act, it will be allowed, okay. Then any penalty under income tax act will be disallowed. Penalty under GST act will also be disallowed. Basically, any penalty you pay because you violated any law, any fine, any penalty will always be disallowed. Then income tax, surcharge, says they are all personal expenses and hence even they will be disallowed. Then we learned if a statutory income tax proceeding is going on and relating to that you hired a lawyer, you hired a consultant or a chartered accountant, you incurred expenses, you paid fees, all that will be allowed. Okay, till here you understood. Then listen to my next point. Let's say I entered into a contract, okay, and I breached the contract. So because I breached the contract, the other party asked me to pay a penalty. This penalty is going to be allowed, guys. Always remember, penalty will be disallowed only if I violate a law. Here I did not violate a law, I only violated a contract. So penalty for violation of a contract will be allowed, okay. Then remaining points are simple. In incentive or stipend paid to articles, I am a practicing chartered accountant, I am paying stipend to my articles, it will be allowed for me. Then gift or diary given to clients on New Year, I am giving gifts or diaries to my clients, I am not giving to my relatives, I am giving to my clients, so it is relating to my business or profession, therefore even this will be allowed. Then income tax refund. Income tax refund is considered as a personal income. It will not be taxed in any head. But however, interest on income tax refund, guys, will be taxed under IFOS head. Alright. Then duty drawback, waiver, concession, industrial power tariff concession, duty drawback, all this will be taxed under PGBP head. Clear, everybody? Yes, so these are some unique expenses which they ask in our total income question. Alright. Then expenses paid to self, like for example, I'm paying interest to myself or I'm paying rent to myself. They are notional expenses. They are always disallowed. Provisions and reserves, I already told you, they will always be disallowed. Got it, everybody? That's all. So this is it with our entire PGBP chapter. So here what I tried to do is, I tried to cover every single concept. I did not do just the important points. Tested areas, untested areas, I've tried revising them all for you. I hope this gave you some confidence. I hope it's making some difference to your preparation. Right, guys? So I'll close over here with this in our marathon. Our basics is done, residential cities is done, agricultural income is done, and salaries head of income. These 4 were done in our first part. IFHP and PGBP got done in our second part now. Capital gains and IFOS we will finish in our third part. Alright. So I'm hoping these marathon sessions, I mean, even though I'm calling it marathon, I'm very sure you will agree with me, they are way more deeper than a normal marathon, right? It's way more deeper. There's a lot more depth. So I'm hoping that is helping you, because marathon sessions, quickly revising just from the top discussing, there are many such sessions. But I wanted to make something which is a little more useful for you, wherein we go even deeper and cover even the small points which generally you all tend to miss. Right, guys? So I'll close over here. Thank you. Bye-bye.